Hello my dear CA Inter students, welcome to all of you for this accounting standard marathon for 2 days. In this marathon I have covered approximately 9 accounting standards. 7 accounting standard I covered fully, 2 accounting standards I covered only the important parts. And in this accounting standard marathon, along with the concepts I covered problems also. And the main purpose of this marathon videos is to revise the standards in a quick time along with the questions to boost your confidence. I hope this marathon will help you in your preparation. So if you like them, please share with all your friends, and also kindly subscribe the channel. All the resources which is used in this marathon are readily available in the website. In free resources you can check and you can get it. Thank you, all the very best. So hope you all like my efforts. Thank you. Good afternoon to all the students. Welcome to the marathon for CA Inter Advanced Accounting Standards Marathon. So today and tomorrow 2 to 8. So average I am planning 5 hours, so 10 hours for accounting standards. In these 10 hours I will try to cover the important accounting standard, the standards which majority of the students taking as a choice. So I am focusing on those standards. So let's see, my main object is to complete at least 12 accounting standards, 10 to 12. Depending upon the time availability, if the time permits, we'll cover more accounting standards. Okay. So let's start our first standard discussion. Accounting standard 15, employee benefits. This is the first standard we are going to discuss, sir. Employee benefits. Sir, what is this standard is all about? See, when you joined in any organization, you will provide services. For your services, company will give some benefits. Now the accounting of those benefits is given by accounting standard 15. Tell me, generally when you joined in any organization, what kind of benefits you will get? You will get salary, wages, PF, gratuity, pension, leave compensation, bonus, like this. So many types of benefits you will get, right? How company will do the accounting of those benefits? That is what provided in this standard. Okay, so the main object is what? Providing accounting for employee benefits. And if you know this standard employee benefits is the best example for accrual concept. Accrual concept. What is accrual concept? Expenses will be recognized actually when they are incurred, right? So therefore entire the standard is based on this accrual concept only. Whatever the benefits we are paying to the employee, they will be recognized when company actually incurred them. That means when employee actually provided the service, the expenses will be incurred, the company will recognize those expenses. So throughout the standard, you remember this concept that this standard is subject to accrual concept. Always try to apply accrual concept. Okay. And sir, this standard is applicable for all types of employee benefits, except there are few exceptions. That is share based payments. That means companies sometimes will give benefits to employees in the form of shares, share based payments. That is not covered under this standard, because for share based payments there is a separate accounting standard or separate guidance note is there. So that's why when there is a separate guidance note, obviously this standard is not applicable. And also this standard is not applicable for accounting and reporting by employee benefit plans like PF authorities, pension authorities. So for them this standard is not applicable. This standard is applicable only to companies which is providing benefits, and it is applicable only for level 1 enterprises. Level 1 means big companies, listed companies only this standard is applicable generally. Okay, now important points are, see this accounting standard is applicable to all type of employees. Benefits provided to all type of employees, whether that employee is a full-time employee, part-time employee, casual employee, doesn't matter. All type of employees are covered under this standard. Second, all kinds of benefits, whether it is paid in cash or kind, covered under this standard. You give benefit in cash, or sometimes you give benefit in kind, this standard is applicable. And next, this standard is applicable to benefits given to employees as well as their dependents. For example, on employees wife, children, for them also company if gives any benefits, that is also covered under employee benefits. And also the last one, payments made directly by employer or any institution organization on behalf of employer is also covered. Like for example, payments can be made directly to employees or their dependent or any other party, like insurance companies, trust, legal heirs, all this. Okay, so please understand, sir, this accounting standard 15 is covering all type of employees and all kinds, whether benefit is given in the form of cash or kind will be covered, and also benefits given to employees and their dependents also covered, and also benefits given by employer or on behalf of employer if any other organization provides benefit, that is also covered. And one more important point, sir, suppose a person joined in an organization, definitely there is a contract. Company will enter a contract with him. In this contract, everything will be mentioned. What are all the benefits he is going to get throughout his employment? So these employee benefits will arise from the contract, formal agreement. Sometimes as per law, for example, PF, gratuity, pension, these are required to be paid by employer to the employee as per law. We have PF Act, Gratuity Act. According to the acts, we need to provide benefits to the employees. Sometimes informal practices, important. Informal practices. That means there is no agreement. There is no legal requirement. But still, any payment made by the employer as an informal practice. Like for example, every Diwali season, company will give Diwali bonus to the employees. It's a practice. That Diwali bonus is also employee benefit. That is also covered under this standard. Okay. So you see in the study material, if you see the illustrations, first illustration you see, what are the kinds of employees covered under AS 15? Tell me what kind of employees are covered? All kinds. Part-time, full-time, casual, everybody is covered. And whether a formal employer-employee relationship is necessary? For example, tell me, in order to cover under this standard, whether formal employer-employee relationship is necessary? For example, I am employer, you are employee. Is this relation is necessary? Formal employer-employee relationship is also not necessary. See, actually there are two things here: contract of service, contract for service. Contract of service, that means employer employee. Basically employer is controlling employee. If that kind of relationship is there, this is covered. There is contract for service. For example, I am a professional, I am providing services to you, so therefore you are not controlling me. So when there is a contract for service, there is no employer employee relationship, then that is not covered. So therefore here you need to understand, formal employer employee relationship is necessary, not required. There is no legal agreement also, not a problem. There is no formal agreement between the employer and employee, but still if there is a contract of service, so you are my employee, I am employer, I am controlling you, and I am making sure that you are working for me. So that kind of relationship is there, then the standard is applicable. So see this, such contract need to be carefully examined to distinguish between contract of service, contract for service. Contract for service implies a contract for rendering services, example professional technical services, which is subject to limited direction and controls. Whereas a contract of service implies relationship of employer and employee, and the person is obliged to obey orders in the work to be performed and has to be mode and manner of performance. And also second question, you see, whether an enterprise is required to provide for employee benefits arising from informal practices. Even informal practices like Diwali bonus is also covered under this standard. Okay, now come back. So now listen, sir, accounting standard 15 main points, sir. Now I am moving into the main standard crux. Accounting standard 15 has divided the employee benefits into 4 categories, sir. All employee benefits are divided into 4 categories. One is short-term employee benefits, another one is post-employment benefits, another one is other long-term employee benefits, and then termination benefits. 4 types of employee benefits are there. And now for each type of employee benefits, they have provided the accounting treatment. So first one is what? Short-term employee benefits. What is short-term employee benefits? Any benefits payable to the employee within 12 months from the end of the reporting period. Any benefits payable within 12 months from balance sheet date. See this, employee benefits payable within 12 months from balance sheet date, like salaries and wages, for example. You know, salaries and wages, monthly basis company will pay, sir, you work for the month, service provided, immediately after the month they will give you salary. So it's a short-term employee benefit. So short-term employee benefits is benefits which is payable within 12 months from the end of the reporting date or balance sheet date. Now what is post-employment benefit? Any employee benefits payable after employment, that is on retirement. Once an employee retired from the organization, we will provide some benefits now, PF, gratuity, pension. They are all called post-employment benefits. Next, other long-term employee benefits. Other long-term employee benefit means any employee benefits payable after 12 months from balance sheet date. Like for example, jubilee benefits. Jubilee benefit means any employee who work in the organization for long period. For him, we will give some extra benefits, that is called jubilee benefits. So next, termination benefits. Termination benefit means, for example, an employee who is terminated from the services. Now when you terminate any employee from the services, we need to give some benefits to him. That is called termination benefits. So best example, retrenchment compensation. So like this, employee benefits are divided into 4 categories, sir. So what are the employee benefits, sir? First one, short-term employee benefits. Second, post-employment benefits. Post-employment benefit means the benefits which is payable on retirement, PF, gratuity, pension, all these things. Other long-term employee benefit means benefits which is payable after 12 months from balance sheet date. And last one, termination benefit. What is termination benefit? Benefit which is given to employees on termination from the service. Now we need to discuss the accounting treatment for each type of employee benefits. Now first see the short-term employee benefits. So short-term employee benefits, in the short-term employment benefits, sir, there are 3 categories, sir. In short-term employee benefits, we have 3 categories. One is regular period benefits like salaries and wages. Second, bonus. Third, leave compensation. This is called short-term compensated absences. Short-term compensated absences is called leave salary. So like this, there are 3 types of short-term employee benefits is there. Salaries and wages, bonus, short-term compensated absences. Short-term compensated absences means leave salary, leave compensation, nothing but leave compensation payable to the employee. Now first, salaries and wages, sir. Tell me what is the accounting treatment you follow in respect of salaries and wages? Salaries and wages. So for example, salaries accrued and paid. What is the entry? Salary to cash or bank. Salary to cash or bank. Suppose you are the employee, you provided in the month of, you provided services in the month of April. Once April month is over, you provided the service now. So once you provide the service, the expenses are accrued to the company. I told you, this standard is based on which concept? Accrual concept. When employee provided the service, company will recognize the expenses. What is the entry with company will recognize? Salary or wages to cash or bank. When accrued and paid, and these salaries and wages, where it will go? It will go to the P&L account as per schedule 3, employee benefits. In P&L account, we have one head called employee benefit expenses. There I will show this, salaries and wages. Next, sometimes salaries accrued but not paid. Salary already accrued but not paid. So therefore, salary account debit to outstanding salary account. This outstanding salary is a liability for us. These salaries and wages is go to P&L account as a expenses. And sometimes we pay salary in advance. When we pay salary in advance, what is the entry? So prepaid expenses to cash or bank. Next, when salary actually accrues, these prepaid expenses will be cancelled against the salaries and expenses. Okay. So short-term employee benefits, what is the accounting treatment? Simple. When the employee provided the service, the related benefit will be recognized. Related benefit will be recognized. As and when the service is provided, the expenses, the benefits provided by the company will be recognized. So in case of salaries, three situations will come. Salaries accrued and paid, salaries accrued but not paid, salaries paid in advance. So when salaries paid, salaries to cash or bank. When salary accrued but not paid, salary to outstanding. Salaries paid in advance, prepaid to cash or bank. And when actually expenses occurred, so these prepaid expenses will be adjusted against the original salaries and expenses. Next, second type of short-term employee benefits is bonus. Sir, what is this bonus? Sir, suppose there is a company Trident Limited. There is an employee. Now this company has a promise to the employee that for the year 24-25, if the sales of the company increases by 10 crores, if the sales increases by 10 crores, we are going to give you 5% bonus, 5% of the profits will be given in the form of bonus. Now see, year end come, target achieved, then company has to recognize the bonus. So you are the employee, sir. What is the target for you? Sales should increase by 10 crores. At the end, definitely sales suppose increased by 10 crores. Company immediately will recognize the bonus. What is the entry for bonus accrued? Bonus to outstanding bonus. We will recognize expense as well as a liability. So bonus to provision for bonus. This bonus is employee benefit. It will go to P&L account, expenses side, employee benefits. Provision for bonus is a liability. And when actually bonus is paid, what is the entry? Provision for bonus to cash or bank. Now here, in respect of bonus, one important point, sir. Suppose here company said they will give you 5% profits, provided you work in the organization throughout the year. But some of the employees left the organization. So therefore, company has reduced this bonus from 5% to 4%. Therefore, you need to give bonus on the basis of 4% only, not on the basis of 5%. Therefore, whenever you are calculating bonus liability, bonus expenses, you need to consider the expectations of the company also. What the company's expectations, accordingly you need to recognize. Important. So, for example, see this example. A profit sharing plan requires an enterprise to pay a specified portion of its net profit for the year to employees who serve throughout the year. So the condition is you should serve throughout the year. If no employees leaves during the year, the total profit sharing payment for the year will be how much? 3% of net profit. The enterprise estimates that staff turnover will reduce the payment to 2.5% of net profit. That means the condition is you should serve throughout the year. Suppose if you left, what company will do? It is not our mistake, na? You left. We said we will give 3% of net profits as a bonus to you. But the condition is you should work throughout the year. But you are not working. So therefore, the company is expecting only 2.5% of the net profit. Then in such a situation, we should recognize liability and expenses only for 2.5% of the net profit. Important. Okay. Next. So what we are discussing? Short-term employee benefits. Correct? In short-term employee benefits, three things are there. One is second, bonus. So both are completed. The last one is what? Leave compensation. I think this is the most important one, where most of the students are struggling to understand this leave compensation. Let us try to understand this. What is this leave compensation concept is? Leave compensation. Sir, when you joined in any organization, definitely there is a leave policy. For example, you are Mr. X, you joined in one organization, sir. The company said your working days in a year is 300 days, sir. Sir, in a year 365 days, now why you are taking Sundays, public holidays? They will be normally given 300 working days. And company said there is a leave, paid leaves will also be given. Paid leaves. What is basically a paid leave? Paid leave means the leave which you can take, but for that period also payment will be given. That is called paid leave. Even though you will not come to office for that period, we will pay. That is called basically paid leaves. Suppose company said your paid leaves are 15 days paid leaves. Paid leaves can be sick leave, casual leave, different names. So see this, normal working days 300, paid leaves 15. That means in effective how many days you have to work? 285 days. If you work 285 days, you will get full salary. Suppose for example, sir, your salary is 3 lakhs, sir. Example, your salary is 3 lakhs. So can you tell me what is the salary per day? Salary per day? 3 lakhs divided by 300. Hello? 3 lakhs is the total salary divided by 300 days. So 1000 rupees per day is the salary, correct? Everybody? Now you see, this paid leaves, whatever is there, they are divided into two categories. One is accumulating, another one is non-accumulating. Accumulating means, yes, these leaves can be carry forward. Carry forward allowed. Here carry forward is not allowed. That means this year, suppose for example 15 days are there paid leaves. Suppose all the 15 days have not utilized, so they are unutilized, but they cannot be carry forward. When they cannot be carry forward, sir, basically no accounting treatment. Forget about it. Now come to accumulating. Accumulating means, suppose this year if I don't use my leaves, what I can do? I can carry forward to the next year. Now in the accumulating, there are two situations will come. What are those? Vesting, non-vesting. Vesting, non-vesting. Vesting means cash will be paid. You will get cash for unused leaves. For example, 15 days unused leave is there. Next year for this 15 days, 15 into 1000, 15,000 rupees you will get cash. That is called vesting. Non-vesting means no cash will be given, no cash. Only you have to utilize, that's it. For example, this year you have 15 days unused leave. Next year, these 15 days you can utilize. That's it. We don't give cash. That is called non-vesting. So total paid leaves are divided into two categories. Generally, paid leaves are divided into two categories: accumulating, non-accumulating. Accumulating again, vesting, non-vesting. For example, you are Mr. X, sir. You are Mr. X. Suppose this year 24-25, you provide the service. What is your total paid leaves? As per the policy, total paid leaves 15. Suppose you have not utilized the paid leaves. You have not utilized. That means total 300 days you worked. So those 15 days which you have not utilized will be carried forward to the next year. Suppose I am explaining this situation, accumulating and that to vesting first. Hello? 15 days unused leaves are there. What company will do is, at the end of the year, you provided the service, 24-25. That means you have earned how many paid leaves? 15. Therefore, company will recognize provision for expenses and liability for that 15 days in the year itself. In this year itself, because you provided service for 24-25. So for the year for which you provided the service, whatever the leaves you earned unutilized, for those leave company point of view, company will recognize expenses as well as liability. So therefore, what company will write at the end of the year? Leave salary or leave compensation or leave salary. Leave salary account debit to provision for leave salary. Like this they will write. How many days I told unused leave? 15 days. Into each day what is the salary? 1000. So total 15,000 company will create what? Provision. Next year 25-26. What happens next year? Suppose if they are vesting, what happens? Tell me. If they are vesting, cash will be paid. So company will write provision for leave salary account debit to cash or bank. That's it. 15. Yep. Along with your regular salary. Regularly, how much you will get, sir? 3 lakhs. So you will get your 3 lakhs subject to working of 285 days. And this year, how many leaves you earned? The benefit which is expected to you get in the next year. For that, I need to recognize provision in this year only. leave salary to provision for leave salary, and next year when the options are vested, cash is paid, provision for leave salary to cash or bank. Suppose if they are non-vested, what happens? Tell me. Suppose if they are non-vesting, then no cash will be given. Then what is the entry will write? See, next year non-vesting means, see this. This 15 days for the 14-15 you have not utilized, na? So if you are an employee, what you do? Company will not give cash to me for that 15 days. So definitely next year you will take 15 days leave also. That means next year what we need to do is salary or wages company will pay, right? Say this, salary or wages. What is the salary or wages? 3 lakhs. In this 15,000 provision for leave salary will be deducted. Remaining 2,85,000. We will write provision for leave salary 15,000 to cash or bank. We will write 3 lakhs. That's it. So what is the difference between vesting and non-vesting, sir? In vesting, you will get additional amount for leave salary. That unused leaves is there, na? For that benefit, you are going to get additional cash. For non-vesting, you are utilizing those leaves also in the current year, right? So therefore, for first the provision will be deducted from the salary, and it will be deducted from the salary's original salary, and it will be paid like this. So therefore, here the employee is getting extra amount along with the salary. But here in non-vesting, he won't get any extra amount, you would say. Because, sir, logically, if you're speaking, sir, 300 days or more working days. Correct? In these 300 days, in the year 25-26, if you observe, normal 15 days casual leave is there for me. That I won't work. Example. And last year carry forward leaves also I utilized. That means in effect how many days I worked? 270 days only I worked. In order to get full salary, how many days minimum I need to work? 285 days. 285 days. But in the year 15-16, 25-26, how many days I worked? 270 only worked. 270 only worked. That's why your salary is 2,85,000. Why you have worked 270 days? Because the unused leave of the last year also utilized in this year. So that way, from the salary first, that provision what you created will be deducted, and that will be paid, that will be recognized separately. You understand this? So this is treatment for leave salary, sir. Hello? Sir, you understand the treatment of leave salary? So tell me, sir. At the end, leave salary, paid leaves are basically divided into 2. What are those? Accumulating, non-accumulating. Accumulating means leaves will be carried forward to the next year. Next year, cash will be paid. Then they will be vesting. Vesting. If cash will not be paid, non-vesting. So, if there is any leave salary, unused leaves are there, which will be paid in cash or which can be carry forward and you can utilize in the future years, that the corresponding expenses relating to that will be recognized in the year of service itself. In whichever year you earned those leaves, in that year itself we need to recognize. Right? So what is the entry? Expenses to provision. Expenses to provision. Whatever be the name. One expense, one provision. Leave salary to provision for leave salary. You're right. Next year what happens? If it is vesting means cash will be paid to you. So leave provision for leave salary to cash or bank. See, this leave salary will go to P&L account. This will be liability. Next year it will be paid. If it is non-vesting, you won't get cash separately. But employee, the more important possibility, here the possibility is employee will utilize these 15 days also in the next year. Because if they are non-vesting means obviously employee's mindset is what, sir? You will not give me cash. Why I will unnecessarily work for you? 15 days unused leave is there now. Next year I will take it. So next year I will take this 15 days leave also. So company point of view, you worked only 270 days. So, but we will give you full salary. So therefore what we will do is from the salary first this earned leave will be deducted and then it will be provision will be cancelled and total 3 lakhs will be paid to you. So this is short-term employee benefits accounting treatment, sir. We have completed. Sir, you understand short-term employee benefits? Yes. Now next, the most important in this standard is post-employment benefits. This is where most of the students are struggling, sir. Struggling to understand what? Post-employment benefits. Listen to me carefully. Post-employment benefits. The question mostly will come from this post-employment benefits only. Mostly they are asking a question from post-employment benefits only. So listen to me carefully. First of all, what is this post-employment benefit? Just now I told, any benefits payable on retirement to the employee, PF, gratuity, pension, those are called post-employment benefits. Okay. Post-employment benefits are divided into two categories. One is defined contribution plan, another one is defined benefit plan. Defined contribution plan, defined benefit plan. Okay. First we'll see defined contribution plan. What is this defined contribution plan? See, as an employer, I will contribute some amount to a fund. That's it. My responsibility is over. Once you are retiring, at the time of retirement, how much amount you are going to get? It is not in my hand. Best example is PF. Suppose there is a company. For example, you see, there is a company, there is a PF authority, PF fund. There is an employee. Company will contribute amount to PF. And this, at the time of retirement, employee will get the amount from PF fund. So why this is called defined contribution plan? Because as an employer, my responsibility is over when I contribute the amount. Finally, how much amount employee is going to get, it is not in my hands, or I am not bothered about it. That's why it is called defined contribution plan. In defined contribution plan, I am not promising any fixed amount to you. Suppose you are my employee. Okay, I am not promising, sir, how much I am getting at the time of retirement, sir. 20 lakhs or 30 lakhs or 50 lakhs. I am not giving any guarantee. Every year or every month, on your behalf, I will contribute some amount to PF. Where at the time of retirement, they will calculate and they will give you the amount. So as an employer, my responsibility is over when my contribution is done. So therefore, here in defined contribution plan, company makes a specific amount of contribution to the fund. Company obligation is over after making the contribution to PF fund. So therefore, suppose the contribution is done every month or every year. Whenever I am contributing the amount, when the contribution occurs, due date occurs, in my books I will write defined contribution expenses to defined contribution payable, or else simply says PF expenses to PF payable or PF provision. Expense provision. So that they are calling it as defined contribution expenses to defined contribution payable. So see this, PF contribution to defined contribution obligation, my PF liability. For example, see this, A Limited is an employer, Mr. X is employee. Okay, PF, every year I will contribute 1.2 lakhs. That's it, my risk is over. Every year, how much I will contribute? 1,20,000. Therefore, at the end of the year, what is the entry I will write? PF contribution to PF liability, PF expenses to PF liability, or else you can improvise this, PF contribution account debit to DCO. DCO means defined contribution obligation. Basically, DCO is nothing but liability. And when you actually pay DCO to cash or bank. This is what I will do every year. That's it. So here there are two types of risk: investment risk, actual risk. Both are not in my hands. Investment risk means finally how much amount you are going to get. I am not bothered. Actual risk means, sir, there is a person called actuary. See, all these employee benefits depends on so many factors. Like for example, how many years employee will work, what is his salary at the time of retirement, how many years he will survive. There are so many things we need to estimate and calculate the liability. So that estimations and all will done by a professional called actuary. So when he makes an estimation, sir, these estimations may change. That's why this is called actuarial risk. This risk, investment risk, in case of defined contribution plan is in the hands of whom? Employee. So you understand the accounting treatment of DCO, defined contribution plan. So tell me, in case of defined contribution plan, as an employer, I am giving any guarantee to you? How much amount you are going to get? Just I will make what? Contribution. Whenever contribution amount due, what is the entry? PF contribution to PF contribution, provision for PF. Correct? That's it. When you pay, provision to cash or bank. Expense to provision, name, whatever you want to put, relevant name you can use. Now, the most important thing is DBP, defined benefit plan. So this is the interesting point. Everybody should listen. Sir, what is this defined benefit plan? See, in defined benefit plan, sir, as an employer, I am giving you an assurance that you are going to get this much benefit. That means in case of defined benefit plan, as an employee, how much benefit you are going to get is guaranteed from my side. Therefore, the risk is on me as an employer. In defined contribution plan, just I will contribute to the PF. How much amount you are going to get at the end, I am not bothered. Just I will contribute. How these PF authorities are performing, how the fund is performing, how the investment is performing, I am not bothered. In case of defined contribution plan. That's why in case of defined contribution plan, investment risk, actual risk is with whom? Employee. But in case of defined benefit plan, I am defining the benefit to you. Suppose, dear employee, at the time of retirement, you are going to get to see this. For each completed year of service, 20% of the last drawn salary will be given to you. Suppose you are one of the employee. Company in the agreement promised you that for each completed year of service, we will give what? 20% of which salary? Last drawn salary will be given to you. That means the benefit is fixed. Therefore, the risk is with whom? Employer. That's the difference between defined benefit, defined contribution. So defined benefit, the risk is with employer. In defined contribution, the risk is with the employee. Suppose, for example, company promised to the employee that your last drawn salary, on that 20% for number of years of service, we are going to give the benefit. Okay. Sir, I am going to explain the accounting treatment for this defined benefit plan through one example, sir. Through one example. That example is there in the study material, sir. Very, very important example, illustration. If you solve this illustration, sir, I think you will get the concept. Illustration number 9. Roshan limited sum. Roshan sum. Sorry, Roshan. So, say this. This is defined benefit obligation sum, sir. Suppose there is an employee, Roshan, sir. He joined in a company, XYZ. And the annual enrollments of Roshan, 14,90,210 annual salary. The company has a policy of giving a lump sum payment of how much? 25% of what? Last drawn salary of the employee for each completed day of service. If the employee retires after completing minimum 5 years. The salary of the Roshan is expected to grow 10% per annum. So therefore, can you tell me, is this defined contribution or defined benefit? Defined benefit. Because we are clearly defining how much amount he is going to get. For each completed year of service, he is going to get how much? 25% of the last drawn salary. Last drawn salary means at the end of the 5th year. Now his salary is how much? 14,90,210. Every year you need to add 10% growth. So therefore, his last drawn salary will be how much? Say this, 14,90,210. Every year you add 10%. Like that, you will get 24 lakhs. So 24 lakhs is the last drawn salary. On this 24 lakhs, 25%. How many years he has to complete? 5 years. Therefore, how much is the benefit? 30 lakhs. We need to pay 30 lakhs to him. So therefore, think from company point of view. Company promised to Roshan that you are going to get 30 lakh rupees after 5 years. So therefore, now it is the responsibility of the company to make sure that the employee is going to get 30 lakhs. So how to do the accounting treatment in this case? Now you tell me, you are the company. You know that you are going to pay 30 lakhs to Roshan when? After 5 years. So therefore, definitely you need to recognize, anticipate and recognize. Na? The standard says, first whatever the amount came liability divided by number of years of service. How many years here? 5 years. So 30 lakhs divided by 5. How much came? 6 lakhs. Every year you anticipate and recognize 6 lakhs, 6 lakhs, 6 lakhs, 6 lakhs like that. But here comes the most important point. So therefore, you see here, for example, you see 30 lakhs is what the liability of the company, and this liability when company is going to pay? Now I am at the end of the first year. Imagine first year end, employee completed 1 year first year service. So 30 lakhs divided by 5. So how much came, sir? 6 lakhs. But the standard says this 6 lakhs is what? This is you are going to pay when? At the end of the 5th year. Now you are at the end of the first year. Therefore, from first year to still how many years are there? 4 years. Therefore, this 6 lakhs convert into the present value. So this 6 lakhs is the future value. You need to convert into the present value. That value which you convert into present value is called current service cost. What is that? Current service cost. So the entry is current service cost account debit to DBO, defined benefit obligation, liability. Current service cost account debit to DBO account. Expenses to liability. Expenses to liability. Here expenses is called what? Current service cost. Now another mistake students will do now. Here suppose this 6 lakhs I want to convert into present value. How you are going to convert? How you are going to convert, sir? Say this. Suppose, say this, 6 lakhs first year. When it is expected to be paid? At the end of the 5th year. When it is going to expected to pay? At the end of the 5th year. But now you are at the end of the first year. Still how many years pending? 4 years. So it is expected to paid after 4. So therefore, see this. Suppose the 8% discount rate given, sir. 8% discount rate given in the question. Present value factor 8% given, say discount rate. Now you see the present value factors for 8%, sir. You need to see the present value factors for 8%. See this. 1, 0.926, 0.857, 0.794, 0.735. Reverse order you need to take. Because you need to understand, this is the future value. I need to convert into the present value. This is expected to be paid after 4 years. So therefore I need to consider what is the present value after 4 years from now. Therefore in your calculator you need to take, so 8% means 1 divided by 1.08. 1, 2, 3, 4. So 0.735. But most of the students what they will do now? First they will take 1, then reverse 0.926, 0.857, like that they will take, which is wrong. Here you need to consider the present value in reverse order. First, last year he started with 1. Next, like this, you need to go. Why? Because you need to understand, first year I am going to recognize this 6 lakhs. This is going to be paid after 4 years. So I want this 6 lakhs, which is I am going to pay after 4 years. What is the present value now? So therefore, multiplied with 0.735. Next, another important point, sir. So therefore, what is the present value of this 6 lakhs? 4,41,000. Hello. What is the entry? Current service cost to DBO. That means my liability is 4,41,000, 4,41,000. Here comes another interesting point. Now this 4,41,000 you have recognized this year. But what is the actual future value? 6 lakhs. So the remaining difference you need to unwind every year. Every year you need to unwind the remaining difference. Sir, how to unwind, sir? Very simple. First year how much you recognized? 4,41,000 into 8%. Into 8% you do. 4,41,000 into 8%. How much came? 35,280. Next year you recognize this 35,280 also as an interest cost. Interest to DBO. Like that, 4,41,000, 8%, second year, 8%, then 8%. Like that if you do first year, second year, 1, 2, 3, 4. It will become 6 lakhs. If you want, you can check also. 4,41,000 starting point, sir. Every year you add 8% to this 4,41,000. 4,41,000 plus 8% plus 8% plus 8% plus 8%. How much came? 6 lakhs. That means we have met the future liability. The present value of 6 lakhs is how much? 4 lakh 41. Now still how many years gap is there? 4 years. So every year I need to unwind the remaining difference. How I am going to unwind? Just simple, current service cost into the interest. I need to keep on adding interest. Then I will get the future value. That means by the time I reach the end of the year, end of the 5th year, the total liability should be 30 lakhs. So therefore here two things we have done. Every year we need to recognize the present value of the obligation, that is current service cost. And relating to this current service cost, next year we need to anticipate every year the interest, unwind the remaining difference. For that, what is the entry? Interest to DBO. Interest to DBO. So current service cost to DBO, interest to DBO. Like that every year you need to do. Suppose at the end of the second year you come. Second year also how much is my obligation? 6 lakhs. Second year also how much? 6 lakhs. Convert the 6 lakhs into present value. So if I am at the end of the second year, this 6 lakhs is expected to be paid when? After 3 years. Therefore I need to multiply with present value factor for 3 years. Third year. Hello. See this 0.794. How much came? 476, 400. 476, 400. You recognize it. And next year you add interest on this. Unwind it. So that it will reach to 6 lakhs at the end of the 5th year. Like that every year current service cost convert into the present value, and to the next years it has to be unwind. It has to be unwind. So that's it, sir. See this. CST to DBO every year we will write, and the interest cost also we will recognize and we will transfer to DBO every year. So that is what here given. If you want you can check also. See this. How it has to be calculated. You look at this. For example, first they have calculated the defined benefit obligation 30 lakhs. Then it has to be divided by number of years of service. 6 lakhs came. Okay. Now every year 6 lakhs into present value factor 4 lakh 41. Every year we need to this. Every year this has to be recognized as which cost? Current service cost. Current service cost to DBO. Current service cost to DBO. Next you need to calculate interest also. Every year how much interest you will charge? Suppose for example this 4,41,000 is the opening balance. So this closing balance. Next year this will be opening. On that apply 8%. Again second year current service cost 476, 400. The total closing balance is this. And on that 8%. Third year 5,14,200 total. Like this you need to do. So at the end you see what will be the liability? 30 lakhs. So you understand the accounting treatment for defined benefit obligation, sir? So defined benefit obligation, can you tell me the steps? What is the first step? First always find the what is the obligation, what is the liability divided by years, number of years. Then you will get every year amount. Will you take it actually? No, you need to convert into present value. What is the entry for that? Current service cost to DBO. Current service cost to DBO you will write. And whatever the gap is there between the present value and future, that will be unwind every year in the form of interest. What is the entry for that? Interest to DBO. That's it. So this is the thing. Now the interesting point, sir. Here I will tell you. When you are calculating this, there are certain changes, sir. For example, here I have given, sir, current service cost, interest cost I told you. Next, actual gains or losses. What is this? See this. I told you, no, sir. These actual gains or losses arise because of change in assumptions. For example, employee will serve for 5 years. We assumed and we calculated the liability. But he served 7 years, or maybe he served only 3 years. The liability changes. For example, we expected that employee will live for 70 years. Life expectancy. Maybe he died early. So because of that, actual gain or losses come. When gain will come, sir? If the obligation, if the liability decreases, gain will come. What is the entry for that? DBO to actual gain. Actual gain. For example, because of the change in actual assumptions, if the liability increases, then actual loss to DBO. Actual loss to DBO. And this actual gain or losses will be recognized to P&L account immediately. Will be recognized to P&L immediately. In study material, one question is there, sir. I will show you that question also. The question is, they will give you the actual, see this question, sir, illustration 6. So what happened is, the company has received an actual valuation, and the actual valuation shows a surplus of how much? 6 lakhs. Now this 6 lakhs, what they want to do is, they want to amortize over a period of time. What is your view? They are asking. The answer is wrong. The actual gains and losses should be recognized immediately in the P&L account as income or expenses. Therefore, surplus of 6 lakhs is credited to P&L account. Any actual gain or loss has to be recognized immediately. Next. Sometimes what happens is, company will change the plan, sir. For example, in the Roshan sum, what is the company promised to pay? 25%? 25% every complete year, sir. For example, initially 25. Later on, company changed it to 20%. Company said, no, we don't give 25, we will give only 20. That means when the benefit reduced now, obviously liability will reduce. Hello? So therefore, liability will be reduced. Similarly, suppose 25%, company said we need to increase it to 30%. Then liability will increase. Liability will increase. Now, here one interesting point, sir. When the liability decreases, whatever the current service cost already you recognize it, no, sir. Actually, suppose for example, the liabilities you need to recognize is 80. But already in the books, you recognized 100 as a current service cost. Are you understanding? 100. Therefore, the extra 20 you recognize it, na? That is called unamortized past service cost. That is like a prepaid expenses. What is prepaid expenses? Expenses not incurred but paid. Similarly, in case of defined benefit obligation, sometimes what happens is, we will change the benefit which is going to be paid to the employees. When the liability decreases, sir, actually the amount of current service cost we need to recognize should also be decreased. But obviously, in the past years, we have recognized based on the original liability. So therefore, if you have recognized any excess current service cost, now it has to be treated as what? Unamortized past service cost, which is like a prepaid expenses. Remaining I need to recognize is amortized past service cost. Suppose for example, if the obligation increases, liability increases, na sir, now DBO account I will credit, amortized past service cost I will debit. And this unamortized past service cost is like a prepaid expenses. Prepaid expense is basically what? Asset. One question is there, very, very important question. So therefore, understand, sir, what happens is sometimes company will change the plan. Defined benefit plan, company will change. So suppose 25% they may reduce it to 20, or 25% they may reduce to 30. So when the liability increases, sir, you need to increase the recognition. Current service cost also you need to recognize. Hello? And suppose for example, if the liability decreases, sir, whatever the cost we have recognized, past service cost, that has to be unamortized. That is treated as what? Prepaid expenses. Next is sometimes curtailment and settlement, sir. What is that? Curtailment and settlement. What is curtailment and settlement? For example, employees. Some of the employees we are removing from the services, or we don't want to give benefits to them. So that is called curtailment and settlement. Company curtails benefit of employees under DBB and settles before maturity. Now, whenever company curtails the benefit payable to the employees, company point of view, it is what? Gain. So therefore, liability will be reduced. It is transferred to gain on curtailment. So DBO to gain. DBO to gain. For example, company liability 100, sir. Now company curtailed 20 rupees benefit. That means 20 rupees liability will be reduced, and that will be treated as what? Gain. Gain on curtailment. That's it, sir. This is DBO. But my advice to all of you is that you need to focus on the core part. Roshan limited sum is there, na, sir. Please focus on that sum alone. It will be more than sufficient. Now, next. So therefore, we understood that we have one liability. What is that liability? DBO. DBO is our liability. We need to pay to the employees. Correct? Now, to meet this liability, what company will do is, company will make some systematic investments. Those are called plan assets. What is plan assets, sir? These are investments specifically done to fund our DBO. Sir, because DBO is our liability, na, sir. To meet our liability, what we need to do? we will make some investments. Okay, those are called plan assets. So what is the entry? Plan assets to cash or bank. So plan assets is our asset, DBO is our liability. This liability, this asset will be set off. The balance will be shown as net defined benefit obligation or net defined asset, plan assets. Net defined plan assets. For example, if asset is more than liability, that means net defined asset, plan assets. If the liability is more than assets, that is net defined benefit liability. In the balance sheet we will show. Are you understanding? Now relating to this plan assets, they are asking the question. What is the questions they are asking relating to this plan assets now? Calculation of expected return, calculation of actual return. Two types of questions they are asking. Calculation of expected return, calculation of actual return. So see this. Calculation of expected return, calculation of actual return. And remember guys, these plan assets will always be shown at what value? Fair value. So there is opening plan assets fair value. During there we'll make some contributions. During there some benefits will be paid to the employees from these assets. And finally closing fair value of plan assets. This is the format. Actually, see this. When I want actual return, what I need to do? Simple. I will take the opening fair value of plan assets. Suppose opening fair value of the plan assets 8 lakhs. What is this fair value of the plan assets? My investments market value, fair value. During their company contributed 2,80,000 to the plan, invested during the year. Whenever invested, what is the entry? Plan assets to cash or bank. Minus whatever the benefits paid to the employees. When you pay benefit to employees, obviously your assets will decrease. Minus 8,80,000. And your closing fair value of the plan assets is 11,40,000. So see this, 8,80,000, it becomes 11,40,000. So therefore, what is the actual return? 2,60,000. This is how you need to find out actual return. Hello. So first you take the opening fair value of the plan assets, add contribution minus benefits paid, compare with closing. The difference is nothing but, suppose the difference, if the closing fair value of the plan assets is more than this, obviously there is a return, actual return. And how to calculate expected return? See, there are two things here: expected return, actual return. See, whenever you make investments, you are expecting some return. That is called expected return. How to calculate expected return? The calculation of expected return is simple. Take first opening fair value of the plan assets. On that apply expected return. They will give you in the question the expected return. Opening fair value of the plan assets into expected return. You will get expected return on opening fair value of the assets. And during the year, how much is the net contribution you made? How to get net contribution? Contributions minus benefits paid. During there, how much you contributed to the plan assets minus how much benefit you paid to the employee. This is called net contribution. On this net contribution, apply expected return. You will get expected return on net contribution. Add both of them. You will get the total expected return. How to find out expected return? First take the opening fair value of the plan assets. On that apply expected return. You will get expected return on opening fair value of the plan assets. Then find out net contribution. What is net contribution to the plan assets? Total contributions minus benefits paid. How much contribution company made to the plan investments? I mean, how much investment made? How much benefit paid to the employee? The difference is net contribution. On that apply your expected return. You will get expected return on net contribution. Add both of them. You will get expected return. That's it. So this is how you need to arrive expected return and actual return. I will show you, sir. I will solve some questions so that you will understand. Yeah, see this type of questions they are asking. Come to question number 8 in the study material. Scenario based question 8. See this question. The following data apply to X Limited defined benefit pension plan. See this. Defined benefit pension plan for the year ending 31st March 2022. Calculate what? Actual return on plan assets. Benefits paid how much? Actually benefits paid is what? Outflow. Next, employer contribution 2,80,000. What is this? Inflow to the fund. Inflow to the plan assets. Company invested. What is the fair market value at the end? 11 lakh 40. At the beginning 8 lakhs. So you need to get what? Actual return. Say this. Actual return is nothing but first to take the opening. How much? 8 lakhs. How much contribution made? 2 lakh 80. How much benefits paid? 2 lakhs. What is the tell me? 8 lakhs 80. What is the closing fair value? 11 lakh 40. So closing fair value is more than this difference. How much? 2 lakhs. This is actual return. This is actual return. I am telling you in a more logical manner. Opening, add contribution minus benefits paid. Compare with closing. If closing is more than this, obviously there is a return. That return is nothing but actual return. Or else you can do in another manner also. This manner they have done it. See this. First you take the opening 8 lakhs, add employer contribution less benefits paid like 80. Fair, same manner only they have done. Sorry. Okay. This is one question, sir. One examination question also recently they asked. Same question. See this. This question they have asked both actual return as well as expected return. In September 2024 attempt, this question asked actual return as well as expected return. Relating to expected return also one question is there. In the study material question only we will solve. 9th question you see. In this question we need to solve both expected as well as actual. See this question. The fair value of the plan assets of Anupam Limited is how much? 2 lakhs. In respect of employee benefit pension plan on 1st April 2011. Opening. On 30th September 2011, the plan paid out benefits of 25,000 and received inward contributions of how much? 55,000. On 31st March 2012, the fair value of the plan assets is how much? 3 lakhs. So on 1st April 2011, the company made the following estimates based on the market studies. Interest and dividend income payable by the fund 10.25%. Realized gain on plan assets 3. Fund administration cost minus 3. Expected rate of return 10.25. Okay. Calculate expected and actual return on plan assets on 31st March 2012 as per AS 15. So they are asking both expected as well as actual return. So how to calculate expected return and actual return, sir? First expected return. How to calculate expected return? First opening fair value of the plan assets. How much? 2 lakhs into 10.25%. 10.25%. That's it. You will get 1. Next, net contribution. What is the net contribution here? Contribution during the year 55. Benefits paid 25. 55 minus 25. 30 into 10.25%. And that too one more important. These are all happening on which date? 30th September. That means 6 months interest you need to take. Because both are happening. See this. On 30th September 2011, the plan paid benefits and received contribution. That means when you are calculating expected return, see this. Contribution 55, benefits paid 25. The difference is 30. On this 30,000, apply expected rate for 6 months. You will get expected return on net contribution. Add both of them, you will get the total expected return. Hello. You see this. First on opening return. So 2 lakhs into 10.25. 20,500 plus return on net gain. Net gain, or we can say net contribution. Net contribution is how much? 55 minus 25, 30,000 during the year ending. That is for how many months? 6 months. 6 months. You calculate 6 months. How much came, sir? Sir, here one interesting point, sir. Equivalent to 10.25% annually compounded every 6 months. So here interest is compounded every 6 months. Interest is compounded every 6 months. So therefore I need to find out the equivalent return, which is 5% they have given. Can you tell me how much you got? 5%? How you got? 1 plus r minus 1. This is the formula. So 1 plus, what is the return they have given? 10.25. 0.1025 minus 1. So you do it. Square root 1 plus 0.1025. Square root will apply 0. How much you got, please? 1 plus Yeah, this is the formula, sir. Actually, you see here, I have done it already. 1 plus r minus 1. This one. You will get 5%. You will get how much? 5%. Hello. See here, they have not applied a 10.25% compounded every 6 months. They have taken. That means for 6 months, the effective rate is how much? 5%. So they have taken 5%. How you got that 5%? Simple here. When interest is compounded for every 6 months, so 5% plus another 5% interest will be added now. So therefore, it will be 10.25% per annum. So 5% they have taken. So 1500. So total 22,000. Actual return, you know how to calculate. Everybody, actual return, you know how to calculate. So this is how you need to arrive expected return as well as actual return. Same type of question is there in the illustration also. If you see the illustration, same type of question is there. Yeah, I think this question. Same. See this illustration 7. Same illustration, sir. Expected rate also 10.25. Same way you need to calculate. Same here also they have taken 5%. Alternatively, they said one more thing, sir. The above question may be solved without giving compound effect. That means no need to give compound effect. Directly you apply 10.25% for 6 months you take. Like I told na, that is also correct. Here the assumption is interest is compounding every 6 months. That's why they have taken directly how much, sir? 5%. Are you understanding, sir? This 5%, the assumption is that interest compounded every 6 months. So I told the formula also. Square root of 1 plus r minus 1. So you will get it. So that's it, sir. This is how you need to arrive this. One more question I will tell you, sir. This question, I think this will come in exams. What I expect is illustration 8. This type of questions they may ask. See, this question is relating to curtailment. What is that, sir? Curtailment. For example, what happened in this question is, see this, sir. There is a company, Rockstar Limited, sir, which discontinues business segment. They are discontinuing one of the business segments, sir. Under the agreement with employees union, the employees of the discontinued segment will earn no further benefit. Those employees who are working in this business segment, they are not going to get any kind of benefits. So curtailment, we are stopping the benefits to employees. Okay, this is curtailment without settlement. Because employees will continue to receive benefit for the services rendered before discontinuance of the business segment. Curtailment reduces what? Gross obligation for various reasons, including change in actual assumptions made before curtailment. Okay, now you see, because of the curtailment, how much gross obligation reduced? See this, immediately before the curtailment, gross obligation is estimated how much? 6,000. And because of this curtailment, obligation is reduced by how much? 600. So tell me, what is the entry? Gross obligation reduced means liability reduces. DBO account debit to gain. I told you gain on curtailment. Your liability decreases means obviously gain, na? So therefore, DBO account debit to gain on curtailment. But here one more twist, that is, what they are saying is, Rockstar Limited estimates the share of unamortized service cost that relates to part of the obligation. How much? 18. Calculate the gain from curtailment and liability after the curtailment to be recognized. See, actually, the unamortized past service cost is there. How much? 180. Unamortized past service cost. Unamortized. Amortized or unamortized? I told you. Here gross obligation reduces. When your liability reduces, whatever the already recognized liability is there, already, or whatever you have recognized for the past services, you might have recognized excess. That excess we treat it as what? Prepaid expenses. Prepaid expenses. So out of this 180, how much is the prepaid? If your gross obligation reduces by 10%, in this unamortized past service cost also, how much will reduce? 180 into 10%, 18 will reduce. So therefore 18 is prepaid, gross obligation reduces 600. So therefore 600, your liability decreasing, your asset will be reversed by 10. So therefore net gain is how much? 600 minus 18. 600 minus 18. How much? 600 minus 18, sir. 582. That is what we are going to recognize. 582 is the gain on curtailment. Gain on curtailment 582. 582 is the gain on curtailment. See this. Actually, here I have written also gain on curtailment. What is the obligation reduced? Gross obligation 600. What is the share of unamortized past service cost? 18. 582 is the gain on curtailment. So the entry is this: DBO account debit 600, unamortized past service cost 18, gain on curtailment 582. This is very, very important. You understand this unamortized past service cost? Sir, when your liability decreases, obviously the excess what you have already recognized is become prepaid. So this is an asset for you. One asset cancelled, one liability cancelled. So the net is 582 is the gain on curtailment. Hello. And one more thing they are asking in the questions here. Calculate gain and liability. And how much is the liability after curtailment to be recognized in the balance sheet of Rockstar Limited on the basis of given information? How much liability you are going to recognize in the balance sheet? Can you tell me? Here in this case, how much is the liability you are going to recognize in the balance sheet? See this. I told you in balance sheet, for example, DBO is our liability, right? This side will show plan assets. Correct? DBO, how much is there? Total 6,000. In this, how much reduced? 600. So what is the balance? 5,400. So 5,400. Plan assets, how much is there? 5,100. Given, see this. Plan assets 5,100. 5,100 we will show. What is the still unamortized past service cost is there? Out of 180 we reduce 18. Still balance is there. How much? 162. That is also unamortized past service cost, another kind of prepaid expense asset. So therefore you net off these two, the balance is nothing but net defined benefit obligation. Net defined benefit obligation is how much? 138. This is the liability of the organization. Sir, after curtailment 600 liability reduced na? So from 6,000 it will become 5,400. You have planned assets how much? 5,100. Unamortized past service cost how much you reversed already? 18. Still balance 162 is there. So therefore this one, net still obligation is there, that is 138. This is net defined benefit obligation, nothing but liability. We will show in the balance sheet, liability side. Actually that is what they have given here. See this 138 is the liability to be recognized in the balance sheet. So you understand this concept, sir? So that's it, sir. So we have completed which type of employee benefits we have discussed, sir? Post employment benefits. Now next, once we completed these two, post employment benefits is over now, sir. There is nothing to discuss in this standard. Next one is what? Other long term benefits. The other long term employee benefits treatment is exactly same as DBO. DBO, how we accounted DBO? First estimated the liability, divided by number of years. Every year, present value, current service cost, unwind the difference as a interest. Same manner, other long-term liabilities will be recognized. So other long-term liabilities accounting treatment is similar to that of the defined benefit obligation. So see this, the other long-term employee benefits are accounted similar to defined benefit plans. And last one, termination benefits. Termination benefit means when employee is removed from the service, we will pay some compensation to him, that is termination benefits. Termination benefit treatment is when you are required to pay this termination benefit in the next 12 months, you recognize the provision. When you pay, actually paid it. For example, VRS, voluntary retirement, termination, we are giving VRS to the employees. Whatever the VRS expenses you need to pay, VRS expenses to VRS payable, you recognize. Like how we recognize short-term employee benefits, same manner, expense to liability, pay it. When you actually pay, VRS liability to cash or bank, over. If it is a other long-term liability, like for example, if it is going to be paid within next 12 months, treat it as short-term employee benefit. Suppose if it is going to pay after 12 months, then what you need to do is, you need to recognize the provision, but you need to convert into the present value, like DBO. And just like DBO, how the interest cost is unwinded, na, same manner we need to unwind. So termination benefits, how the accounting will be done, either they will be treated as short-term employee benefits or long-term employee benefits, depending upon when you are going to pay them. If you are going to pay them in the next 12 months, treat them as short-term employee benefits. If you are going to pay after 12 months, treat them as long-term employee benefits. Accordingly, you create a provision at present value, unwind the difference in the form of interest, and when you actually make the payment, write the payment entry. That's it, sir. This is termination benefits. So my guess is they are going to ask a question from post-employment benefits. So post-employment benefits only they will test, sir. Mostly they will test post-employment benefits. And all the important questions also I covered, sir. Remaining questions you can see easily, you can solve, sir. With this discussion you can solve. Some theory questions are there in the study material. Very simple theory questions these are all. For example, you see illustration number 3. This illustration they are saying is a company is required to pay a salary of how much? 2 crores for the year 11-12. Actually paid how much? 1.9. That means remaining 0.10 outstanding. So what is the entry? Salary to outstanding salary. Salary to outstanding salary. What is the treatment I told? Salary is a short-term employee benefit. What is the accounting treatment for short-term employee benefit? Create a provision when it is actually incurred. When the employee provided service, in that year itself you recognize the provision. I told you 3 situations, na? Salary accrued paid, accrued but not paid, prepaid in advance. So you need to recognize both expenses as well as liability. So in this case, the total expense is 2 crores. In that outstanding is 10 lakhs. So therefore the entry is what? Salary account debit 2 crores to outstanding salary 10 lakhs and 0.10 crores to cash or bank 0.90 crores. That's it, na? What is that? Very simple. Now whether entitlement to earned leave which can be carried forward to future period is a short-term employee benefit or long-term employee benefit? Sir, leave salary. Leave salary short-term or long-term? Generally when it becomes short-term? If it is to be paid within 12 months from the end of the reporting period. And also we need to expect that the employees is going to exercise this. Employees is going to utilize these leaves in the next year. Then only it will be recognized as a liability. Important, sir. Sir, here in order to consider earned leave as a short-term employee benefits, 2 things must happen. That is, it should fall due within 12 months after the reporting period, and also where the absences are expected to occur within the 12 months after the end of the period. That means 2 things. They must fall due within next 12 months and we are expecting that employees are going to utilize them in the next 12 months. These leaves, unused leaves. Then only they will be treated as what? Short-term employee benefit. For example, 15 days unused leave is there. So we need to pay them in the next 12 months, falls due. At the same time, we need to expect that the employees is going to utilize them in the next 12 months. Then only we need to create a provision. Actually, in the study material, if you see, one question is there, I will show you. Yeah, this example is there in the study material. You see this example? Suppose there is an enterprise. In that enterprise, how many employees are there? 100. Each entitled to how many days leave? 5 days. Okay. Unused leaves can be carried forward for 1 calendar year. At the end of the year, the average unused leave is how many days? 2 days. How many employees? 100 employees. 100 into 2? 200 days. We need to create a provision at the end of the year for these 200 days. In general, hello. If we expect that employees is going to utilize these 2 leaves, either we will pay vesting or non-vesting. We need to create provision in the year in which they availed the benefit. I told you, in the year in which they earned leave, in that year itself we need to recognize. But what happens, you see, the enterprise is expecting 92 employees will take no more than 5 days leave. That means 92 employees will not utilize these 2 days unused leave next year. And 8 employees will take average how many days? That means this carry forward leave 1.5 days they will use in the next year. That means how many employees? 8. They will use 1.5 day of this carry forward leave. So 8 into 1.5? 12 days. Only 12 days we are expecting that employees is going to utilize in the next year. Therefore, you need to create provision only for 12 days salary. So expected additional cost. The enterprise expect to pay additional 12 days of pay. That is 1.5 day for 8 employees who take more leave. So therefore we need to create a provision as well as expenses for these 12 days at the end of 31st December 2024. So therefore at the end of the year, how many unused leaves are there? At the same time, out of unused leaves, how many are expected to be utilized by the employees? For that only we need to create a provision. While explaining the concept, I explained total 15 days. My assumption there is what? All the 15 days is going to be utilized by the employees, expected to be utilized by the employees. But this is the classic example. Even though each employee unused leave is how much? 2 days. But we are expecting that they are going to use only 1.5 day. That too, how many employees? 8. So 8 into 1.5, only 12 days will be utilized in the next year. So therefore we need to create provision only for 12 days salary. Are you understanding? That's it, sir. So this is accounting standard 15, sir. We have completed. Okay, sir. Next accounting standard we are going to cover is AS2, valuation of inventories. First of all, in this standard what we are going to cover is how inventories will be valued. That is the main objective of this standard. Okay. Basically, what is inventories? Inventories are assets which is held for sale in the ordinary course of the business, or in the process of production for such sale, or in the form of materials, to be consumed in providing services or production of goods. So basically inventories are assets which are held for sale in the ordinary course of the business. What is held for ordinary sale in the ordinary course of the business is called finished goods. Correct? In the process of production for sale. In the process of production means work in progress. So work in progress is also inventory. Next, for consumption in the production of goods or services for sale, including any maintenance, supplies and consumables, nothing but raw material. So basically, if you are a manufacturer, for you the inventory is in 3 forms. Anything you held for sale in the ordinary course of the business is inventory, finished goods. Anything in the process of production for such sale is also inventory, work in progress. And not only that, anything you held for consumption in production of goods or rendering of services. Suppose if you are a service provider, for providing your services, whatever the materials you consume, that is also your inventory. If you are a manufacturer. Suppose if you are a trader, for a trader, we will call them as stock in trade. For example, D-Mart is there. D-Mart is doing what? Is there manufacturing anything? No. They are purchasing and selling. For them, it is not finished goods. For them, it is stock in trade. They are dealing in stock in trade. So therefore, for a trader, anything he purchased for resale, that is inventory for him. For example, Reliance Smart is there. They are purchasing for resale. Anything they are purchasing for resale, that is also inventory for them. So therefore, you need to understand, sir, if you are a manufacturer, for you raw material, finished goods, work in progress will come. But if you are a trader, anything you are purchasing for resale, that will be your inventory. That is called stock in trade. And here one important point, sir. Any kind of spare parts, service equipment, standby equipment. Spare parts, service equipment, standby equipment. If they satisfy the definition of PPE, then they are not considered as inventory. If they satisfy the definition of PPE in AS10, then they will be considered as PPE. They will not be considered as inventories. Okay. So now this standard will provide you how to value inventory. Measurement of inventories. Very, very important. Listen to me carefully. Sir, the standard says how to measure inventories. In case of finished goods and work in progress, cost or NRV, whichever is lower, that principle we will follow, cost or NRV. This principle is the best example for prudence. Prudence concept says we should anticipate all possible losses but not gains. That is exactly we are following here. Suppose for example, you see your cost is 100, NRV is 120. Now we are recognizing whichever is lower. That means we are recognizing inventory at 100 only, not at 120. Na? That means the 20 rupees profit we are not anticipating. For example, your cost is 100, NRV is 90. Whichever is lower means we are taking 90. We are not showing inventory at 100. That means the loss of 10 rupees we are anticipating and recognizing. When your NRV is less than cost means there is a 10 rupees loss. That loss we are recognizing. So prudence means what, sir? Anticipation of all possible losses but not gains. So best example is this one, cost or NRV, whichever is lower, is the classic example for prudence concept. So therefore, when you are valuing inventory at the end of the year, if the inventory is finished goods, work in progress, you need to compare the cost, NRV. Whichever is lower is the value of inventory. What is the closing quantity available? Finished goods. Compare cost per unit, NRV per unit. Whichever is lower you take into closing stock quantity, then you will get the closing stock value. And you know the importance of closing stock. Closing stock will come in P&L as well as balance sheet. Current assets will show inventories, and in P&L account also expense side, cost of materials purchased, change in inventories of finished goods, work in progress. So therefore inventory is such an important item which is affecting both P&L as well as balance sheet. That's why inventory has to be properly valued. Okay. Now come the raw material, the most important. Sir, when it comes to raw material, how it will be valued? So the standard says raw material valuation is depends upon the finished goods valuation. Raw material valuation depends on the finished goods valuation. Why? Because raw material is not meant for sale. It is meant for use in the production of goods. That's why in respect of raw material, you cannot compare cost to NRV. So therefore, raw material valuation is always depends upon the finished goods valuation. If the finished goods in which this raw material is used is sold, important, listen to my words carefully. If the finished goods in which this raw material is using is sold yet or above cost, yet or above cost, that means the finished goods sale value, nothing but NRV, is equal to cost or above the cost, then raw material is valued at cost only. Raw material will be carried at a cost only. Suppose if the finished goods in which this raw material is used is sold below cost, that means the NRV of the finished good is below the cost, then raw material is valued at cost or replacement value, whichever is lower. Cost or replacement cost, whichever is lower. Therefore, the raw material valuation depends upon what? Finished goods valuation. If the finished goods are sold yet or above cost, then raw material is carried at a cost only. If the finished goods valued below cost, if the finished goods are expected to sold below cost, that means NRV is less than cost, sir. NRV is less than cost, then raw material is valued at cost or replacement cost, whichever is lower. That is what I have given here. See this. If the finished goods are expected to be sold at or above cost, then raw material is measured at cost. If the finished goods are expected to sold below cost, raw material is measured at cost or replacement value, whichever is lower. Why, sir? Why? Because see, obviously, when the finished goods sale value is less than cost means in the market the finished goods demand has been down. Obviously, when the finished good demand down, the raw material which is using in that finished goods value will also down. That's why they're saying that compare with replacement cost. What is replacement cost? Right now, if I want to purchase this raw material, how much I am going to spend? That is called replacement cost. Sir, for example, I am manufacturing one soap, sir. In this soap, I am using one oil. When the soap demand decreases, the sale value of the soap is below the cost. Obviously, this oil which I am using in the soap will value also will down. That's why I need to compare the cost with what? Replacement cost. If the replacement cost is less than cost, I need to consider only replacement cost. Are you understanding? So therefore, measurement of inventories you need to understand, sir. So that is what I have given. Raw material is always valued at cost. But if the finished goods are sold at or above cost, this principle will valid good. Otherwise at replacement cost. Provided this replacement cost is less than the original cost per unit of the raw material. Sir, sometimes what he will do now, he will give you replacement cost. But that replacement cost is more than cost. Then you should value the inventory at cost only. Don't increase it to replacement cost. Increase will not happen, only decrease will happen. If the replacement cost is below the cost, then raw material should be valued at replacement cost. If the replacement cost is above the cost, should maintain at cost only. In order to confuse you, sometimes he will give like that. And finished goods work in progress, how they will be valued? Cost NRV, whichever is lower. Now, so therefore I want two things now. What are those? Cost, NRV. Cost, NRV. How to determine cost? The standard says cost of purchase, cost of conversion, other cost. There are three types of cost are there. As per AS2, there are three types of cost. What are those three types of cost, sir? Cost of purchase, cost of conversion, any other cost. Important, listen. First, cost of purchase. Sir, sometimes you will purchase the goods, sometimes you will manufacture the goods, right? So when you purchase the goods, how to determine the cost? Take purchase price, add all duties and taxes, provided they should be non-refundable. If they are refundable duties and taxes, don't include. If they are already include, minus. Any freight, any insurance, any transportation cost, any expenses directly related to purchase, add. Any rebate, trade discount given by the supplier, deduct. You will get the cost of purchase. So how to determine the cost of purchase? First you need to take purchase price. Any duties and taxes. Which duties and taxes? Non-refundable. And any other expenditure directly attributable, like freight, transportation, loading, unloading charges, commission, insurance, everything add. Any discounts given by the other party, deduct. So you will get the cost of purchase. Now next, cost of conversion. Cost of conversion. Sir, what is this cost of conversion, sir? Cost of conversion. Let us see this cost of conversion. Cost of conversion means, sir, suppose imagine you are manufacturing the goods. What is the starting point? Raw material, then labor, material, labor, expenses, overheads, nothing but, right? Direct material, direct labor, direct expenses, nothing but overheads. So you add everything, you will get cost of conversion. Cost of conversion means nothing but the cost which is incurred to convert the raw material into finished goods. How much cost you are incurring to convert the raw material into finished goods? All those costs you add. But here, whenever you are finding the cost of conversion, direct material, direct labor, no problem. The main problem is overheads. Overheads are basically two types: variable, fixed. Important, listen. Variable overheads, fixed overheads. Variable overheads means what? Which will change along with the production, like fuel cost, power cost, all these things. Next, fixed overheads means depreciation, rent, maintenance expenses. These are fixed in nature. Irrespective of the production, they have to be incurred. Always remember, sir, in respect of variable overheads, how much variable overheads you will absorb to the production? Inventory. Variable overheads are absorbed always based on the actual production. Actually, how many units you produce, you need to absorb based on that. Fixed overheads, actual or normal, whichever is higher, you need to take. Fixed overheads are always absorbed based on actual or normal, whichever is higher, we need to take. Actual or normal, whichever is higher, we need to take, sir. So therefore, remember guys, when you are absorbing the fixed overheads, see the actual capacity. Actual means how much is the actual production. What is the normal capacity? Normal production. Whichever is higher you take. Don't take whichever is lower. What happens whichever is lower if I take? Tell me. For example, sir, you say this. My fixed overheads, suppose 14,000. My fixed overheads is 14,000. My actual production, suppose 500. Actual 400, sir. Normal 500. Tell me now. So fixed overhead recovery rate, 14,000 divided by actual or normal, whichever is higher. Whichever is higher means 500. So tell me, 14,000 divided by 500. How much? 28 rupees per unit. Correct? fixed overhead recovery rate. So therefore, how much is absorbed into production cost, inventory? How much? How many units you produced? Into recovery rate, 28. How much? 11,200 will be absorbed. Only 11,200 will be absorbed into inventory cost. What about unabsorbed balance? Unabsorbed. Your total fixed overheads 14,000, correct? Hello? In this 11,200 absorbed, remaining unabsorbed 2,000. This will go to P&L account. Like a abnormal loss. Abnormal loss this is. Why this is abnormal loss? Can anybody tell me? Simple sir, logic. What is your normal capacity? But how much you produced? That means there is an inefficiency. That means there is a inefficiency in the organization. Why this inefficiency? Because of the labor, because of the material or abnormal usage. Normal loss, no problem. Normal loss we will include in the cost absorbed, but abnormal loss we will not include. AS2 says any abnormal wastage of material, labor, overheads we will not consider in the inventory cost. Therefore here you see clearly it is visible. Suppose see. Some students will get it out. So why whichever is higher? Suppose if I take whichever is lower, instead of 500 if I take 400, what happens? I will show you. 14,000 my fixed overheads divided by actual production 400. Tell me. 35. That means my absorbed fixed overhead recovery rate is 35. How many units I produced? 400 into 35. Each unit how much cost will absorb? So total 14,000 was absorbed into inventory cost, production cost. That means you see on one hand you have inefficiency, on the other hand you are showing more asset value. Suppose instead of 11,200 if I absorbed 14,000 to inventory cost, how much excess I am transferring to inventory cost? Tell me. 2,800. That means asset value I am increasing now. That means your weakness you are showing as an asset. That's why standard says no, we don't allow it. That's why whichever is higher. If you take whichever is lower, what happens is your abnormal loss is also included in the inventory cost, which is not allowed by AS2. So that's why fixed overheads are always absorbed based on which base, sir? Actual, normal. Whichever is higher. If you take whichever is higher, automatically abnormal loss is eliminated. Unabsorbed will be eliminated and that will be transferred to P&L account. Sorry, you understood? This is very, very important. Okay. So therefore, when it comes to cost of inventory, sir, cost of conversion we have seen. Now other costs, sir, important. Other cost. Sir, when you are calculating the inventory cost, other cost is also there. These other costs are what? Other costs which are incurred to bring the inventory to its present location and condition. Like for example, any design cost. For example, in order to manufacture any particular item, some design need to be done. For that, some cost is incurred. That design cost is necessary to bring the inventory to its present location and condition. Therefore, design cost is also included as a part of cost of inventory. Cost of purchase, cost of conversion. Next, other cost. In other cost, which cost I need to include? Any cost which is necessary to bring the inventory to its location and condition. To bring the inventory to its present location and condition, what are all the costs I am incurring? Next, borrowing cost, important. So I will talk about borrowing cost later. Amortization of intangible assets. Amortization means depreciation, nothing but. For intangible assets, we will call it as what? Amortization. For example, any patent is there, patent, copyrights. By using these patents, you are manufacturing inventory. Therefore, on these patents, whatever the depreciation generated, that is also absorbed into the inventory cost. Normally not, if it is related to production, example, patent for manufacturing, copyrights for publisher, it may be included. Any exchange differences, please don't include it as a part of inventory cost. So therefore, when you are calculating the cost of inventory, sir, any cost you incurred to bring the inventory to its present location and condition, please include it. Now the most important is exclusions. Standard has given some exclusions, sir. Standard has given some exclusions. Definitely they are going to test this, or in the question also there is a chance that this will be tested. Listen, the standard says some cost should not be considered as a part of cost of inventory. First one is what you know already, abnormal loss. any abnormal loss, whether it is material or labor or other production cost, doesn't matter. Abnormal loss is always charged to P&L account. It will not be included as a part of inventory. I told you the logic. Why? If you include loss as your inventory, that means you are showing your weakness as asset. That is prohibited. On one hand, you are incurring loss. On the other hand, you are showing it as an asset. Is it allowed? No. That's why abnormal loss straight away rejected. It will not go to inventory cost. It will go to P&L account as a normal expenses. Second, storage cost. Sir, any cost we incurred for storage of inventory, then generally it will not be included. But there is an exception. If storage is necessary to make the inventory to bring its present location and condition, if storage is necessary for further production, then storage cost will be included as a part of cost of inventories. And next one, administrative overheads. Generally, admin overheads will not be included in the inventory cost. Like for example, head office rent, accounts department salaries, no way connected with inventory na. So those cost, administration overheads will not be included. And last one, selling and distribution cost also not to be included. Selling and distribution cost. One more interesting point I told you, interest. Interest. Listen, sir, generally tell me, interest, will it be included as a part of inventory cost? Interest. Suppose you have taken a loan. On that loan, you are paying interest. That loan you are utilizing for manufacturing of goods, inventory. Whether interest you are paying on the loan, which is using for manufacturing of the goods, will it be added to inventory cost? The answer is depends on age 16, borrowing cost, which says if the asset is a qualifying asset, borrowing cost directly related to acquisition, construction, production of qualifying asset, then it will be capitalized. Otherwise, charged to P&L account. Therefore, if the inventory you are manufacturing is a qualifying asset, then interest cost will be included. Otherwise, interest cost will be charged to P&L. Should not include as a part of cost of inventory. So therefore, interest generally included or not included. When it included, if the inventory is a qualifying asset, then it will be included. Normally not included, except for inventory that takes a long time to be ready. That means it's a qualifying asset. If it's a qualifying asset, then include as per AS 16. As per AS 16. So you understand? So cost of purchase, cost of conversion, other cost. What cost we should exclude? Abnormal wastage of material, labor, storage cost. When storage cost will be included? If it is necessary for further production, then included. Next, admin, general admin overheads, we should not include. Then selling and distribution cost, we should not include. Interest, if the inventory is a qualifying asset, add. Otherwise, transfer to P&L account as a normal period cost. Next, there is one more concept called joint products and byproducts. What is this joint products, byproducts? Simple. Listen. Sir, through common production process, for example, this is the production process, we generated two products. Okay, two products we generated. Suppose two products A, B, both are having a significant market value, both are having significant sale value. These are called joint products. So through common production process, if two or more products of equal significance, some significance value is there in the market generated, now those are called joint products. Suppose up to one point of time you are incurring cost, right? This is called processing cost or production cost. Till now you incurred some cost. For example, till now you incurred 20 lakhs. Now two products generated. Now the standard says whatever the common cost you incurred, na, this will be split between these two joint products. In order to determine the cost of these two products, how to determine the cost? Simple. These 20 lakhs split between the joint products. On what basis? Based on the sale value at a split off point. This is called split off point. Split off point. Yet this split off point, whatever the sale value is there, based on the sale value, this 20 lakhs will be allocated between A and B, if they are joint products. Sometimes what happens na, byproduct will be generated. What is byproduct? It does not have significant value in the market. Does not have significant value in the market. In case of byproduct, what we need to do is, we need to see the scrap value. If I sold this byproduct in the market, how much I am going to get? Waste, scrap value. That scrap value I need to reduce from the process cost. Remaining cost is the cost of the main product. For example, 20 lakhs is my process cost, total cost. I generated two products, A, B. In this B is, for example, byproduct, which is a waste. So this waste I sold, I got 1 lakh rupee. So the standard says from this 20 reduce 1 lakh. So 19 lakhs will be the cost of product A, main product. So therefore, in case of joint products, what you do, tell me? Common cost will be allocated between the joint products based on what value? Sale value at split off point. Sometimes what happens now? These joint products further processed and sold. Further processed and sold. Then take the sale value after further processing as the base to allocate this 20 lakhs between the joint products. Depending upon the information given in the question, you need to see. Generally, it is the sale value at the split off point. At what point of time these two products separated? At that point of time, if I sold them, what will be the sale value I am getting? Based on the sale value, this process cost, common cost will be allocated between the joint products. If it is a byproduct means does not have any significant value in the market, just it will be sold as a scrap. Whatever the scrap amount you are getting now, you need to reduce from process cost, total common cost. Everybody, remaining cost will be the cost of the main product. Cost of the main product. That is what they have given, sir. See this. See, cost up to split off point should be allocated using reasonable and consistent basis. This basis allocation may be sale value at split off, or at sale value after further processing. In case of byproduct, they are valued at NRV, and the main product cost is nothing but joint cost minus NRV of the byproduct. So therefore the conclusion is what? Tell me conversion cost. Labor, factory overheads. If it is a labor overheads, fixed. Tell me, how will you allocate fixed overheads? Normal or actual, whichever is variable? Actual production. In case of joint cost, main products, joint products generated. The common cost, joint cost is allocated based on sale value. Either sale value at separation or sale value at completion. If it is a byproduct, simple. This NRV is deducted from the cost of main products or joint products. Next, there is cost formulas. What is this cost formulas, sir? Very simple. Sir, when you are valuing the inventories, you need to determine cost, no, sir? To determine cost, there are some formulas they have given, sir. Listen. Here they are saying whether the inventory items are interchangeable or not. What is interchangeable? Ordinarily interchangeable means large quantities we are producing the same items. They are called ordinarily interchangeable. For example, there is a company which is manufacturing calculators. What is this calculators? Number of items, similar items they are manufacturing, right? They are ordinarily interchangeable. Hello. Or for example, you are a company which is manufacturing biscuits. Biscuits manufactured in large quantities, same, interchangeable, right? Now when you are manufacturing items in large quantities which are ordinarily interchangeable, then how you are going to find out the cost? There are two techniques they are saying, that is follow LIFO method or weighted average cost method. LIFO or weighted average, sorry, FIFO or weighted average. LIFO not allowed, not suggested by S2. Why? Because last in first out. That means latest stock you sold. That means in the closing stock, old stock will be there. Old stock is reflecting at old price. They are not reflecting current market prices. That's why LIFO is not suggested. Which method is suggested? FIFO. In FIFO, what we do? First in, first out. Whatever the stock first came, we assume it is sold. That means at the end, closing stock is having latest value, latest stock in FIFO. So therefore, the value of the closing stock is reflecting the current market value. That's why FIFO is suggested, or weighted average cost method is suggested. So FIFO or weighted average cost method is suggested for which kind of inventory? Inventories which are interchangeable. That means small items in large quantities. Similar items you will manufacture. For example, medicines. When you are manufacturing medicines, you will manufacture in batches, large quantities. Na? They are ordinarily interchangeable. Therefore, the cost will be determined either by FIFO or weighted average cost method. Sometimes the items are not ordinarily interchangeable. Then you follow specific identification cost method. What is that? Specific identification cost method. For example, you are manufacturing luxury cars. You are a company, Rolls Royals. How many cars they will manufacture? At a time, 1000. They will manufacture only one or two. One they will manufacture. Correct? Luxury car. Now in that case, they can determine the cost of that item separately. That's why specific identification method. Or for example, any high value jewelry. Exclusively you are manufacturing one jewelry. Only for Mukesh Ambani, for example, in his family. For his daughter, he is making one jewelry, exclusive jewelry. He is given an order. Only for him the jewelry is made. So company point of view, the jewelry shop point of view, it is not ordinarily interchangeable. So how they will determine the cost? Specific identification cost method. Gold necklace, all these things. So therefore this is one formula, sir. So you understand the formulas? So tell me how to determine the cost formula. Inventory is interchangeable or not? If not interchangeable, specific identification. Ordinarily interchangeable, before weighted average you will use to determine the cost of inventories. Apart from this, they have given some more other techniques like standard cost method. Standard cost, will determine the standard cost of a product. So based on that standard cost, will determine the cost of the product. For example, I am a Dell company. I am manufacturing computers. To manufacture one computer, what is my standard cost? Closing stock into standard cost. I will get the cost value of the inventory. This is important. Retail method. Retail method. This is also one formula they have given to determine the cost of inventories. Retail method. See, generally this retail method is used by whom? Those businesses who are engaged in large number of rapidly changing items. For example, D-Mart, all these companies you see, they are dealing in large quantities, similar items, rapidly changing items. How they will determine the cost? Very difficult, na? That's why they said sale price minus margin. From the sale price, if you reduce the margin, automatically you will get what? Cost. For example, sale value is 10 rupees. Margin is 2 rupees. So cost is 8 rupees. That's it. 8 rupees is the cost into closing stock quantity. You will get the closing stock value. So therefore, used for businesses with a large number of rapidly changing items. Retailers usually have consistent gross margin. See, this is applicable for whom? Retailers, not for manufacturers. So the inventory cost is sales minus margin. Sales minus margin. That's it. So these are the formulas they have given, sir. And you know how to determine NRV? Sir, we need to compare cost with what? NRV. How to determine NRV? NRV is nothing but what is the estimated selling price minus what is the estimated selling cost in order to make the sale. But how to determine NRV of a work in progress? See, there are, we know in case of work in progress, finished goods. Two things are there. Work in progress as well as finished goods. See this. Generally, how NRV will be decided? See this. Estimated sale price minus what is the cost I am going to incur to make the sales. Then you will get NRV. Nothing but selling cost. For example, my estimated selling price 100 rupees. To make the sales, the cost is 10. So therefore, NRV is 90. But this is applicable for finished goods. But what about work in progress? Because work in progress does not have estimated sale value. Why? Because work in progress cannot be sold directly in the market. Na? Can anybody will purchase semi-finished goods? For example, this calculator is a finished good. It will have a market value. But for example, this calculator is not yet finished. Is it having a market value? No. Therefore, how to determine the NRV of this semi-finished goods? Work in progress, nothing but how to determine? Simple. First to take the sale price of the finished goods. From the two things you need to reduce. One is what is the further cost I need to incur to convert this work in progress to finished goods. Still this has to become finished good, right? What is the cost I am going to incur to complete this product? Minus it. And also what is the selling cost I am going to incur to make the sale? Deduct it. Then you will get the NRV. So how to determine the NRV of the work in progress? First to take the sale price of finished good. From that you need to reduce two things. What is cost of completion minus estimated cost of sales. You need to reduce. You will get the NRV of the this one. Okay. And one more important point, sir. Then disclosures. Okay, disclosures not important. Now here I forgot to this one, scope of the standard, important. They may ask a question. Scope. What is scope of the standard says? Whether AS2 is applicable to all type of inventories? The answer is no. This standard says we are not applicable for construction business, construction contracts. So any constructions under work in progress, any directly related services which is covered in AS7. So therefore AS2 is not applicable. Similarly, if I am a service provider, if I am providing any services in the ordinary course of business, for me AS2 is not applicable. For example, I am a chartered accountant. I entered a contract of service with one firm to provide the services. Whether AS2 is applicable for my services, work in progress in the ordinary course of the business of service provider, the answer is no. You cannot apply AS2 for service providers. And also any shares, debentures, other financial instruments held as stock in trade. For example, I am having any shares, debentures as a stock in trader, stock in trade. So I will purchase and sell shares, debentures, all these things. So for me AS13 is there. So therefore AS2 is not applicable. And last one, the most important one is any producer's inventories of livestock, agriculture, forest products, minerals to the measured at what value? NRV, based on industrial practice. So they will ask a question. Suppose if you are a manufacturer of livestock, I mean producer of livestock, agriculture products, forest products, minerals. Generally, these items are valued at what value? NRV. Therefore, AS2 is not applicable. Because basic principle of AS2 is what? Cost compared with NRV, whichever is lower. But these industries, generally they will value the inventory at NRV. Therefore, the AS2 is not applicable. But suppose in the question, if they have given that these industries are not following NRV, then you should apply AS2. So 4 exceptions are there, sir. Can you tell me what are the 4 exceptions? Work in progress for the construction businesses, work in progress for service providers, and any shares, debentures held as stock in trade, and last one is any producers inventories of livestock, agriculture, forest products, minerals to the extent they are measured at NRV. That is also not covered under this standard. That's it, sir. The discussion of the standard is over. Now let us see the questions. Yeah, come to questions of AS2. Simple questions these are. First question you can manage, second question also you can manage, third we'll discuss, fourth one you see, you are required to value the inventory per kg of finished good. Material cost 200 per kg, labor 40 per kg, variable overheads direct 20. Fixed production charges on normal working capacity of 2 lakh kgs is how much? 20 lakhs. 4,000 kgs of finished goods are in stock at the end of the year. That means closing stock is 4,000 kgs. So can you tell me here what will be the fixed overhead cost per kg? Simple. What is the fixed overheads total? Divided by normal capacity 2 lakhs. So 20 lakhs divided by 2 lakhs, 10 per kg. So 200, 40, 20, 10. So total 270. 270 is the cost per kg. Into how many kgs? 4,000. So 4,000 into 270. This is the value of inventory. 10 lakhs 80,000. So fixed overheads are allocated based on actual or normal, whichever is higher. Normal given, actual not given. So that will be taken. Next. This question important, sir. See the 6th question, everybody. Capital Cables Limited has a normal wastage of how much? Normal wastage. See, there are 2 types of wastage, normal, abnormal. Abnormal loss will be charged to P&L, but normal loss will be included in the inventory cost. It will not be charged, it will be included in the inventory cost. Hello? See this. During the year 11-12, the company used 12,000 metric tons of raw material costing 150 per MT. That means what is the total cost of materials used? 12,000 into 150, 18 lakhs. So this is the total cost. Everybody. Next. At the end of the year, 630 MT of wastage was in stock. So total wastage 630. So in these 2 types of wastage will be there. Normal, abnormal. What is normal? 4%. 12,000 into 4% you do. 480 is the normal wastage, metric tons. So total 630. In that 480 if you minus, 150 is what, sir? Abnormal wastage. 150 is the abnormal wastage. You see, next. The accountant wants to know how this wastage be treated in the books. Explain in the context of AS2 the treatment of normal loss and abnormal loss. Also find out the amount of abnormal loss, if any. Simple. Sir, here you need to think, sir. Everybody. What is the total cost you spend on the material? 18 lakhs. Okay. What is the normal quantity? Normal quantity. Normal quantity means 12,000 empty na. In this normal loss is how much? 480. So reduce 11,000. 11,520 empty. So this 18 lakhs is divided with this 11,520. Then you will get cost per empty. How much? 18 lakhs divided by 11,520. How much, sir? 156.25. This is the cost per empty. 156.25. That means indirectly what I have done now, the normal loss also I have included. Normal loss is basically 480 na. This 480 I have deducted it. That means this same 18 lakhs cost I averaged it for 11,520 units. That means the normal loss also I have included in the remaining good stock. Remaining stock. In that remaining stock, abnormal is also there. Hello. First you understood. Total 18 lakhs cost you understood. Divided by normal quantity. Normal quantity means after normal loss. It will be 11,520. So what is the cost per empty? 156.25. Now suppose if I want abnormal loss, what I will do? 150 empty into 156.25. How much? Say this 23,437.5. This is abnormal loss. Where it will go? P&L account. See this 23,437.5 will be charged to P&L account. Everybody. And how much is the total cost of materials consumed during the year? How much is the total cost of material consumed during the year? See this materials used 18 lakhs na. In that 11,520 units cost, 11,520 into 156.25. How much came? 11,520 into 156.25. How much? 18 lakhs. 18 lakhs. Hello. So net quantity is this much. Abnormal loss is this much. This abnormal loss will be transferred to P&L account. Okay. Now see the question number 7, sir. Important question this is also. Mr. Mehul gives the following information relating to items which are formed part of inventory. As on 31st March 2011, his factory produces product X using raw material A. So raw material A, product X. Product X is finished good, raw material A is there. First they are giving about raw material. 600 units of raw material A purchased at 120. Replacement cost of raw material A is 90 per unit. Sir, I told you raw material valuation depends upon finished goods valuation. Now immediately come to finished goods valuation. See this 1500 units of finished goods of product X. Total cost incurred 320. Expected selling price 300. I told you if the finished good is expected to sold yet or above cost, then raw material is valued at cost only. If the expected selling price of the finished goods is below cost, then raw material is valued at cost or replacement cost, whichever is lower. Now see here, what is the expected selling price? 300, which is below the cost. Which is below the cost. Therefore, raw material is valued at cost or replacement cost, whichever is lower. What is the cost? 120. Replacement cost 90. Whichever is lower means 90 into 600 units. How much? 50. That is raw material value. 54,000. Now come to finished goods valuation. Finished goods valuation 1500 into cost or NRV, whichever is lower means NRV. How much? 1500 into 300. 4,50,000. Now come to work in progress. 500 units of partly finished goods in the process of producing X and cost incurred till date is how much? 260. These units can be finished next year by incurring additional cost of 60. So therefore cost NRV whichever is lower. In order to calculate NRV, first I need to take what? Selling price of the finished good. What is the selling price of the finished goods? 300. Correct? 300 minus what is the additional cost I'm going to incur? 60. Any additional selling expenses? No. 240 is the NRV. What is the cost I incurred so far? 260. 260, 240, whichever is lower means 240. So therefore finished goods are valued at 240. Say this 240, 1,20,000. Because finished work in progress valuation, NRV, how you are going to find out it? First take the selling price of the finished goods. From that additional cost to be incurred to complete the work in progress for product, then you will get the NRV. Compare with the cost. Okay. Next. This question you see, sir. Question number 1, important question this is. An enterprise ordered 20,000 kg of certain material at 110 per unit. The purchase price includes GST of 12 per kg, in respect of which full ITC is available. I told you, sir, whenever you are determining the cost of inventory, any refundable taxes is there, we need to deduct it. So in this 110, how much GST is there? 12, which is refundable. So therefore total purchase price 20,000 kgs into 120, 22 lakhs. From that ITC they deducted, see this. How much? 12 per kg into 20,000 kg. So 2,40,000 we need to deduct. Everybody. Next. Freight incurred how much? 1,17,600. Add 1,17,600. Normal transit loss is 2%. Normal transit loss is 2%. That means 20,000 kg into 2%. How much, sir? Normal loss? 400 is the normal loss. But you see here, the enterprise received 19,500. That means abnormal loss is 100 kg. Actually 20,000 minus normal loss means 19,600. But we received 19,500. That means 100 kg is abnormal loss. And we consumed how much? 18,000 kg. That means closing stock 1,500 kgs. Closing stock is 1,500. Sir, simple sir. 20,000 kgs purchased. Normal loss 400. 19,600. But we received 500. That means 100 kgs abnormal loss. How much we consumed? 18,000. That means how much stock is there in closing stock? 1,500 kgs. What they are asking? Calculate the cost of material per case. Allocation of material cost. So therefore what is the total cost incurred? This one 20,77,600 divided by normal quantity. What is the normal quantity? 19,600. 19,600. 20,000 kgs minus normal loss. 19,600. So what is the cost per kg? 106. Now find out each one. Abnormal loss 100 kg into 106, 10,600, which will go to P&L account. How much material you consumed? 18,000 kgs into 106, 19 lakhs 8,000. And closing stock 1,500 kgs into 106, 1,59,000. Abnormal losses are recognized as a separate expenses. Okay. This question, sir. This is also there in the study material as well as RTP. Now, there is a company Alpha Limited, sir. They are selling flavored milk to customers. Some of the customers consume the milk in the shop run by Alpha Limited. While leaving the shop, the consumer leave the empty bottles in the shop and the company take possession of these empty bottles. The company has laid down a detailed internal record procedure for accounting of these empty bottles, which are sold by the company by calling tenders. Keeping this in view, decide whether the inventory of the empty bottles is an asset. Sir, you understand? For example, there is a company, sir, they are selling, for example, badam milk. Badam milk is sold in glass bottles, right? Suppose you went to a shop, you consumed. What do? You will bring glass also with you. That bottle also will you bring? No, we will leave there only. Now what this company is doing is, all these empty bottles they are collecting. They are maintaining a detailed record. And they are calling tenders and selling them. Previously there was a bar example. For example, there is a bar and restaurant. I mean, customers will go to the bar and they will consume the beer. The beer bottles they will left. What that company will do? They will collect these beer bottles and they will sell it. Now the question is same here. Now they are asking whether the inventory of empty bottles is an asset. First of all, is this empty bottles which is left by the customer, is it an asset? Is it an asset for the company? What is asset basically? Asset is a resource which gives future economic benefits. Correct? Definitely these bottles left by the consumer, you are selling it now. So you are maintaining detailed record and you are calling tender and you are selling them. That means definitely some expected benefits are there, future economic benefits. So they will definitely become assets. First question answer over. Next. If so, whether inventory of empty bottles existing on the date of balance sheet is to be considered as inventories of the company. Now whether these empty bottles is an asset, will you consider them as inventories and valued as per S2, or will you treat it as a scrap and shown at net realizable value with corresponding credit to other income? Tell me, these empty bottles, will you treat it as inventories or will you treat them as scrap value? Scrap or inventories? No sir, they have clarified that this is inventory. Because what is inventory? Inventories are assets held for sale in the ordinary course of the business. Sir, this company collecting all these empty bottles, they are maintaining a detailed internal control records and they are selling them regularly by calling tenders. That means they kept these bottles for sale in the ordinary course of the business. Therefore, definitely we need to consider them as what? Inventories. They are assets and at the same time they will be inventories. But sir, how inventories will be measured? Cost or NR, whichever is lower. Then what is the cost here? The cost is nothing but what is the cost we are incurring to maintain internal records? Tenders we are calling, what are the cost we are incurring for calling the tenders? These are the cost. NRV means how much amount we are going to get when you sell them. So this is how these empty bottles will be valued. This is important, sir, because most of the students thinking that this is not inventory. Actually, they have given the answer that this is a inventory. See this, actually, Alpha Limited sells empty bottles by calling tenders. It means further benefits are accrued. Therefore, empty bottles are assets. As per AS2, inventories or assets held for sale in the ordinary course of the business. Inventory of empty bottles existed on balance sheet is inventory, and Alpha Limited has detailed controlled record and accounting procedure which duly signifying its materiality. Thus, inventory of empty bottles cannot be considered as scrap and it should be valued as inventory. Mark it as important. It is there in study material also, this question. So here in this case the empty bottles are assets as well as inventory. Assets as well as inventory. Okay. This question you see important. Illustration, question number 10, sir. RTP May 2025 attempt. RTP May 2025 attempt, sir. They have given you raw material, sir. I need to acquire closing inventory. They have given raw material as well as finished goods. Look at the raw material closing. How many units are there? 700. Cost price including GST how much? 280. ITC available 25. We need to deduct. Freight 35. Handling charges 20. Replacement cost also given. Because raw material valuation depends upon the finished goods valuation. Now when it comes to finished goods, how many units are there? 1800. Material consumed given 280. Labor 80. Overheads 40. Direct overheads these are. Fixed overheads how much given? 360. Normal capacity 36. Actual production 30. Whichever is higher. So therefore fixed overheads 360 divided by 36. 10 rupees. So therefore what is the cost per unit of the finished good? 280 plus 80 plus 40 plus 10. Total finished goods, sir. 280 plus 80 plus 10 plus 40. How much? 410. This is the cost of what? Finished good. Sir, very simple, sir. Metal consumed per kg given, labor cost given, variable overheads given, fixed overheads you need to allocate per kg. Actual or normal, whichever is higher. How much came? 410. Whenever in the question, sir, both raw material finished goods given, sir, first you compute finished goods. Because finished raw material valuation depends upon the finished goods valuation. So here finished good cost is how much? 410. Cost per unit 410. See here in this question, calculate the closing stock when the NRV of the finished goods is 500. Suppose tell me, sir, your cost is 410, NRV is 500. That means finished goods are expected to sold above cost. When above cost, then raw material is valued at cost only. Therefore, what is the cost of raw material? Simple. Cost price including GST 280 minus ITC available 25 plus freight 35 plus handling charges 20. 310 is the cost per unit. So therefore raw material is valued at 310. 310 into 700 units. Hello? So raw material cost per unit is 310. Since finished goods are valued, expected sale value is above the cost, raw material is valued at cost. So in the first case, what is the answer, sir? When the NRV of the finished good is 500 per unit, raw material is valued at cost. And finished goods are also valued at cost because NRV, I mean selling price is more than cost in case of finished goods. So that this is the closing value of inventory. Suppose, sir, second bit you see, when the NRV of the finished good is 380 per unit, what is the cost? 410. NRV 380. Hello? Now see, the expected sale price of the finished goods is below the cost. When it is below the cost, raw material is valued at cost or replacement cost, whichever is lower. Whichever is lower. What is the cost of raw material? 310. What is the replacement cost? 200. Whichever is lower means 200. So therefore, in the second case, the raw material is valued at 200 per unit. So therefore, 1,40,000 is the value. Replacement cost we need to take. And finished goods with valued at net realizable value, because which is less than the cost. Sir, very simple, sir. Finished goods expected to sold at what value you see? In the first case, the finished goods are expected to sold at 500, which is more than the cost. Na? What is the cost of the finished good? 410. What is the expected NRV? So therefore, obviously raw material is valued at cost. So take the cost into quantity, you will get closing stock value. Second case is what? NRV given at 380. Finished good NRV 380. Cost 410. That means expected sale value is below the cost. I told you when the finished goods expected sale value is below the cost, raw material is valued at cost or replacement cost, whichever is. Replacement cost how much given? 200. Cost 310. Whichever is lower means 200. That is what I have taken. See this 200. Hello. Next. This question, sir. Question number 12. This question is asked in September 2025 attempt. Very good question actually. This question, you see. Suppose in this question also there are two goods, finished goods, raw material. Finished goods is MP, raw material is RP. They have given the following information. Opening inventory of both given, finished goods, raw material. MP is what? Finished goods. RP is what? Raw material given. Purchase of RP, raw material given, labor given, overheads given, fixed. Sales given. Sales means what? Finished goods. We will sell finished goods, not raw material. Raw material is used in production. Closing inventory given. MP means finished goods. RP means raw material. Now what they are asking? The expected production is 45,000. Sir, actual production we don't know, but the expected production how much, sir? 45. Due to fall in market demand, the sale price of the MP was 22 per unit. That means finished goods sale value is 22. Replacement cost of RP was 11.5 per unit on the closing day. You are required to calculate the value of closing stock of MP and RP. So you need to calculate the closing stock of MP as well as RP. First, what you decide? Finished goods. Finished good is what? MP. You need to determine the cost of MP. How to get the cost? Here, labor cost we know. Overheads fixed. But how fixed overheads are allocated? Actual or normal, whichever is higher. So 45,000 expected given, but actual we don't know. We need to find out how many units actually we produced. Okay. So therefore, raw material how much consumed during there we don't know. We need to find out. Raw material consumption. Sir, see, simple, sir. If I want finished good cost per unit, what I need to do? I need to consider direct material, direct labor, overheads. These three I should add. Na? Direct labor available, overheads available, materials not available. I need to see how much material I consume during there. Generally I consume what? Raw material. How to find out raw material consumption here? Opening plus purchases minus closing. Automatically consumption will get. So see this. Raw material opening is there 4,400. During their purchase is there 40. Minus closing is there 4,000. So find out. So say this raw material movement opening plus purchases minus closing. So you will get 40,400. This is what, sir? Raw material consumed. Raw material consumption. But how many units of finished goods we produced? We need to find out the ratio. For example, finished goods, you see, what is the opening stock of finished goods? 4,000. Sales 40,200. Closing given. So how to find out how many finished goods you produced? Sales plus closing minus opening. In respect of the finished goods, you need to find out how many units you produced. How to get produced? Sales plus closing minus opening. What is sales here? 40,200 plus closing stock 4,200 minus opening 4,000. How much, sir? 40,400. See this 1:1 ratio. That means for each unit of the finished good, 1 unit of raw material is consumed. Sir, here finished goods, I need to find out how many finished goods I produced. Why I need to find out actual production? Because fixed overheads I need to allocate na. In order to allocate fixed overheads, I need two things. What are those? Actual, normal. Normal they have given. Actual I don't know. How to find out actual finished goods produced? Sales plus closing minus opening. That is what they have done here. Say this. Then you will get 40,400. Now tell me, to produce finished goods, I want what? Raw material. How much raw material you consume during the year? Opening plus purchases minus closing. So for consumption of raw material, this is the formula. Opening plus purchases minus closing. For finding how many units you produce finished goods, the formula is sales plus closing minus opening. So if you find out the same came 40,400, 40,400. That means 1:1 ratio. That means for 1 unit of RP is used for 1 unit of MP. Okay. And also I can find out the cost per unit, purchase price of raw material. Because here they have given a 4,80,000 divided by 40,000. What is the cost per unit? Say this, opening value 52,800 plus purchases 4,80,000. Total 5,32,800 divided by 44,400. Then I will get 12 per unit. Raw material, sir. Raw material opening stock 52,800 is there na? For 4,400 unit. During there we purchased 4,80,000 na? For 40,000. Therefore find out average price, average purchase price. Hello, average purchase price is how much came? 12. Now I can easily find out the cost. Cost of material consumed. I consumed 40,400 materials. Each cost is 12 per kg. Labor cost they have given. How much? 3,23,200 given. Fixed overheads, now you see 3,15,000 is their fixed overhead. Expected 45. Actual production 40,400. So whichever is higher. So therefore 3,15,000 divided by 45,000. Ayya, what is the fixed overheads? Ayya, 3,15,000. Actual or normal, whichever is higher. Actual production 40,400. Normal production 40. Whichever is higher means 45. So tell me fixed overhead recovery rate. 3,15,000 divided by 45. How much? 7 rupees. Into actual production. That means 2,82,800 will be absorbed. Remaining P&L account. Remaining unabsorbed fixed overheads will go to P&L account. So I get total cost of production 10,90,800 for 40,400 units. So 10,90,800 divided by 40,400. 27 is the cost per kg. Finished goods. Into, compare net realizable value. Net realizable value, how much given, sir? See this, the sale price of the finished good is 22. Compare whichever is lower. That means finished goods sale value is expected to below cost. Cost is 27, sale value is 22. Therefore raw material is valued at cost or replacement cost, whichever is lower. Now when it comes to raw material, what is the cost of the raw material? See this, as NRV of the finished good is less than the cost, relevant raw material will be valued at replacement cost. What is the replacement cost, sir? 11.5. Cost is 12 rupees. Raw material cost per unit is 12. Replacement cost is 11.5. Whichever is lower means 11.5. Therefore, the value of the closing inventory is 4,200 units available at the end. Okay. 4,200. Given now for closing stock. 4,200 into 22. In case of finished good. Raw material 4,000 into 11.5. This is how the inventory value is determined. So this question they asked for 5 marks. I was surprised because this is so complicated. Students thought it is a complicated thing, but you need to understand. So what is the specialty of this question? Can you tell me? In this question, first thing is they have not mentioned the material consumption cost. How much materials you consumed, not given. We need to find out material consumption. How to find out material consumption? Opening plus purchases minus closing, you will get consumption. And also you need one thing. What is that? How many units you produced. Why you need how many units you produced? Because fixed overheads will be allocated based on actual or normal, whichever is higher. I know normal, but I don't know actual. So for that I need to find out actual production. How to find out actual production? Sales plus closing minus opening. So if I see the ratio, 1:1. Therefore, whatever the material consumed entirely absorbed into the finished goods production cost. So material consumed, labor cost, overheads cost. Overhead cost when you allocate na actual or normal, whichever is higher you take. So automatically you got the cost. Compare with the NRV. Here finished good NRV is less than the cost. Therefore raw material is valued at replacement cost or cost whichever is lower. Here replacement cost is lower than the cost. That's why raw material is valued at a replacement cost. That's it, sir. This is one question. So remaining question you see sir, important one I have solved it, sir. So this is accounting standard 2. And one more question, sir. This one RTP January 26, one question given. See this recent RTP question. This question, there is a private limited company. They are manufacturing fancy terry towels. Towels they are manufacturing. And valued its closing inventory of inventories of finished goods at what value? Realizable value. They are valuing their inventory at NRV, inclusive of profit and the export cash incentives. Okay, because they are exporting these towels to foreign countries. So when you export, you are going to get some benefits in export incentives. They are including them also. Okay. Firm contract had been received and goods are packed for export. But the ownership of these goods not yet been transferred to the foreign buyers. We have received a foreign contract, sir, to export these goods, but we have not exported it. So still goods are there with us only. Now comment on the valuation of inventories. Now tell me, what is your comment on the valuation of inventory? Sir, this company is manufacturing what? Fancy terry towels. Is it an agriculture product? Because see, towels generally is made from the cotton. Cotton is an agriculture product. Cotton seeds, sir. Cotton seeds is an agriculture product. So the standard says in case of producers inventory, I told you in scope last one, producers inventories of livestock, agriculture, forest products, to the extent they are valued at NRV, the standard is not applicable. But here they are manufacturing towels, which is not agriculture product. Sir, potato is an agriculture product. Potato chips, not an agriculture product. Cotton seeds is an agriculture product, but not towels. So therefore they are not agriculture product. Therefore they have to apply AS2. But they are not applying, which is wrong. So they need to apply AS2 and they need to compare what? Cost NRV. Whichever is lower they need to take. Everybody. One more thing. They are recognizing export incentives na, without exporting the goods. That is against accounting principles. You need to recognize them only when the export is happened. Export is happened. Income is certain to receive. Then only you need to recognize. See this. Terry towels do not fall into the category of agriculture crops or mineral ores. Accordingly, taking into account the facts stated, the closing inventory of the finished goods should have been valued at cost NRV, not at NRV. They may ask this question in exams because recent RTP question this is. Further, export incentives are recorded only in the year of export. Therefore, the policy adopted by the company for valuing its inventory of finished goods is not correct. So that's it, sir. So remaining questions you solve, sir. Hello? Remaining questions you solve. Simple questions only, remaining and all, just concept application questions. And some questions are just a repetition. Whatever the questions are there, they are just repeated. So in AS2, what is the main thing, sir? Raw material valuation. What is that? Raw material valuation. How raw material will be valued, sir? Based on finished goods valuation. If the finished goods are expected to sold below cost, raw material is valued at cost or whichever is lower. Otherwise, raw material generally valued at cost only. That's it. Okay, sir. The next accounting standard we are going to start is interim financial reporting. Sir, what is this interim financial reporting is all about? So let us see. See, generally, sir, we'll prepare financial statements once the year is completed, right? Once the year completed, for that completed year, we'll prepare financial statements, we'll prepare annual report. Suppose if you prepare financial statements for part of the year, that is called interim financial reports. So basically interim financial reporting means a report which consists of financial statements for the interim period. Interim period. What is interim period? A period which is less than 12 months, 1 year is called interim period. For example, you take there is a company A Limited, sir. Financial year 24-25. So 1/4/24 to 31st March 2025 is the year. Suppose relating to this, the first quarter, that is from 1st April to 30th June, suppose a company is preparing financial statements for the first quarter. So this is called interim financial report. A financial statement, a report which is containing the financial statements for the interim period. Interim period is here less than 1 year. Less than 1 year, sir. See this. Interim period is basically a period which is shorter than the full financial year. Okay. Now listen. Sir, AS 25 says, AS 25 is giving choice to the organization. Whenever you are preparing interim financial statements, either you can have complete set of financial statements or condensed set of financial statements. So when give a choice, sir, obviously companies will follow condensed set of financial statements. Complete set of financial statement means complete balance sheet, P&L, cash flow statement, notes to accounts. Condensed set of financial statement means condensed balance sheet, I mean summary of balance sheet, P&L, cash flow statement, selected, notes to accounts. See, sir, what is the form of interim financial statements, interim financial reporting? Suppose if you are preparing complete set of financial statement, if you selected to prepare complete set of financial statement, sir, the format should be similar to annual financial statements. How the companies will prepare annual financial statements, like regular financial statements, the same format we need to follow. But suppose if you are preparing condensed set of financial statements, then you need to show only the headings, subheadings, and key selected notes to accounts, and that too as per the recent annual financial statements. Recent annual financial statements, you take it from there, the headings, the subheadings, the key selected notes to accounts you have to show, sir. Okay. So interim financial reporting, complete set, condensed set. And complete set, what it contains: balance sheet, P&L, cash flow statement, notes to accounts. And form and content also explained, sir. If it is a complete set of financial statements, the format should be as per the latest annual financial statements. If you are preparing condensed financial statements, sir, it should consist only of what? Headings, subheadings of the most recent annual financial statements, and selected explanatory note is required. Any additional disclosures? Not required, but if the additional information is not presented, if it is misleading the users, then additional information is also to be disclosed. Included if their omission would make them interim financial statements misleading. What about EPS? So if the enterprise presents basic and diluted EPS in financial statements, annual financial statements, then it must also disclose basic and diluted EPS in the interim financial statements. And see, one important point, sir, if you read AS 25, it says this standard does not giving the list of companies which are required to prepare interim financial statements. This is not making mandatory for any company to prepare interim financial statements. But the standard is saying any company which they want to prepare financial statements for the interim period or interim financial statements basically, then they need to follow AS 25. So AS 25 does not mandate which enterprise must present interim financial reports, how frequently they need to prepare, how soon. This AS 25 will not say, but it says if enterprise chooses or required to present interim financial reporting, then it must follow AS 25. Suppose you are a company, you need to prepare financial statements for every quarter because you need to submit the financial statement to SEBI. Now that means you are preparing interim financial statements. So you need to follow AS 25. And the standard will prescribe the minimum content which is required to be included in the interim financial report. It will provide both principles for recognition and measurement. Okay. Now, the most important concepts in this standard is first the comparative periods. This one we will discuss, sir. Important. They may ask a question in study material also. One question is there relating to it. Sir, generally when you prepare financial statement, sir, along with the current year data, we will give previous year data for comparison. Correct? Generally when you prepare, when you see the schedule 3 format, current year end, previous year end, we'll compare. But in case of interim financial statements, it is little bit different. See, please see it carefully. Balance sheet you are presenting for interim period. Suppose, you are preparing interim financial statements for quarter 2 of financial year 24-25. Quarter 2 means it will start from July, end on September 2024. Correct? July to September. So therefore you will prepare balance sheet for 30th June 2024, 30th September 2024, second quarter ending. Now what will be the comparative period? The comparative period is recently completed financial year end. Recently completed financial year end. See this. End of the immediately preceding financial year. Current year is 24-25. Immediately preceding financial year 23-24. What is the end of 23-24, sir? 31st March 2024. So give this comparative information. So whenever you are preparing balance sheet for the interim period, so compare with the recently completed financial year. Hello? End of the immediately preceding financial year. Suppose next P&L account, sir. When you are preparing P&L account, current interim period and cumulative year to date. Current interim period, for which period you are preparing for P&L. Generally P&L account is prepared for the period. And cumulative also, year to date. Suppose for example, I am preparing here for 24-25 quarter 2 P&L account. So that means for July to September 2024. For this period I will prepare P&L. Na? At the same time cumulative also I need to prepare till now, April to September 2024. This is current year. Compare with the same previous year, this interim period, July to September 2023, April to September 2023. So compare interim period and year to date of the immediately preceding financial year. That means 4 columns will come. 4 columns. One is current period and another one is year to date. From beginning of the year to till the date. Previous year, same period, previous year, and previous year, year to date. 4 columns will come. Like that you need to compare. So current period. For example, in our example, what is the current period? July to September. Correct? July to September 2024. We'll compare it with July to September 2023. Next, April to September 2024 compared with April to September 2023. Like that. Okay. And the next one, balance cash flow statement. When you are preparing cash flow statement for the interim period, cumulative year to date for the current financial year compared with year to date of the immediately preceding financial year. Suppose in our example we are preparing for second quarter, right? July to September. Cumulative we need to prepare means April to September 2024. Compared with April to September 2023. So you understand this? So tell me, when you are preparing interim financial reports, what is the comparative periods? If it is balance sheet, we compare with what? Immediately preceding year end. That means here in this case, if I prepare interim financial reports for the second quarter, that is on 30th September 2024, I will prepare balance sheet now. These figures will be compared with 31st March figures of the previous year. Suppose if I am preparing P&L account, 2 things I need to prepare of the current year. One is for that interim period, year to date figure. Same for last year. Same for the last year. Now CFS, when you are preparing CFS, Year to date you need to prepare. That means if you are preparing financial statement for July to September, year starts from April. So April to September of the current year, April to September of the last year, previous year. You need to compare like this. So this comparative information. Now, sir, whenever you are preparing interim financial statements, what are the minimum disclosures to be made? Like when you are preparing condensed financial statements, what are the minimum disclosures we need to make in the notes to accounts? Accounting policies, which policies company is following, seasonal impact on operations. Generally, I told you this interim financial reporting main object is to focus on the unusual items, seasonal impact, because this is period for only part of the year. Therefore, in that period, in that interim period, what happened? What is the unusual events happened? What is the impact? So that will be disclosed in the notes to accounts. That, for example, a company usually earns 60% of revenue in October to December month. Now, because of the festival demand. So that is called seasonal effect. That has to be disclosed in the interim reports. Suppose if I am preparing interim financial statements for October to December, definitely I need to disclose this point in the notes to accounts that during October to December, because of the festival season, our sales will increase by 60%. Like that I need to disclose. And any unusual items happened in the organization. Unusual items, exceptional, extraordinary items, if anything happened now, we need to disclose in the notes to accounts. And any material changes in the estimations from previous period, any debt equity transactions like issue of shares, buyback, restructuring, dividends, segment reporting, change in comparative enterprise composition like mergers, acquisition, discontinuation. These are all the important things which has happened in the interim financial reporting. They must be disclosed in the notes to accounts when you are preparing interim financial statements. Any material changes in the contingent liabilities. Okay. Now the most important, see in this sir, in this standard, what are the questions they will ask in examinations? Till now, out of the discussed points, only this is the periods comparison question is possible. From this they can frame a question. You have to remember. So for which period we need to compare this one. This can be asked as a question. One. Second question is, mostly they will ask a question from these accounting policies. Last attempt also they have asked one question from this accounting policies only. So mostly they will ask a question from this accounting policies only. Very, very important. That too, in this accounting policies, I will tell you 2 or 3 points. Only those 2 or 3 points are important. So see this, one by one we will see this. This is the important thing. With this, the standard will be over. Next we will solve the questions. Sir, first of all, you understand the crux of the standard. What is basically interim financial reporting? Preparing financial statement for the interim period. What is interim period? Less than 1 year. Less than 1 year. Is this standard is saying for which enterprises this standard is applicable? No. The standard is saying that when you prepare interim financial statements, what are the minimum things you need to disclose? And the standard is giving 2 choices. What are those? Complete, condensed. So when you follow condensed, what you need to present? Headings, subheadings, selected explanatory notes. What are the selected explanatory notes? That's what I have given. This one. Hello. And also, when you prepare financial statements for the interim period, with which year statements you need to compare also I have given. Balance sheet, P&L account to cash flow statement. Comparison should be there. Because one of the important qualities the financial statement should have is comparability. I should be able to compare my figures with the previous year figures. That's why. Okay. Now, accounting policies is the most important area. There is a chance that a question may come in examination. Last attempt also one question asked, I will show you. So see this. First thing is, what are the accounting policies I need to follow? Accounting policies and measurement in interim financial statements. The first thing, sir, always you need to make sure that whenever you are recognizing any revenue cost in interim period, when you are preparing interim financial statements, no differing, no anticipation. Seasonal and or occasional revenue should not be anticipated or deferred. Should not be anticipated or deferred. Whatever expenses you incurred in that period, whatever the revenue you earned in that period, in that interim period, that is only recognized in the interim financial statements. No revenue, no expenses, no revenue should be anticipated or deferred. Should not be deferred. Deferred means postponement. For example, I earned a revenue of 10 crores in the first quarter. That's it. First quarter only I need to recognize. I cannot say these 10 crores I will recognize over a period of 4 quarters. No, this standard does not allow it. So therefore, first point you need to understand is, whenever you are preparing interim financial statements, sir, any seasonal or occasional revenue should not be anticipated or deferred. And second important point, sir, income tax expenses. How to recognize income tax expenses, sir? When you are recognizing income tax expenses for the interim in the interim financial statement, sir, it should be based on what? Annual effective tax rate. Important. Mark it as important. Annual effective tax rate. Which tax rate? Annual effective tax rate. Only that rate you need to consider for recognizing the tax expenses. Tax expenses. Okay. And you also need to understand that unevenly incurred costs should be recognized only if allowed at year end. Suppose if you are incurring any cost unevenly, even means equal, uneven means not equal. So if you are incurring any cost unevenly, sir, it will be allowed only if, it should be recognized only if it is allowed at the end of the year. This point also I will explain. Wait. Now first, relating to tax, sir, see this example everybody. Suppose there is a company, sir, has the following projected financial statements. Estimated annual profit before tax, how much, sir? 1 crore. PBT, profit before tax. Estimated annual tax expenses, 25 lakhs. So 25 lakhs is my estimated tax expenses. My estimated PBT is 1 crore. So therefore find out annual effective tax rate. Annual effective tax rate is nothing but total tax expenses divided by total profits, PBT. So tax expenses divided by PBT, that is 25%. That is nothing but 25 lakhs divided by 1 crore. So they will give you some questions. I will show you in study material. One question is there. In that question, they will tell you to recognize income tax expenses. How much you recognize? First, in order to recognize income tax expenses, you need to first calculate annual effective tax rate. How to find out annual effective tax rate? Total tax expenses divided by total, profit before tax. Total profit before tax. Then you will get one rate. Apply this rate. Now this is, see this. PBT every quarter, profit before tax. For example, first quarter PBT 20 lakhs. Second quarter 30, third quarter 25, fourth quarter 25. Now I need to find out tax expenses. Simple. Whatever the revenue of the first year PBT, apply 25%. See this. This 25% we ascertain now. Apply 25, 25, 25. So you will get what? Tax expenses. You will get what? Tax expenses. So this is how tax expenses will be recognized. So according to AS 25, sir, whenever you are preparing tax expenses, you are presenting tax expenses, it should be based on the annual effective tax rate. And one more important point I told, what? Any seasonal or occasional revenue, it should not be deferred, or it should not be anticipated. Should not be deferred, it should not be anticipated. For example, if company receive 5 crores royalty income in quarter 1, it should recognize in quarter 1 itself rather than spreading over it year. It should not spread it. Quarter 1 we received something, some income earned, that will be recognized in quarter 1 only. We should not defer it. Cost not meeting the asset criteria should not be deferred. For example, we incurred some cost. It is not meeting the asset criteria. That means, can I defer it? No, it should not be deferred. In which year you incurred? That year only you recognize. That year only should be recognized, sir. Okay. So now see this. Come to question bank, sir. I will show you some beautiful questions. Very easy in examination, sir. Very easy. See illustration number 2. Illustration number 2, you see. The accounting year of the X Limited ends on 30th September 2011 and it makes reports quarterly. However, quarterly means interim financial statements they are preparing. However, for the purpose of tax, year ends on 31st March every year. For the accounting year from 1st October 2010 to 30th September 2021, the quarterly income is as under. So see this. 1st October 2010 to 30th September 2011, the quarterly income given, sir. Sir, this company is following 1st October to 30th September. This is their year. Correct? Their year ends on 30th September. That means they 1st October of this year to 30th September of the next year. That is the year they are following. Their quarterly income given. See this. Every quarter, this is the income. 200, 200, 200. What they're asking, average actual tax rate for the financial year ending 31st March 2011 is how much, sir? 20%. And for the financial year ending 31st March 2020, it is how much? 30%. Calculate tax expenses for each year. So now you need to calculate tax expenses for each year. How much is the tax expenses for each year? How much is the tax expenses for each year? See this, here important thing, sir. Your average actual tax rate for the financial year ending 31st March 2011 is how much, sir? 20%. That means from 1st April 2010 to 31st March 2011, the tax rate is 20%. Correct? And for financial year ending 31st March 2012, 30%. That means 1st April 2011 to 31st March 2012. How much, sir? 30%. This is the tax rate. Now you see, this first quarter belongs to which year? So see this, for example, first quarter ending on 31st December 2010. 1st September to 31st December 2010, sir. In 2010, what is the tax rate, sir? See this, 20%. Hello? This will fall this year. 20% you apply. See this, 20%. So tax expense is 40 lakhs. I told you, no, whenever you are recognizing tax expenses, you should follow the average annual tax rate. Here they have given average annual tax. Now second quarter, 31st March. That means January to 31st March 2011. So up to 31st March 2011, the tax rate is 20%. So apply 20%. Correct? So second quarter income 200 lakhs on the 20%. Now come to third quarter. 1st April 2011 to 30th June 2011. 1st April 2011 onwards, what is the tax rate? 30%. So apply 30%. 60 lakhs. So this one also 30%, 60 lakhs. So every year this is the tax rate we need to apply. Very simple question. Hey, you understood? Tax rate. This year, this quarter belongs to which year? You see, in that year, what is the tax rate? Apply it. Just. This is one question, sir. See this question, I told you, na? This question also there, theoretical question. Comparison period. This we explained. See this question, everybody. An enterprise reports quarterly estimates an annual income of how much? 10 lakhs. Assuming tax rates on first rupees 5 lakhs at 30% and the balance at 40%. The total estimated quarterly income 75,000, 2 lakh 50, 3 lakh 75, 3 lakhs. Calculate tax expenses to be recognized each quarter. Hello? Sir, an enterprise reports quarterly and estimates an annual income of how much, sir? 10 lakhs. What are the tax rates, sir? On first 5 lakhs, 30%. Balance, 40%. Their estimated total income is 10 lakhs, sir. Every quarter income also given 75, 2 lakh 50, 3 lakh 75, 3 lakhs. You need to calculate tax expenses. I told you how to calculate tax expenses. In order to calculate tax expenses, I want annual tax rate, annual effective tax rate. Correct? How to find out annual effective tax rate? Total tax expenses divided by total profit before tax. Correct? So total tax, how to find out, sir? On first 5 lakhs 30%, sir. So 5 lakhs into 30%. 1 lakh 50 and balance means 5 lakhs. Total income 10 lakhs. 5 lakhs into 40%. How much, sir? 2 lakhs. So total tax expenses 3 lakh 50,000. Divided by what is the total PBT? Total PBT 10 lakhs. You add everything 75, 2 lakh 50, 3 lakh 75, 3 lakhs. 10 lakhs. Correct? So therefore annual effective tax rate is equal to 3.5 lakhs divided by 10 lakhs. How much? 30%. That's it. 35% is the annual effective tax rate. Apply this on quarterly income. So 75,000 into 35, 2 lakh 50 into 35, 3 lakh 75 into 35, 3 lakhs into 35. So each quarter this is what we need to recognize. See this. First quarter 75 into 35, 2 lakh 50 into 35, 3 lakh 75 into 35, 3 lakhs into 35. This is the expenses we need to recognize. So first you need to find out the average rate. Hello? This is the question they will test. Very simple. Just to find out the average annual tax rate. Total tax expenses divided by total PBT, profit before tax. You will get the annual tax rate. Apply it on the quarterly income. You will get the tax expenses to be recognized. Okay. Now, sir, one more important question I will solve, sir. Not this one. First question is easy. See illustration 3. Important question. This is illustration 3. See this. The accounts of Purnima Limited showed a net profit of 7,20,000 for the third quarter of 2011 after incorporating the following. They will give you the net profit for the interim financial period. Here they are giving profit for the third quarter. That means interim financial statements. How much is the net profit they are giving? 7,20,000 after incorporating the following. Three things. First, bad debts 40 incurred during the quarter. 50% of the bad debts have been deferred to the next quarter. Tell me, when you are preparing interim financial reporting, is deferring allowed? No, I told you deferring is not allowed. Any kind of deferring, say this, seasonal or occasional revenue should not be anticipated or deferred. So whether it is incomes or expenses, please don't defer it. Whatever the year you incurred expenses, recognize it. If you incur in that year, you need to recognize. In that period, if you incur, you need to recognize in that period only. So therefore, in this case, they have deferred 50% of the bad debts. 50% of the bad debts means 20,000. What we need to do? Add back. Because this 7,20,000 is after, sorry. Now we need to deduct. Sir, we need to deduct, na sir. Because this 7,20,000 is after incorporating the following. That means this 50% of the bad debts we defer it. That means we don't consider. So therefore our 7,20,000 profit, now I need to deduct it. Bad debts I need to deduct. Okay. There is an extraordinary loss of how much? 35. Incurred during the quarter has been fully recognized in this quarter. Correct only. 35,000 extraordinary loss. I told you we should not defer. In whatever the year is there, in that year whatever the expense incurred, we need to recognize it. So we recognized it. So therefore 35,000 we need to recognize, sir. So we have recognized it. So therefore there is an extraordinary loss of 35,000 incurred during the quarter has been fully recognized. That means they have done correctly only. No need to make any kind of adjustments. And see the third point, sir. Additional depreciation of 45,000 resulting from change in method of charge of depreciation, assuming that 45,000 is the charge for the third quarter only. Sir, they have changed the method of charging depreciation, sir. Because of that, additional depreciation came 45,000 and they have considered this 45,000 in third quarter only. Correct only they have done. Because of change in method of depreciation, any additional depreciation came. Sir, you remember AS5, which says whenever there is a change in accounting estimate, the accounting will be done prospectively, prospective accounting. Whenever there is a change in accounting policy, retrospective. So therefore here change in method, 45,000 extra depreciation came. It is recognized in that quarter only. So they have done the same thing. So therefore no need to make any kind of adjustments. So only thing we need to adjust is what? Bad debts. So bad debts we need to recognize, but they have deferred it. So 20,000 you need to deduct. So 7,20,000 minus 20,000. So therefore the correct profit quarterly income is 7 lakhs. See this. So in this case, Purnima Limited should report quarterly income how much, sir? 7 lakhs. 7,20,000 minus 20. See this. Bad debts of 40,000 has been incurred during the current quarter. Out of this, company has deferred 20,000 to the next quarter. Therefore, 20,000 is deducted from 7,20,000. The treatment of extraordinary loss of 35,000 being recognized in the same quarter is correct. Recognizing additional depreciation of 45,000 in the same quarter in tune with AS 25. Hence, no adjustments are required to be done in these two cases. Next. This one, illustration 11th question, sir. Study material 11th question. I think this question they have asked in exams, sir. Recent examination question. This is, see, the same question. In May 2025 attempt, they have asked one question. Okay, same question, sir, which is there in the study material. Study material question only they asked this question. See this question only they asked. Study material question exactly repeated. But the problem is students are not studying. This is simple standard. This is just it will take 40 to 50 minutes. Nothing is there in the standard. You are saying, na? What is there? Just 3 or 4 important points. So in the interim period, when you are recognizing, don't defer anything. That period will be recognized in that year only. Any expense or revenue. That is one. Tax expenses will be recognized on based on annual effective tax rate. Correct? Now you see, 11th question you see. Antarparthi Limited reported a PBT. How much? 4 lakhs. For which quarter? Third quarter. That means it is interim financial statements. On inquiry, you observe the following. Give the treatment required under AS25. Okay. See this one by one. Dividend income of 4 lakhs. Dividend income of 4 lakhs received during the quarter has been recognized to the extent of 1 lakh only. Tell me. Sir, how much dividend income received? But how much recognized? Wrong or right? Wrong. We should not defer it. We should recognize in the same period. That means they have to recognize another 3 lakhs. So we should add to the profit. Dividend income. Everybody. Next. Second. 80% of the sales promotion expenses, 15 lakhs, incurred in the third quarter. 80% of the sales promotion expenses, see this, rupees 15 lakhs incurred in the third quarter has been deferred to fourth quarter as the sales in the last quarter is high. So deferring done, sir. Correct or wrong? Wrong. They should not do deferring. 80% of the sales promotion expenses of 15 lakhs incurred in the third quarter. 15 lakhs you incurred, sir. Total 15 lakhs should be recognized in this quarter only. But 80% of this 15 lakhs, how much? 12 lakhs. You defer to the next year, which should not correct. You should recognize in this year only. So if you recognize this 12 lakhs, what happens? Your profits will be reduced by 12 lakhs. So minus 12 lakhs. Correct? Minus 12 lakhs. Next. In the third quarter, the company changed depreciation method from WDV to SLM, which resulted in excess depreciation of how much? 12. The entire amount has been debited in the third quarter, though the share of the third quarter is only 3 lakhs. Sir, actually depreciation, how much excess depreciation came, sir? 12 lakhs excess depreciation came. Entire has been debited in which year, sir? Which quarter? Third quarter only. Though the share of the third quarter is only how much? 3 lakhs. So therefore, what is the correct treatment? Can you tell me? Shall we done correctly or anything we need to do now? Correct treatment only we done. Whatever the change in method of depreciation happened, because of that additional depreciation came, that depreciation 12 lakhs came, that 12 lakhs we have recognized in the third quarter only, because change happened in third quarter only. So we have done correctly only. No need to do any kind of adjustments. Correct? Next. Rupees 2 lakhs extraordinary gain received in third quarter was allocated equally to the third and fourth. Sir, extraordinary gain, how much we received? But what we have done? We defer it to the next quarter also. Is it correct? No. So that means 2 divided by 2, 1 lakh we have deferred to the next year. But it is also income of the current year. So therefore what we need to do? Add. Sir, 2 lakhs I received in third quarter. When I need to recognize? Third quarter only. But they have deferred 1 lakh to next quarter. So then now I need to set right it now. Everybody. Next. Cumulative loss resulting from change in method of inventory valuation. See this. Sir, here change in depreciation method. Change in depreciation method is change in estimation. Change in inventory valuation method is change in accounting policy. If it is an accounting policy, retrospective. If it is a change in estimation, prospective. So therefore, see, they have done a change in method of inventory valuation, which was recognized in the third quarter of 3 lakhs. Out of this, loss of 1 lakh relating to previous quarters. That means change happened, inventory valuation. Because of the change, there is a loss. How much loss, sir? 3 lakhs. But in this 3 lakhs, how much belongs to last year? Last quarter? 1 lakh. That means current quarter only 2. But we have recognized excess loss of 1 lakh now. Because of that, my profit came down. Now I need to do add 1 lakh. Add 1 lakh. You cannot say, sir, here in the third quarter only change happened, sir. You said whatever happened in that quarter, you need to recognize in that quarter only. Yeah, this is change in policy. So here change in policy happened. See, this is cumulative loss resulting from change in method of depreciation was recognized in third quarter. So already change happened way back. Because of the change, till now the cumulative loss is 3. In that 3, 1 is already belongs to previous quarter. That means that loss of the previous quarter also you recognized in this quarter, which is not correct. So therefore, that 1 lakh excess loss, now we have to reverse it. Everybody, see the difference between this and this you need to understand here. Third, this one. In the third quarter only change is happening. Here the cumulative loss resulting from change. That means change happened way back. Recognition is happening in the third quarter. So the loss of this quarter is only 2. But we recognize it 3 because 1 lakh loss relating to previous quarters. Everybody. Next, sir. The sale of investment in the first quarter resulted a gain of how much? 20. The company had apportioned this equally to the 4 quarters. Wrong. So in the first quarter sale happened. That means it should be recognized in first quarter only. Now we are in third quarter. So these 20 lakhs they have apportioned for 4 quarters. That means every quarter they recognized 5. That means in this quarter 5 lakhs included, na? Deduct 5 lakhs minus. Very simple. Simplest. In the quarter, whatever the incomes earned, recognize this year only. Anything should not be deferred, amortized, which is received, which is relating to this quarter. Okay. Now you tell me, your PBT is how much? 4. So 4 plus 3, 7. 7 minus 12 minus 5 plus 1 minus 3 minus 5 minus 8. So that is the correct profit for the third quarter. Correct? So see this. This is the thing they are asking in the examination for 5 marks. Same question they have tested. See this. This is the same question. 7 marks they tested. May 2025 term, 7 marks they have tested this. Same, nothing, no changes. See this. Dividend income, sales promotion expenses, same. Change in depreciation method, change in inventory valuation, cumulative loss, sale of investment gain, all these things. So exactly same, sir. You try this once. Okay. See this one also. More question I will solve. This question, I think this question not that much. First question and third question same here. See this illustration number 1. There is a sincere corporation is dealing in seasonal product. They are dealing in seasonal product. Sales pattern of the product quarter wise given, sir. First quarter 10%, second quarter 10, third quarter 60, fourth quarter 20. That means see the seasonal impact. Third quarter sales were high. Correct? That means there may be any, like festivals, some event. So when you're preparing interim financial statements for the third quarter, you need to disclose in notes to accounts. Next, information regarding first quarter ending given, sir. Sales how much, sir? 80. Salaries and other expenses 60. Advertisement expenses 4. Admin and selling expenses 8. While preparing interim financial report for first quarter, Sincere Corporation wants to defer 10 crores expenditure to third quarter on the argument that the third quarter is having more sales. Therefore, the third quarter should be debited by more expenditure. Considering the seasonal nature of the business and the expenditure are uniform throughout all quarters, calculate the result of the first quarter as per AS 25. Sir, tell me first of all, as per AS 25, deferring allowed? No, not allowed. In the first year, how much expenditure you incurred? 10 crores. Correct? They want to defer 10 crores expenditure to which quarter? Third quarter. This is not correct. They should not defer it. So tell me what is the first quarter result? Simple. Sales 80 minus salary 60 minus this one 4, this one 8. So deduct all things. 80 minus 60 minus 4 minus 8. 8 is the profit. Correct? So all these things. So according to AS 25, income and expenses should be recognized when they are earned and incurred irrespectively. Income and expenses should be recognized when they are earned and incurred. Therefore, seasonal incomes will be recognized when they occur. Thus, company's view is not as per AS 25. So they want to defer this expenditure to the third quarter, because third quarter they are saying that they have more sales. Therefore, this expenditure they want to defer it for the third quarter, which is not correct. You should not do that. AS 25 says, in whichever quarter you incur the incomes and expenses, please recognize the expenses and incomes in that quarter only. Don't defer it for the future periods. Same question, sir. Illustration 1 4 same. So mark it. Same as illustration 1. Same as illustration 1. Okay. Now, one more important point, sir, here. Last point, sir. Okay. See this point. Applicability of AS 25 to interim financial results. See, suppose for example, sir, my organization, my company, I need to prepare interim financial statements because of any other law, any law. For example, I am a listed company, sir. Listed company means I need to follow SEBI regulations. According to SEBI regulations, every quarter I need to prepare financial statements. So they are called what? Interim financial statements. Now tell me, when I require to prepare interim financial statement as per SEBI guidelines, shall AS 25 is applicable to me? A listed company preparing quarterly financial results as per SEBI regulations, shall I require to follow AS 25 principles? The answer is yes. Even though my company is required to prepare financial statement as per any other guidelines, but when I prepare, I need to follow AS 25. That is what I told in the beginning. This standard does not prescribe which companies need to follow, which companies need to prepare interim financial reporting. But it says whenever you are preparing interim financial reports, you need to apply AS 25. The recognition and measurement criteria of AS 25 is applicable. So therefore, even though you are a company which is subject to preparation of interim financial statement as per SEBI guidelines, in SEBI there is one clause called listing agreement clause 41. See this. AS 25 applies only if the enterprise prepares interim financial report as per its definition. Quarterly financial results under clause 41 of the listing agreement do not qualify as interim financial reports, but must follow AS 25's recognition and measurement principles. They may ask this question. This question is there in the study material also. So they will ask you, your company is required to follow need to prepare financial statements quarterly as per clause 41 of the listing agreement. Whether AS 25 is applicable? Yes. Even though you are required to prepare interim financial statements as per the listing agreement, but when you are preparing interim financial statements, definitely you need to follow the recognition and measurement criteria of AS 25, sir. Okay. So I think yeah, this question you see questions. These questions, sir. Illustration 9 you see. Question number 9 in the study material. This is also a very good question actually. You see this question. On 30th June 2011, Asmita Limited incurred 2 lakhs. Net loss from disposal of business segment. They sold one of the business segment. They got a loss. How much loss they got? 2 lakhs. As on 31st July 2011, the company paid 60,000 for property taxes assessed for the calendar year 2011. See this. They have paid 60,000 taxes, property taxes on 31st July 2011 for calendar year. What is calendar year? January to December. That means for January 1st 2011 to 31st December 2011, they paid how much? 60,000 per annum. That means if I spread divide by 4 each quarter, it will start from January 1st. January 1st 2011 to 31st March 2011, like that. 1st April to June, July to September, September to October to December, like that. So 60,000 divided by 4 if I write, 15,000 every quarter property tax, correct? Now you see, I sold this, I got a loss of 2 lakhs. When I got a loss? 30th June 2011. Which quarter is this? Second quarter. 30th June 2011 means second quarter. Second quarter, I got a loss of 2 lakhs. How the above transaction should be included in the determination of net income of the Asmita Limited for the 6 months interim period that is ending on 30th September 2011. So you are preparing interim financial statements for 6 months. 6 months you are preparing, sir. That means from 1st April to 30th September. Sir, understand, sir. Financial statements are prepared. Generally, the year we need to follow is financial year. That is 1st April of this year to 31st March of the next year. But here property tax is paid for the calendar year. Correct? Now you need to prepare this interim financial statements for this period. What is the period for which interim financial statements will be prepared? 6 months. That means 1st April 2011 to 30th September 2011. Correct? So 1st April to 30th September means April, May, June, July, August, September. 2 quarters. 2 quarters means each quarter how much is the expenses? 15,000. The total 30,000 tax expenses. What is the loss? 2 lakhs. So 2 lakhs is the loss, tax expenses 30,000. Correct? See this. I think what is the number illustration, sir? This one? 9. See this. What is the net loss from disposal, sir? I got 2 lakhs. I paid property tax of 60,000. Correct? So if you see from 1st January 2011 to 31st December 2011, total 60,000 I paid for calendar year. Quarter wise, if you see how much I paid, 15,000. First quarter, second quarter, third quarter, like this. Now when I prepare interim financial reporting for this period, 1st April to 30th September, 6 months I am preparing now. I should recognize this 2 lakhs loss as well as property taxes I need to recognize. How much tax, property tax I paid for this period, 1st April to 30th September, 2 quarters, correct? This one, 1st to 30th September, 2 quarters, 15, 15. But you know, when we paid this, these taxes, when we paid, sir, 31st July, 31st July you paid, correct? Sir, 31st July you paid means 31st July you paid. You are preparing from 1st April. 1st April you paid on 31st July. That means opening outstanding 15,000. Opening outstanding 15,000. Opening outstanding is there now. Suppose you are preparing from 1st April, sir. But when the property tax is paid, 31st July. That means first quarter expenses not yet paid now 15,000. That is outstanding at the beginning. When you are preparing interim financial reporting, that one you need to consider. And also when you are closing the interim financial statements 30th September, by the 30th September, 4th quarter property tax already paid, prepaid. Prepaid expenses is 15,000. Outstanding 15, prepaid 15. And second and third quarter tax expenses incurred and paid. Not understood. Very simple here. What is there here? See, here what they are telling is, see, remember, everybody, please, you are preparing interim financial reporting for this period. What is the period? 1st April to 30th September. For this period, you are preparing what? Financial statements, interim financial statements. You paid total tax expenses how much? 60. When you paid it? 31st July. Correct? 60,000 you paid for calendar year. That means January 1st 2011 to 31st March 2011 first quarter 15,000. Second quarter 15,000. Third quarter 15. Fourth quarter 15. Now my question is, this first quarter what is the tax expenses? 15. When you paid it? 31st July. That means at the beginning of the year they are outstanding. Na? So outstanding 15,000. Similarly, when you are closing interim financial statements, that is September. By the time you are closing, 15,000 belongs to fourth quarter, but you already paid on 31st July. That means 15,000 belongs to fourth quarter is already paid, means prepaid. So outstanding 15, prepaid 15. So outstanding expenses we will add, prepaid expenses we will deduct. So net effect is nil. Hello. So that is what? Outstanding 15, prepaid 15. Very good question actually this is, because students have to think here. See this, market is important. According to AS25, if an enterprise prepares and presents a complete set of financial statements in interim financial reporting, the form and content of those statements should conform to the requirements as applicable to the annual complete. Okay. As at 30th September 2011, see this, Asmita Limited would report the entire amount of 2 lakhs as loss on disposal of the business segment, since the loss was incurred during the interim period. A cost charged as an expense in the annual period should be allocated to interim periods on accrual basis. Since 60,000 property tax relates to entire calendar year of 2011, 30,000 would be reported as expenses for the 6 months. Second quarter, third quarter is belongs to interim period only. Therefore, 30,000 property tax expenses incurred and paid, that will be recognized in the interim financial reporting. And while out of the remaining 30,000, 15,000 for January to March should be shown as what? Outstanding amount of previous year. And another 15,000 relating to last quarter, October to December, would be treated as prepaid expenses. So therefore, here total 60,000 is your prepaid property tax, sir. See this, the conclusion is 60. In this 60, 30,000 which belongs to 1st April 2011 to 30th September 2011. What is this? Incurred and paid. Therefore, this is the expenses. And relating to January 1st 2011 to 31st March 2011, what is this? Outstanding at the beginning, 15,000. And relating to one more thing, what is that? 1st October 2011 to 31st December 2011. How much? 15,000. What is this? Prepaid. So therefore, I need to opening outstanding, prepaid. These are the expenses incurred during the year I will recognize. So that's it. So this is one more question, sir. We have completed. I think all the questions I solved, sir. Okay. Small questions are there. You see this question also we have seen. Sir, one more point, sir. Unevenly incurred cost should be recognized only if allowed at the year end. This point is there, na, sir. What is this point? For example, sir, see this. There is a company, sir, XYZ Limited. They rent an office of 1,20,000 per year, but agrees with the landlord to pay it unevenly. 1,20,000 per year is our expenses, sir. Rent expenses. That means per month 10,000. Evenly means 10,000 per month. Correct? But April to June we pay how much? 60. April to June 60 we are paying. July to December 40. January to March 20. This is what we are paying. That means the benefit, the expenses we are going to pay is 1,20,000 per annum, means every month 10,000. But look at the expenses. April to June 60,000. July to December 40,000. January to March 20,000. Right? What we need to do here is, here rent expenses should be recognized evenly. That is, company must record 10,000 per month, regardless when the payments are made. If the company expenses the entire 60,000 in the first quarter, it will show higher cost upfront, which is incorrect unless justified. If required by accounting standard at year end, the excess 30,000 should be deferred and adjusted over the remaining period. For example, you see, first year how much? But actually 30. Every 30. That means remaining 30,000 is what? So paid but not relating to this period. So it will be deferred to the future years. Future period, it will be deferred. So at the end, see, at the end 1,20,000 only expenses. But only thing is that whatever the expenses you are incurring unevenly, so they will be carried forward. They will be amortized, deferred to the future years if it is allowed. So cost should be recognized as they relate to the period of benefit rather than when paid. Every year the benefit is 10,000, the cost is 10,000. Uneven payments do not justify the uneven expense recognition unless explicitly allowed. Okay, so this is also one point is there, sir. That's it, sir. I think AS25, this is the thing. So in AS25 you need to remember this point, sir. Only 2 points. What are those 2 points, sir? Any incomes or expenses should not be deferred or anticipated to future. in whichever quarter they occur, they will be recognized in that quarter only. And tax expenses will be recognized based on annual effective tax rate. That's it, sir. This is AS 25. Okay, sir. The next accounting standard we are going to start is AS 22, accounting for taxes on income. See, this standard basically talks about accounting for income tax, sir. Taxes on income means income tax, basically. So this standard is talking about what, sir? Accounting for income tax. Income tax. First, you need to understand some important technical terms in order to understand AS 22. First is tax expenses. What is tax expenses? AS 22 says tax expenses are current tax, deferred tax. Tax expenses are two: current, deferred tax. And you know, if you prepare P&L account as per Schedule 3, today you go and check Schedule 3, P&L account. So you will get one head called tax expenses. PBT, first profit before tax. After that you will show tax expenses. These tax expenses will consisting of two: current, deferred tax. Then you will get profit after tax. And also one more thing I will tell you. When you are preparing balance sheet as per Schedule 2, Schedule 3, balance sheet non-current liability side, equity and liability, non-current liabilities, there is one head, deferred tax liabilities. Go and check, it is there. Balance sheet when you prepare as per the Schedule 3, balance sheet, equity and liability side, non-current liabilities. In non-current liabilities we have deferred tax liabilities. This concept of deferred tax liability, deferred tax asset is derived from AS 22. And if you see asset side, non-current assets, one of the item is deferred tax asset. Now in this standard you are going to learn majorly this concept only, deferred tax asset and liability. Okay. So as per AS 22, the tax expenses are current tax, deferred tax. Sir, what is current tax? The tax which is required to pay based on the tax provisions. See, you know, in income tax, I think by this time you have an idea about income tax. In income tax, you will calculate the total income. Total income you calculate. On that you apply tax rates. You will get taxable income. Total income. From the total income you will get taxable income. On the taxable income you apply tax rate. You will get total tax payable. That is called current tax. Current tax is nothing but the tax payable as per the Income Tax Act. Hello? So now what is deferred tax, sir? Current tax I know, because as per income tax I will calculate. I will know. What is deferred tax? See, that is what the main thing of this standard. What is deferred tax? Understand the concept of deferred tax, everybody. Understand the concept of deferred tax. Please listen. Sir, there is accounting income, taxable income. There is accounting income, taxable income. Accounting income. What is accounting income? Accounting income is nothing but net profit or loss from the P&L account. Every year you prepare P&L account, sir, for company. In that P&L account you will get net profit. That is called accounting income. So accounting income is nothing but what? Net profit or loss before tax from P&L account. Now how you are going to prepare P&L account? Schedule 3, okay. Next, you will follow accounting standards, accrual concept, double entry system, all these principles, generally accepted principles, generally accepted accounting principles you will follow, and you will prepare the P&L account, and you will get net profit or loss before tax from P&L account. That is called what? Accounting income. Now come to taxable income. What is taxable income? The income which is determined by following the provisions of tax laws. Hello? As per Income Tax Act, you will calculate total income, na? And from that you will arrive taxable income. On the taxable income only you will apply tax rate and you will get the tax liability. So basically taxable income is what? Income which is determined as per provisions of tax laws. This tax liability is determined based on what? Taxable income. So this is called generally current tax. This is called what? Current tax. Current tax is calculated on what? Taxable income. So there is accounting income, taxable income. Now you tell me, as per P&L account, I will get net profit. As per taxable income, I will get taxable income. Whether both will be same or different? Different. Why they will be different? Because of the provisions of Income Tax Act. Because Income Tax Act says some expenses they won't allow. Some expenses they will allow over a period of time. Some expenses they will allow in the year of incurrence itself. In the year in which you incurred, they will allow. Best example is depreciation. You know, when you purchased any asset for scientific research, 100% of the cost of the asset is allowed as depreciation in the Income Tax Act. But in the company, as per the P&L account, as per accounts, we don't allow 100% of the cost of the asset at a time. Na? We will follow straight line method. We will follow straight line method. And Income Tax Act, you know, generally how depreciation is provided? WDV. Generally we will follow WDV. But as per accounts, I mean P&L account, when you prepare, we follow straight line method. But you need to observe, overall depreciation is same. Whether you follow accounting principles or income tax principles, the total depreciation allowed is cost of the asset only. But the difference is only every year amount. They are following WDV method, I am following straight line method. Hello. So therefore you need to understand, sir, accounting income, taxable income is there. Both are not same. They will not same. Why they will not same? Because of the provisions of the Income Tax Act. Income Tax Act, sometimes some expenses they don't allow. For example, interest on loan. Tell me, sir, as per Income Tax Act, interest on borrowings, interest on loan, is it allowed? When it is allowed? In the year of payment. You know, 43B payment. Interest on capital or interest on loans will be allowed in the Income Tax Act only in the year of payment. But in P&L account, we will recognize as expenses when it is incurred. That means we will debit to P&L account, but we don't allow in Income Tax Act. That means when you compare accounting income and taxable income, sir, they are not matching. Why they are not matching? Because of the provisions of Income Tax Act. Because of the provisions of Income Tax Act, they are not matching. So therefore what we need to do is, we need to identify the reasons. We need to identify the differences. The standard says these differences are divided into two types. One is permanent differences, another one is timing differences. If it is a permanent difference, ignore. For example, any penalty, Income Tax Act, any interest paid on income tax, never allowed as per Income Tax Act. We will allow as per P&L. Sir, any expense, any income, we will take it in P&L, but income tax has restrictions. For example, any donations. Generally, donation is allowed only some specific conditions are satisfied as per Income Tax Act. Suppose when a company gives a donation, sir, P&L account we will allow, but income tax we don't allow. That means it's a permanent difference. So if it is a permanent difference, ignore. If the difference is a timing difference means the difference which originate in 1 year and capable of being reversal in future years. This year there is a difference, but it will reverse in next year's future years. That is called timing difference. The standard says if the difference is timing difference, on that timing difference, whatever the tax is there, that is called deferred tax. The word defer means postponement. Either tax benefit has been postponed or the tax liability has been postponed. That postponement, that timing difference now came, it is going to reverse in the coming years. Therefore you anticipate and recognize now. For example, because of this difference, in future tax liability will come. That is deferred tax liability. Because of this difference between income, accounting income and taxable income, in future there will be savings in tax. That means my asset, deferred tax asset, recognize this year. So why AS22 came? AS22 came to match the tax expenses with the income. Your accounting income and tax expenses should match. They are not matching. Why they are not matching? Because in P&L account you are getting one net profit, but current tax you are calculating as per Income Tax Act. As per Income Tax Act, the taxable income is different. As per P&L account, your net profit is different. But tax is calculated based on taxable income. That tax expenses you are showing it in the P&L account. But P&L account, accounting income is different. Suppose sir, my accounting income 30 lakhs came sir, net profit. Okay, taxable income 20 lakhs came sir. See this, 20 lakhs came. I will pay tax on what? 30 lakhs or 20 lakhs? Sir, my accounting income 30, my taxable income 20. I will pay tax on what? 20. On 20 lakhs, suppose 30% tax sir. 6 lakhs is my liability. I will show this on the P&L account. See this, in P&L account, suppose 30 lakhs is my net profit. I will show 6 as expenses. These two are not matching. Why they are not matching? Suppose if my income is 30, I should pay 30% on 30. It should be 9. But I am showing tax expenses as 6. That means my accounting income and tax expenses I am showing, they are not matching. Why they are not matching? Because tax I am considering as per Income Tax Act. And the tax expense is the current tax I am showing in the P&L account. In P&L account, my net profit is 1. My net profit, which is different from the income tax. Correct? So, these differences I need to identify. And if the difference is, which difference? Timing difference. Timing difference means which originates reversal in future. On that I need to calculate deferred tax. I will show you. I will see this. For example, there is a company X Limited. Everybody please see this. There is a company X Limited. Now I am preparing P&L account for the year ending 31st March 2024. My revenue 100. My expenses, you see, interest on loan 20, other expenses 20. So what is my PBT? 60. This is called accounting income. This is called, which is prepared as per P&L account. Okay. Now come to income tax computation. PBT how much? 60. But in this interest on loan is there na 20. Is it allowed as per Income Tax Act? Not allowed. Interest on loan 43 payment allowed only in the year of payment. Suppose assume this 20 was not paid. This 20 was not paid. So add back. So therefore your taxable income is 80. Taxable income is 80. Accounting income 60. What is the difference? 20. Why the 20 difference? Interest on loan. Is it temporary difference, permanent difference? Temporary. Because next year when you pay it is allowed. Next year when you pay as per income tax, this 20 is also allowed. Na? That means this 20, which is the difference between accounting income and taxable income of the current year, has the capability of reversal in the coming years. Therefore on this 20, you find out the tax. 20 into 30%. How much? 6. 20 into 30%. How much? 6. That 6 is your deferred tax. You recognize in the current year itself. Is it deferred tax asset or liability? Deferred tax asset or liability? Simple principle I will tell you. Save now, pay later. Pay now, save later. Save now, pay later. Pay now, save later. Now you are saving or paying? Paying. Because on this 20 also you are paying tax. That means in future you are going to save. Because this 20 is allowed. Therefore that 6 is deferred tax asset. Deferred tax asset. So therefore, simple sir, have you suffered the tax liability? Have you enjoyed the tax benefit? If you enjoyed the tax benefit today, in future there is a liability. If you suffered the liability, in future there will be tax savings. So therefore, in future liability is coming sir, deferred tax liability. In future I am going to save some tax sir, deferred tax asset. Now you see here, my taxable income is 80. On the tax liability I calculated 24 came. Now this 24 where I will present? P&L account. In P&L account I need to show tax expenses. Current tax how much? 24. Now the question is, see this, everybody please see. Here these two are not matching. My PBT here is 60, but my tax expense is 24. See, ideally on 60, 30% means it should be how much? 18. But I am showing how much? 24. That means they are not matching now. That's why this standard came into the picture, which says the accounting income is not matching with the tax expenses. You are showing tax expenses 24, which is as per the Income Tax Act, but your accounting income is only 60. On 60, ideally 30% means 18, but you are recognizing 24. Why you are recognizing excess 6? Because of the Income Tax Act. Why? Because of the Income Tax Act. Income tax does not allow the 20 lakhs. Is it timing difference or permanent difference? Timing difference. This year not allowed, but next year they will allow. Next year when they allow means next year my taxable income is reduced by 20. My taxable income reduces by 20 means I will save a tax on the 20. 20 into 30, 6 lakhs tax I will save. Therefore create deferred tax asset this year itself. So that's why I created deferred tax 6. So what is the entry for deferred tax asset? Asset to P&L. Asset to P&L. Deferred tax asset to P&L. Or else you can write like this. Deferred tax asset to deferred tax. Deferred tax asset to deferred tax. This deferred tax will be transferred to P&L account. P&L account will be created basically. Sorry, asset to P&L, sir. Asset to P&L. That means P&L account is created with 6, debited with 24. Current tax entries, current tax to P&L to current tax. P&L to current tax. This 24 debited to P&L account. This 6 created to P&L account. That means what is the net effect? 18. Net effect is what, sir? 18. So this net effect is 18. Therefore my total tax expenses is 18. I told you, what is tax expenses as per AS 22? Current tax plus deferred tax. What is my current tax? Minus 24 plus what is the deferred tax? 6. So therefore what is my total tax expenses? 18. Now it is matching. See this. 60, 18. On 60 if I apply 30% it will be exactly equal to 18. This is what this standard will do. Hello. So therefore what is the entry I will write at the end of this year? P&L to current tax. 24, 24. Deferred tax asset to P&L 6, 6. See this P&L account is debited with 24, credited with 6. That means net debited with 18, which is exactly matching with my income. So therefore see here, I am paying now, save later, then deferred tax asset will come. See on this 20 now I am paying tax. So in future there will be savings. So therefore I need to recognize what? DTA. Suppose if I save now, I have to pay later, then it is called deferred tax liability. Or else you can see, when your taxable income is greater than accounting income, taxable income is greater than accounting income means obviously you paid more tax, correct? So tax benefit was deferred, so therefore DTA. When your taxable income is less than accounting income means your tax benefit enjoyed in the current year itself. So therefore in future you will get tax liability. So therefore it is a deferred tax liability. Sir, next year what happens now, sir? Next year when the company pays this 20 is allowed in the next year. Therefore next year what happens now? This deferred tax asset will be reversed. So P&L to DTA. 6, 6. Because in the year of origination you recognized. Next year when the difference reversed, this DTA you cancel it to the extent of the difference. See, first year you recognized DTA. How much you recognized? 6. Now next year when you pay interest, this DTA realized, tax saving happened. Therefore DTA will be cancelled. P&L to DTA. Hello. So that's it. This is the deferred tax concept, sir. I will take one more example, sir. You will understand it better. Don't worry. Depreciation is the best example, sir. Depreciation is the best example. Suppose, sir, see, there is a company, sir. As per P&L account, their PBDT given, sir. Profit before depreciation and tax. Every year 1 lakh, sir. 1 lakh, 1 lakh, 1 lakh. This is PBDT. Profit before depreciation and tax. They purchased one machinery, sir. The cost of the machinery is 30,000. Cost of the machinery is 30. When you prepare P&L account, how depreciation is allowed? SLM. Straight line method. So 30,000 divided by 3. Every year 10, 10, 10. Correct? But as per income tax, you see, when you are computing income tax, sir, entire 100% of depreciation is allowed in the. So as per income tax, entire depreciation of 30,000 is allowed in the first year itself. As per P&L, over a period of 3 years it is allowed. But overall depreciation allowed in P&L as well as income tax, 30 only. Understand? This is a classic example. Overall depreciation allowed as per books, P&L as per income tax is what? 30. The difference is only time. That is why it is called timing difference. See here in 22-23 10,000 depreciation allowed. Next year 10. Next year 10. But here entire 30,000 is allowed in first year itself as per income tax act. Now you see, just common sense you use. In the first year itself, 30,000 depreciation I claimed as per income tax act. But as per P&L only how much allowed? 10,000. That means excess depreciation 20. I enjoyed the benefit. On the 20 I am not paying tax. But I know next year this is going to be reverse. Why? Next year no depreciation is allowed now. But as per the accounts, next year also 10 depreciation is allowed. But as per income tax, entire 30,000 I claim it in the first year itself. That means 20,000. The difference between accounting and taxable, on the 20,000 tax benefit I enjoyed today. So when I enjoy today, tomorrow I need to suffer. Therefore, on this 20,000 I create deferred tax liability. So 20,000 into 30%. How much? 6,000. Create deferred tax asset. What is the entry? Deferred tax liability. Create deferred tax liability. What is the entry? P&L to deferred tax liability. When it is an asset? Deferred tax asset to P&L. When it is a liability? P&L to deferred tax liability. That's it, past 60,000. Now next year what happens, sir? See this. Next year, this 20,000, whatever the difference is there, another. In this 20, how much reversed? 10,000 was reversed. 10,000 was reversed. So 10,000 into 30%. 3,000. So from this deferred tax liability, 3,000 cancelled. Remaining balance, 3,000 will be there. Next year, another 10,000 reversed. That means deferred tax liability will be 0 by the end of the third year. Hello? This is the concept. So you see here, as per P&L account, accounting income, see this. Every year my depreciation is 10, 10, 10. That means total 30. But as per income tax, 30,000 is allowed in the first year itself. But overall depreciation remains same, 30. Therefore, the difference is only timing. First year, how much excess depreciation I considered? 20. In this 20, how much reversed? Next 10. So therefore, what the standard is saying is, in the first year 20,000 is there na difference between accounting income and taxable income. On this 20,000 you enjoyed the tax benefit. But you know this 20,000 you enjoyed the benefit, you saved the tax na. In next year you need to pay. Next coming years you need to pay tax on this 20,000 also. Because next year no depreciation is allowed as per Income Tax Act. But as per the accounts it is allowed. Therefore, first year, whatever the benefit you enjoyed now, this benefit is going to become a liability for you. So therefore, you do one thing. On this 30% means how much? 6,000. You create deferred tax liability. So therefore, in the balance sheet of the first year, when I prepare balance sheet of the first year, I will show DTL. How much DTL I will show? 6,000 I will show. Next year, what happens? 10,000 reverse na, sir. So 3,000 I will reverse. That means when I prepare balance sheet for the next year, from this 6,000, 3,000 reversed. So what is the balance? 3,000 will be shown. Next year another 10,000 reversed. So therefore another 3,000 will be reversed. So next year when I prepare balance sheet, so 3,000 of balance minus reversed 3,000. So what is the balance? Nil. So therefore deferred tax liability for the first year and how much? 6,000. Second year 3,000. Third year nil. What are the entries? P&L to DTL 6,000, 6,000. Second year reverse DTL to P&L 3,000, 3,000. Third year, that's it. This is the standard. Very simple. Identify the difference. The difference is only timing. Permanent. Permanent differences are there. See, in order to understand this standard, sir, little bit of income tax knowledge is also required. PGBP chapter is there, na, sir? PGBP. That chapter you should have the knowledge. Otherwise, you won't understand this standard. Because which is permanent difference, which is a timing difference, you need to understand, sir. Permanent difference means it is not going to reverse. Not going to reverse means income tax says not allowed means not allowed. There are some expenses which is not, for example, goodwill written off. Goodwill written off, sir. We will debit to P&L account. P&L account everything is allowed. But income tax act says no, nothing. Goodwill written off we won't allow. That means the difference is there. But the difference is permanent difference. So you cannot calculate deferred tax. So deferred tax is calculated only on timing difference between accounting income and taxable income. So tell me the simple way, how will you identify whether it is liability or asset? Deferred tax asset or liability? Save now, pay later. Pay now, save later. Simple. Am I enjoying the benefit, tax benefit? If I am enjoying today, liability, I need to suffer. If I am taking the liability this day, savings in future. So here asset means savings in tax. That's why it is deferred tax asset. Understood? Okay. So see this. Come to illustration number 1, sir. See this illustration number 1. See, these are the questions they are asking. 5 marks, just like that you can get it. See illustration number 1. Everybody please concentrate. There is a company Rama Limited, sir. Depreciation as per accounts. Accounting records means as per P&L. As per income tax. Now you tell me. I am not, just think. As per income tax, how much depreciation I am claiming? 5 lakhs. As per accounts, excess depreciation claim. This 3 lakhs I am saving. I mean, on the tax I am saving today. I am claiming 3 lakhs excess depreciation as per income tax. That means on 3 lakhs I am saving the tax. The tax rate is 50%. That means 3 lakhs into 50%. 1 lakh 50. What is this 1 lakh 50? Deferred tax liability. DTL. DTL I need to recognize. On this 1 lakh, I mean on this 3 lakhs. Why? Because depreciation I know it is which difference? Timing. Because whether you take income tax or P&L, overall depreciation is cost of the asset only. But the only difference is year-wise. Year-wise if we see there is a difference. But overall if I see total. Same interest on loan. For example, if I take an interest on loan, on that if I pay interest, P&L account I will debit. Income tax also will allow. But when they allow? Only when I pay. So therefore the difference is only timing difference. When I pay they will allow now. That means the difference is only temporary difference, timing difference, which is going to reverse. For that we need to recognize deferred tax. So deferred tax is recognized only for temporary timing difference. Next one. This one also very important. See this. Unamortized preliminary expenses as per which records? How much is there? 30. Now I want every one of, I think there is one section called 35D. Amortized preliminary expenses. 35D or 35D, I think D, 35D. How many years they will allow, sir? Preliminary expenses? 5 years. So that means if at all any preliminary expenses is there, I will debit to P&L. But income tax side says we will allow for 5 years. So that means there is unamortized preliminary expenses. That means this unamortized balance is what? Is going to allow in the future. Is going to allow in the future as per income tax. But because sir, income tax act says unamortized preliminary expenses will allow over a period of 5 years. Now this 30,000 is going to allow in the future years. That means this year I have paid tax on this 30,000 also. But next coming years, out of this some amount will be allowed as deduction. For example, total 1 lakh, sir. 1 lakh divided by 5. Every year 20,000 they will allow now. Like that still 30,000 they are going to allow as per income tax act. But as per P&L I claimed everything. So the difference of 30,000 is what? So it is my deferred tax asset because it is going to give me some tax savings in future. Today I am suffering. I am paying tax on this 30,000 also because income tax excess we will allow in future over a period of time. Now that means you suffered tax on this 30,000. So that means when you take in the burden of tax liability today and pay now, definitely you are going to save later. So this 30,000, 50% means 15,000. DTA. Correct? DTL how much? 1 lakh 50. On depreciation DTL, sir. On unamortized preliminary expenses DTA. So therefore overall 1 lakh 35,000 net deferred tax liability. See this. Excess depreciation as per tax records 3 lakhs is a timing difference. Calculate deferred tax liability 1 lakh 50. Unamortized preliminary expenses amount 30, timing difference, deferred tax asset. Sir, you understand how deferred tax asset came? What is deferred tax asset? Savings in tax. Savings in tax. When savings will happen? When you take in the burden today. When you pay tax today, there will be savings. On this 30,000, you are paying tax now. Because they are not allowed, they are going to allow in future. That means this 30,000 you are paid the tax. That means it is going to give savings in future. So therefore deferred tax asset. Hello. I will give you one more beautiful question, sir. This question I think I already asked in the examination. See this question, illustration 4. There is a company Omega Limited, sir, which is working on different projects which are likely to be completed how many years? 3 years. It recognizes revenue from these contracts on what basis? Percentage of completion method for financial statements during 10, 11, 11, 12, 12, 13 for 11 lakhs, 16 lakhs, 21 lakhs respectively. That means this company Omega Limited, sir, in when they are preparing financial statements, revenue they are recognizing. On what basis they are recognizing? Percentage of completion method. Amounts given, sir. Now see, however, as per income tax purpose, it has adopted which method? Completed contract method. As per books, we are following percentage. As per income tax, we are following completed contract method, under which it has recognized the revenue of how much? 7, 18, 23 for the year 10, 11, 11, 12, 12, 13 respectively. Income tax rate is 35. Compute deferred tax asset or liability for the years. Simple. Take a calculator. Okay. Add these things. 11 lakhs, 16 lakhs, 21 lakhs. Tell me how much came? 11, 16, 21. 40. This is what? Total revenue as per P&L. Now, as per income tax, add everything. Revenues 7, 18, 23, 48. That means overall revenue recognized as per books, as per income tax, same. The difference is only years. So this is called timing difference. On timing difference, we need to recognize deferred tax asset or liability. Now see first year. First year, everybody see. First year, as per P&L, what is my income? 11 lakhs. As per income tax, 7 lakhs. That means as per P&L account 11 lakhs, as per income tax 7. That means as per income tax 7 lakhs only I considered. So therefore save now, pay later. I have saved 4 lakhs. The difference is 4 lakhs. On that 4 lakhs I saved the tax. I have not paid it because as per income tax I considered only 7. But as per P&L 11. That means 4 lakhs less considered. Na? That means 4 lakhs into 35%. 1 lakh 40,000 is my deferred tax liability. Liability. Because I enjoyed the benefit today. Tomorrow I am going to pay. Hello. So first year timing difference how much? 4 lakhs. 4 lakhs into 35%. Second year you see. Second year what is my P&L account income? 16. As per income tax 18. That means the first year timing difference of 4 lakhs was reversed now. 2 lakhs reversed. So 2 lakhs into 35%. 70,000 you reverse deferred tax liability. Reverse. So the balance is 70. Last year you see as per P&L how much? 21. As per income tax 23. Another 2 lakhs reversed. So 2 lakhs into 35. So nil. Deferred tax liability at the end of the third year is nil. Very simple concept. See this. Accounting income first year 11, taxable income 7. Your taxable income is less than accounting income. Sir, the moment your taxable income is less than accounting income means you have enjoyed the benefit today, this year. That means you paid tax on this 7 lakhs, not on 11 lakhs. That means this 4 lakhs is the timing difference. On this 4 lakhs you enjoyed the benefit. Therefore in future liability will come. So 4 lakhs into 35%, then deferred tax liability 1 lakh 40. Next year you see, next year your accounting income is 16 but taxable income is 18. Taxable income is more than accounting income by 2 lakhs. That means 2 lakhs was reversed. First year timing difference was reversed by 2 lakhs. See this timing difference 2. So on that 35% means 70,000 reverse. So the balance is how much? The balance is, sir, first total deferred tax liability 1 lakh 40, sir. In that 70,000 reverse means how much will be there? 70. Third year another 2 lakhs reversed. So deferred tax liability will be nil. What are the entries? Can you tell me? First year P&L to DTL 1 lakh 40, 1 lakh 40. Second year DTL to P&L 70, 70. Third year DTL to P&L 70, 70. That means third year and DTL is 0. First year 1 lakh 40. Second year 70. Third year 0. See this 1 lakh 40, 70, 0. Okay. So timing difference, permanent difference, theory question, same question which we solved. Just now we solved na? Illustration 1. That question only they have asked. Okay. In examination, recent examination question I will show you. Very simple question. See this. September 2025 attempt they asked one question. Same depreciation. You have to tell me. See, come on. This company has purchased what? A building. What is the cost? 20 lakhs. Life 4 years. Scrap value expected is 0. Depreciation allowed how much? First year, rest balance in second year for which purpose? Straight line method is considered for accounting purpose. So that means 20 divided by 4. 20 divided by 4 means 5 lakhs. So that means as per P&L every year 5 lakhs, 5 lakhs, 5 lakhs, 5 lakhs. As per income tax, first year 10 lakhs, second year 10 lakhs. Now see the first year difference. As per P&L, what is the first year difference? First year depreciation 5. P&L 5. As per income tax 10. How much excess you claimed? 5. Which will give you deferred tax liability. You enjoyed today. You claimed excess depreciation. So 5 lakhs into 30%. 1 lakh? 1 lakh? So deferred tax liability for first year 1 lakh 50. Correct? Second year also same as per P&L 5 lakhs. As per income tax 10. Again you claimed excess depreciation, which will give you deferred tax liability. Same 5 lakhs into 30%. How much? 1 lakh 50. So that means total DTL is 1 lakh 50 plus 1 lakh 50. Total 3 lakhs. Correct? Now come to third year. As per P&L 5 lakhs. As per income tax 0. That means timing difference is reversed. First year timing difference 5 lakhs. Second year timing difference 5 lakhs. Total 10 lakhs. In the 10 lakhs how much reversed? 5 lakhs reversed. So 5 lakhs into 30%. 1 lakh 50,000. So from this 1 lakh 50 reversed. Last year as per P&L 5 lakhs, as per income tax 0. That means another 5 lakhs reversed. So 5 lakhs into 30%. 1 lakh 50 reversed. That's it, pa. What is there? Simple. They have given PBDT as per accounting depreciation. This profit before taxes, tax expenses, current tax, and deferred tax. So here they have given, see this. This is the timing difference for first year. On that DTL will come. Second year also there is a timing difference, DTL. Third year reversed. Fourth year reversed. That's it. But this question they have asked for 5 marks. Jackpot. What is there? Nothing. You know the concept. So you understood the difference between accounting income and taxable income. Here is only depreciation. First year I claimed excess depreciation. On that excess depreciation I will create deferred tax liability. Next year also deferred tax liability. Next year cancelled, reversed. Okay. Same manner this question also you practice. One examination question is there. So okay. So that means we have completed the main concept of AS22, sir. Deferred taxes concept. So can you put it in simple? What is deferred tax? What is deferred tax? What is deferred tax? Deferred tax is tax effect on timing differences. Tax effect on, that's it. So they are saying this, see this. What is deferred tax? Tax effect on timing differences. What is timing differences? Difference between accounting and taxable income that originate in one period, reverse in future periods. Best example, suppose if I purchase a machinery for scientific research, it is fully deductible in year 1 as per income tax. But as per P&L account, it is allowed over a period of time. But the difference is only timing. Overall cost of the asset only allowed as a depreciation, whether it is income tax or P&L. The difference is only in the years, the amount. What is permanent difference, sir? Difference that originate in one period, do not reverse later. Example, fine for late tax payment. Suppose in the income tax act, sir, if I make any payment late tax, I should pay fine, sir, fine penalty. Is it allowed as per income tax act? Never allowed. Any fines, penalties, late taxes you paid, it is not allowed. Therefore, since it never reverses, it is a permanent difference. Will you calculate deferred tax on permanent difference? No. Ignore. Everybody. Next. So accounting income means net profit or loss before tax. Taxable income I told. Tax expense means current tax plus deferred tax. Current tax I told. Tax payable on the taxable income. Okay. Now recognition. Now once the main concept is over, deferred tax concept is over, here onwards some small points are there. I will tell you. Sir, one important point, sir. Deferred tax asset. Sir, what is deferred tax asset? Hello? What is deferred tax asset? What is deferred tax asset, pa? Deferred tax asset means savings. Tax savings in future is called deferred tax asset. Okay? That means today I suffered, tomorrow there will be savings. I paid the tax today, but there will be savings tomorrow. Correct? That I am calling it as deferred tax asset. So deferred tax asset is basically tax savings in future. Now listen. The standard says Sir, in future, this deferred tax asset must be realized. How asset will be realized? Here in this case, by way of savings in tax. Generally, suppose if I have this building, this is my asset. How this asset will be realized? When I sell, amount will be realized. But deferred tax asset is an asset, but it is not realized in the form of cash. It is realized in the form of tax savings. But the question is, in order to have tax liability in future, there must be sufficient taxable income in future. Then only this deferred tax asset will be realized. Na? For example, you said my deferred tax asset is 10 rupees. That means this 10 rupees is a tax savings in future. In order to have this 10 rupees tax savings, first of all, there must be tax liability in future. Suppose you are a company, loss making company. You don't have any future taxable income. You don't have any tax liability at all. Then standard says don't recognize DTA. DTA will be recognized only if there is sufficient future taxable profits, against which this deferred tax asset will be realized. The logic is what? Prudence concept. Don't anticipate assets, but anticipate liabilities. Asset will be anticipated only when there is absolute certainty. So in future, if you are sure that your company will have sufficient taxable profits, you get a tax liability. Against this tax liability, this deferred tax asset will be realized. Savings, sir, savings when will happen, sir? Only when there is a liability. When there is a tax liability, in the tax liability savings will happen. Correct? That is what standard says. Here two situations they are creating. One is, if you are creating DTA for reasons other than unabsorbed depreciation and carry forward losses. You created DTA. For which reasons you created DTA? For which timing differences other than unabsorbed depreciation and carry forward losses? You remember in Income Tax Act, unabsorbed depreciation and carry forward of losses. Sir, in income tax, any unabsorbed depreciation is there, it can be carry forward. That means in the future years, against taxable income, this unabsorbed depreciation will be adjusted. That means in future, because of this deferred tax, this unabsorbed depreciation, my tax liability will be reduced. So it will create deferred tax asset. Hello. Similarly, carry forward of losses. If any losses is there as per income tax, it can be carry forward to future years. So that means this carry forward losses will give savings in future. So therefore, if you create any DTA because of reasons other than unabsorbed depreciation and carry forward of losses, they say you must have a reasonable certainty. Which certainty? Reasonable certainty that you should have sufficient taxable income in futures. Then only DTA will be recognized. Sir, what is reasonable certainty? Based on the past records. You check the previous year data. Previous year records you check. Based on the past records, if you can able to come to a conclusion that this company will have sufficient taxable income in future and there will be tax liability, then only DTA will be recognized. If you are creating DTA due to reasons other than unabsorbed depreciation and carry forward of losses. Sir, if you are creating DTA for reasons of unabsorbed depreciation and carry forward of losses, suppose in your company already unabsorbed depreciation is there, carry forward losses is there, and you are creating DTA. You are creating DTA. In this situation, they are saying you should have virtual certainty. What is this virtual certainty? Here reasonable certainty, here virtual certainty. Why? Why the difference? Standard making absolutely clear that see, already your company have unabsorbed depreciation carry forward losses means you are already suffering losses. Therefore, in future, whether you will get a taxable income, you will get tax liability, very big question. You don't get profit at all. Therefore, the question of arising tax liability will not arise. Therefore, unless you are absolutely confident, that's why they use the word virtual certainty. What is virtual certainty means? 100% pakka evidence you should have that you have definitely some taxable income in future against which there will be tax liability. That means, for example, company got a export order, export contract. Suppose if I export this, I will get revenue. That concrete evidence should be there in my hands. That is called virtual certainty. See, here reasonable certainty is sufficient, but here virtual certainty should be there. For what? That there will be sufficient taxable income in future years, against which this DTA will be reversed. DTA will be realized. So simple listen, DTA means savings in tax. In order to realize this DTA, there will be tax liability in future. So the standard says you are creating DTA. Yes. In your company, you don't have unabsorbed depreciation carry forward of losses. Then you should have reasonable certainty that in future your company will have a sufficient taxable income against which tax liability will be there. Only when there is a tax liability, this deferred tax asset will be realized. Suppose you said, sir, my tax liability 100 rupees. Then only I can say you can save 20 rupees. Suppose if you say, sir, I don't have tax liability, how can I say savings in tax liability? So therefore your company says DTA. DTA means tax savings. In order to realize this asset, you should have reasonable certainty that your company is going to get what? Taxable income in future. When you create DTA due to reasons other than unabsorbed, that means your company does not have any existing losses. Suppose you already have existing losses. Existing losses already means worst condition. In future, there is no guarantee that you are going to get profits. Correct? Therefore, in this case, they are increasing the degree. They are saying reasonable certainty not sufficient. What is required? That's it. Nothing is there. So therefore, you understand reasonable certainty, virtual certainty. Reasonable certainty is judged from past records. But virtual certainty, 100% pakka evidence you should have in your hands. See, strong evidence should have, sir. Please understand, strong evidence such as binding export order. Okay? And one more thing, sir. Sir, how I am going to measure these deferred taxes? If it is a current tax, no, sir, I should measure by using the applicable tax rates and laws. You know, every year I will calculate tax liability. So whatever the tax rate applicable for that period, I will apply. But what about deferred taxes? Which rate I will apply to calculate deferred taxes? Because this deferred tax is relating to future. Which rate I need to apply? For example, this year, this assessment year, you know the income tax rates. Suppose when I am calculating deferred tax, the same rates can I apply? The standard says enacted rates. Government already announced future tax rates. Enacted or substantively enacted rates, use them. When you are calculating current tax, only this year applicable rates. But deferred tax, you apply enacted. What is enacted rate, sir? The rates which is approved in the parliament. Government already approved. Substantially enacted means almost confirm they will come. Sir, every year government tax rates they will update, na sir. So when it comes to deferred tax, timing difference into tax rate I need to apply, na sir. Which tax rate I will apply? Enacted or substantively enacted tax rate I will apply. Discounting, no question of discounting, sir. You cannot discount the deferred tax to present value. Discounting is not allowed. It cannot brought to present value. Some students will say me, sir, deferred tax is relating to future. Can I convert into the present value? No. Today we discussed AS15, DBO. DBO, current cost will brought to present value. But similarly, can I recognize deferred tax asset liability to its present value? No, not allowed. Next. Okay. Next, sir, presentation and disclosure. Say important, one point, sir. Sir, can I set off both current taxes, assets and liabilities? Current tax, assets and liabilities. What is current tax asset? Advance tax. Hello? Advance tax is current tax asset. Current tax liability? Provision for tax, correct? Every year we create provision. Can I set off both? Standard says yes. Allowed, but two conditions. It is a legal enforceable right to set off should be there, and intent to settle it on net basis should come. For example, my advance tax 10 lakhs, provision for tax 8 lakhs. So I can set off and I can pay 2 lakhs. Now similarly, deferred tax assets and liabilities, can I set off? Yes, same conditions. There must be legal enforceable right to set off, and the company both related to taxes levied by same tax laws. Important, sir. Deferred tax asset and liability can be set off only if the both should arise from the same tax laws. Same tax laws. For example, DTL came in India. DTA came in foreign country. Foreign. Suppose in foreign also we have one branch, sir. There in the foreign country transactions we got DTA. Indian company transactions DTL. Can I set off both? No, cannot. They may ask a question on this. DTA, DTL will be set off only when they arise from same tax laws. Same tax laws. That's it. Now special cases. Two special cases are there. I will discuss them. One is tax holiday. Important. Listen to me. They may ask this. Tax holiday. Sir, what is tax holiday? You know, In income tax, there is a concept called tax holiday. 10A, 10B, 80IA. Tax holiday means what? For some period of time, government will say no tax. Hello? For some period of time, there is no tax liability to you. So that is called tax holiday. See, if at all there is a tax liability, tax holiday, sir, what we need to do? Suppose, for example, there is a company, sir. For you, first 10 years, there is no tax liability. Government income tax says there is no tax liability for first 10 years. Now, standard says any timing difference which originates and reverses within the tax holiday period, ignore. Any timing difference originates, reverses within the tax holiday period, ignore. Don't recognize DTA or DTL. Why? First 10 years no tax here. When there is no tax, why to recognize? So whatever the timing difference originates, for example 100 lakhs timing difference, out of these 100 lakhs 60 lakhs was reversed in the next 9 years. Therefore this 60 lakhs ignore, don't recognize DTA or DTL. Now any timing difference which originates in the tax holiday period but reversal will happen after tax holiday period, then on that you need to recognize DTA or DTL. For example, 100 lakhs timing difference came between accounting income and taxable income in the first year. Out of these 100 lakhs, 60 lakhs was reversed. Ignore. Remaining 40 lakhs is there now. When it is going to reverse? After tax holiday period. Sir, this year there is a difference between accounting income and taxable income. 100 lakhs. Out of these 100 lakhs, in the next 9 years tax holiday period, suppose 60 lakhs reversed. Ignore it. That means what is the balance? 40. On that 40 you recognize DTA or DTL in the year of origination. In the year of origination. So that is what tax holiday concept is. So only two principles you need to remember. What are those? Tell me. Any timing difference originates, reverses. In the tax holiday period, ignore. Any reverses, any timing difference originates but reverses after tax holiday period. What do you need to do? Recognize. Recognize DTA or DTL. Hello. Suppose this question you see. Scenario based question 6. Y Limited is a company, sir, is a full tax-free enterprise. Tax-free enterprise means tax holiday. For the first 10 years of its existence. So first 10 years tax holiday given, sir. And in the second year of its operations. Now depreciation timing difference is there. Directly given. How much is there? 200 lakhs. And INR 400 lakhs respectively, which will result in a tax liability for year 1 and 2. So there is a timing difference of 200 lakhs in the first year, 400 lakhs in the second year. From the third year, it is expected that timing difference would reverse each year by how much? 10 lakhs. Now you tell me, come on, simple. First year, what is the timing difference? 200. Reversal will happening from third year. How much reverses? 10. Third year 10, fourth 10, fifth 10, sixth 10, like that 10 years. Correct? That means 8 into 10. How much? 80 lakhs. So 80 lakhs reverses. So first year, whatever the timing difference originated 200, on that 80 lakhs is reversing within the tax holiday period. Ignore that 80 lakhs. So from this 200, if I reduce 80, what is the balance? 120. This 120 will reverse after tax holiday period. On that you recognize deferred tax asset or liability. You need to in which year? In the first year itself. In the first year itself. Because first year difference is 200. In this 200, how much is reversed? 80. Remaining balance 120 you recognize. Second year, how is the timing difference? 400. Entire 400 will reverse after tax holiday period. Therefore, on that 400 also you recognize deferred tax liability or asset. Hello. See this tax rate how much? 40%. Find out the deferred tax liability they are asking for the end of the second year and any charge to P&L account. Very simple. See this. See this. Out of 200 lakhs timing difference due to depreciation, difference of 80 lakhs will reverse in the tax holiday period and therefore should not be recognized. However, 120 lakhs deferred tax liability will be recognized for 48 lakhs. How much? 48 lakhs. How much came? How 120 into 40% in the first year. In the second year, the entire amount of timing difference 400 lakhs will reverse only after tax holiday period. Hence the recognition in full. So deferred tax liability amounting to 40% of 400, 160 lakhs will be created by charging to P&L account. Therefore, the total balance of deferred tax liability at the end of the second year is how much? First year balance 48, second year 160. Total 208 will be recognized. Hello. So any timing difference which originates, reverses. Both happened within the tax holiday period, ignore. Any difference originates but reverses after tax holiday period, recognize. In the year of origination. And here you need to follow FIFO. First in, first out. Whatever the difference originates first, assumed reversal first. That means here the first difference came 200. Only that will be reversed. You cannot assume second year I will assume, sir. No. On this 280 reversed. On this 280 reversed. Remaining balance you need to recognize deferred tax asset or liability. So this is tax holiday concept, sir. Very simple concept I explained. Now next there is one more concept, sir. MAT. Not MAD, sir. MAD. Not MAD. MAD. It is MAT. M-A-T. You know MAT? Minimum alternate tax. You know, this is also called as what? AMT, right? In some places. Alternate minimum tax. Listen. You know AMT or MAT. In income tax, we calculate tax liability as per the regular tax rates. One tax liability will get. We will compare with AMT, right? We also calculate tax liability as per AMT. Okay, MAT. Whichever is higher we will pay. Correct? As per MAT, if it is 1 lakh. As per regular, it is only 80. How much I need to pay? 1 lakh I need to pay. Now my question is, if any year you are paying tax liability as per MAT, because MAT tax liability is more than regular tax rate, will deferred tax will also be calculated based on MAT rates? Because MAT rate is different from normal rates. Suppose in any particular year your tax liability is more than MAT, that means you need to pay tax to the government on basis of MAT, current tax. Whether deferred tax is also calculated based on MAT rate? The answer is no. The standard says no, never. Deferred tax is always calculated on regular tax rates, no MAT rate. No MAT rate. No MAT rates. Okay. So DTL and DTS for timing difference must be measured using which rates? Regular tax, not 115 JB rates. Please understand, sir. And relating to this, one question is there, sir. This is important question. They have tested already, I think, this question, this type of question. I will solve that question. See this illustration number 2. See this question, everybody. Illustration number 2. From the following details of A Limited for the year ending 31st March 2011, calculate what? Deferred tax asset or liability as per AS 22 and the amount of tax to be debited to P&L. Can you tell me how much amount of tax we need to debit to P&L account? Tax expenses are two parts. What are those? Current, deferred. So how much amount I need to debit? I need to know current tax, deferred tax. Both I need to know. Correct? Accounting profit, how much given? What is this accounting profit? Net profit as per P&L. Book profit as per MAT means minimum alternate tax. Book profit we will calculate there. That one given. Profit as per income tax. This is regular. In income tax, regular tax rates. Tax rate 20, regular tax rate. MAT rate 7.5. Now you first you see. I calculate current tax first. Current tax. Can you tell me how to calculate current tax? Simple. What is my profit as per income tax? 60,000 into 20%. Normal tax rate apply. How much? 12,000. This is as per normal, regular, correct? See MAT also once. MAT. In MAT you take book profit. What is book profit? 3,50,000. MAT rate 7.5. How much? 26,250. Which one you pay? 26,250. Sir, I will pay 12. Income tax they won't allow. They say whichever is higher. 26,250 pay. So this is your current tax. So what is current tax? So one component we got 26,250. This is called current tax. Now I want deferred tax. Hello. Deferred tax means what? Tax on timing differences between accounting income and taxable income. What is my accounting income? 6 lakhs. What is my taxable income? Is it 3,50,000 or 60,000? Can I consider as per MAT, as per profit, as per normal income tax? Normal. Always. Don't compare with this one. Hello. So tell me, 60,000 my accounting profit, as per income tax 60. 6,60,000. So difference is how much? 5,40,000. On this 5,40,000, which rate I will apply? Normal rate. What is the normal rate? 20. Apply 20. 1,00,000. That's it. This is my deferred tax. Pa, important pa. The difference between accounting and profit as per income tax. Don't consider MAT. Even though this year my current tax liability came as per MAT, when it comes to deferred tax, don't take MAT. Rate we should not take, income also we should not take as per MAT. So as per normal book profit 6 lakhs, as per income tax 60. So 6 lakhs 60,000, how much is difference? 5 lakh 40. 20%, 1 lakh 8,000. Is a deferred tax asset or liability? Asset or liability? Asset or liability? I think, see, you are paying tax on 60,000. Your accounting income is 6 lakhs. So it's a deferred tax liability. DTL. So 1 lakh 8,000 DT deferred tax. Current tax 26,250. Total 26,250 plus 1 lakh 8,000. 1 lakh 34,250. This is the total expenses which is debited to P&L account. See this. 1 lakh 34,250. See, you follow what I am teaching, because here some hard way they present it, but this is a simple way. Simple way explained. So how much will be debited to P&L? 1 lakh 34,250. That's it, pa. This is AS 22. Over AS 22. So AS 22, the only important concept is what? Deferred tax concept. What is deferred tax? You understood? What is deferred tax? Can you tell me? Tax effect on timing difference. What is timing difference? Difference between accounting and taxable, which originates and reverses in future features, and which originates but will not reverse. Permanent difference. Ignore. Don't calculate. Correct? And deferred tax asset. If already there is unabsorbed depreciation losses in your company, then you recognize DTA only virtual certainty. Virtual certainty. In other cases, reasonable certainty. Reasonable certainty, past records will judge. Virtual certainty, 100% pakka, strong evidence. And current tax is recognized based on normal tax rates. I mean, current tax, applicable tax rates. Deferred tax, enacted or substantively enacted rates. I told na, if nothing gives, whatever the rates available we'll take. But if enacted, substantively enacted rate gives na, that we will take it. Okay, let's start accounting standard 19, sir. Leases. So basically, what is this standard is all about? See, AS 19 will provide you the accounting treatment for leases. Whenever any asset is taken on lease basis, what is the accounting we need to do in the books of lessor as well as lessee? The person who is the owner of the asset is called lessor, who gives his asset on lease basis. The person who takes the asset on lease is called lessee. So in the books of lessor, in the books of lessee, how we are going to do the accounting treatment for leases? That is what this standard will address. And also what kind of disclosures the lessor and lessee need to make in the financial statements. That is also provided by this standard. So this standard will basically provide the accounting for leases in the books of lessor and lessee, and disclosures to be made relating to leases in the financial statements. See how you are going to learn AS 19, sir. Simple. AS 19, first we understood the object, right? Then scope we need to see. And the most important part in AS 19 is what? Definitions. The technical terms are very, very important. Without understanding these technical terms, it is not possible to understand AS 19. So AS 19 depends upon those technical terms. Okay. Those definitions are very, very important. And then types of leases. And then finally, accounting for leases in the books of lessee, in the books of lessor. Actually, AS 19 divided the leases into two categories: finance lease, operating lease. So finance lease, lessee books, lessor books. Operating lease, lessee books, lessor books. What is the accounting treatment? That is provided by accounting standard 19. And the last concept of AS 19 is sale and leaseback transactions. Sale and leaseback transaction. So from that concept also they are testing sale and leaseback transactions. So this is the things we are going to discuss in accounting standard 19, sir. Okay, first start with the what is lease first of all? Can you tell me, see, what is lease, sir? Basically, see, lease is basically an agreement between two parties. It is an agreement between two parties. Who are the two parties? Lessor, lessee. Lessor is the owner of the property who gives asset on lease basis. Lessee is the person who is taking the asset on lease basis. So lease is basically an agreement between two parties where one party gives the right to use the asset to other party. I am giving you the right to use the asset to you for a period of time, for an agreed period of time. Suppose I will give this building to you to use it for 5 years, and in return you are going to pay me some consideration. So basically in lease, what are the important things? Agreement, two parties, lessor, lessee, for an agreed period of time. That means there is a lease term, and then consideration. These are called lease rentals. Okay. Now see, why? Because suppose for example there is a company, they want plant and machinery. Suppose the cost of plant and machinery is 1000 crores. Tell me, purchasing by spending 1000 crores, blocking this much amount on a capital asset may be not possible for all the companies. That's why this lease concept came into the picture. Taking asset on rental basis came into the picture, because I can't spend this much amount, I can't block the funds this much for a single asset. It will affect my organization working capital. I can't arrange this much funds for purchase of large, capital intensive assets. That's why the lease concept or rental concept came into picture. Okay. Now, if you look at AS 19, sir, this AS 19 scope, sir, whether AS 19 is applicable for all types of leases? No. There are three exceptions. One is natural resources. Any lease given for exploration or use of natural resources like oil, gas, timber, metals, other minerals, those kinds of leases are not covered under AS 19. Second, licensing agreement. Any licensing agreement for intellectual property rights, IPRs. Intellectual property right means motion picture movies, motion picture films like cinemas. I given my licensing agreement of movies to you. So any videos, video recordings, plays, manuscripts, patents, copyrights. We can say intangible assets. These are all intangible assets. If I give my right of intangible assets to you to use, those kind of licensing agreements are not covered under accounting standard 19. And the last one, land. Okay, if I give my land on lease basis, AS 19 will not cover it. Agreement specifically for using land. So land lease agreements are not covered. So there are three lease types of leases AS 19 will not cover. What are those? First one, natural resources. Second one, intellectual property rights like patents, copyrights, trademarks, manuscripts. What is manuscript? Manuscript means originally written books, written or typed document that forms the original content of a book or a scripts, academic papers, screenplays, originally written. Suppose there is an author, he has originally written the book, that is called manuscript. So if he has given his publishing right of that book to any other, so any other publishing company or any other person, that will not be covered under accounting standard 19. So those kind of licensing agreements are not covered under accounting standard 19. Okay, next. Sir, in AS 19, the most important thing is definitions, sir. The most important things are definitions. So listen to these definitions very, very carefully. Now, see, as per AS 19, as I already told you, this standard has classified the leases into two categories. One is finance lease, another one is operating lease. So accordingly, they have provided the accounting treatment. For finance lease, what is the accounting treatment? In the books of lessee, lessor. For operating lease, what is the accounting treatment? For lessee, lessor. What is finance lease? Finance lease, I will transfer risks and rewards of the property also. In the finance lease, the substance is that I am not just giving the asset to you on lease basis. I am transferring risks and rewards also. That means finance lease is not just a lease agreement. It is not like a mere rental arrangement. No, I am giving you the risks and rewards. So since I am giving risks and rewards to you, as per AS1, there is a concept called substance over form. We need to see the financial reality. So therefore, whenever lessor gives any asset on lease basis, and if that lease is finance lease, sir, lessor point of view, it is a sale. lessee point of view, it is a purchase. So finance lease is kind of what I am selling the asset to you on finance basis. Generally, what is operating lease? Operating lease is just a rental arrangement between the parties. For example, this building I have given rent to you. Risks and rewards are there with me only. So depending upon the substance of the lease agreement, you need to classify whether the lease is a finance lease or operating lease. Finance lease, risks and rewards will also be transferred. So therefore, in case of finance lease, as a lessor, whenever I have entered an agreement, if that lease agreement is a finance lease, lessor will treat this as a sale. Lessee will treat it as a purchase. So lessor, what he will do, whenever he has given any asset on finance lease basis, whatever the amount receivable from lessee, he will recognize as a receivable asset, and from his books the asset will be derecognized. Every year you will pay lease rentals, that lease rentals will be recognized by him as a income, he will recognize. But in operating lease, sir, just it is a rental arrangement between the parties. So I have given an asset to you, you pay me rent. As a lessor, every year I will recognize this as a income. As a lessee, you will recognize as a expense. Okay. So again, we will come back to the accounting treatment, but just I have given a brief idea about types of leases. So AS 19 classifies leases into two: finance, operating. Okay. Now come to the definitions. Important. See this. Seriously, there are 17 definitions are there. But not all definitions important, but some definitions definitely very, very important for accounting point of view. See, we'll try to cover. First, non-cancelable lease. This is the definition. Sir, AS 19 is applicable only for non-cancelable leases. It is not applicable for cancelable leases. Suppose if lessee can cancel the lease at any point of time, that is called cancelable lease. For cancelable leases, the standard is not applicable. Only for which leases the standard is applicable? Non-cancelable leases. Non-cancelable leases only the standard is applicable. Sir, what is non-cancelable lease? A lease generally which cannot be cancelled by lessee on his own. But there are few exceptions. 4 exceptions they have given, sir. In these 4 cases, even though the lease is cancelable, still standard consider them as non-cancelable and AS 19 is applicable. First point, AS 19 is applicable only for non-cancelable leases. Non-cancelable lease means lease cannot be cancelled by lessee on his own. But there are 4 exceptions. In these 4 cases, lease can be cancelled, but still we consider it as a non-cancelable lease only, and we need to apply AS 19. Sir, what are those cases? Upon the occurrence of some remote contingency. Some remote, rare contingency. Contingency means something which we are not expecting may happen in future. Suppose on happening of some remote contingency, if lease is cancelable, still it is considered as non-cancelable lease only. For example, I have given this building to you on rental basis. Suddenly fire came, entire building was destroyed. Lease is automatically cancelled. You cannot say this lease is basically non-cancelable lease, so it is now cancelled, therefore I don't apply AS 19. No. Suppose fire came, asset destroyed, obviously lease will be cancelled. So on happening of some remote contingency, lease can be cancelled. That will be still considered as non-cancelable lease only. Second thing, with the permission of lessor. If lessee can cancel the lease with the permission of lessor, still it is considered as which lease? Non-cancelable lease, and AS 19 is applicable. And also if the lessee enters into new lease for the same or an equivalent asset. So for example, you are lessor, I am lessee. We enter into an agreement, lease agreement for one particular asset. Now suppose we both are entered into a new lease for the same asset or equivalent asset. Automatically old lease is what? Cancelable, but still it is considered as non-cancelable lease. AS 19 is applicable. And last one, sir, upon the payment of additional amount, that at the inception of the lease is reasonably certain. Suppose lessee can cancel the lease by payment of additional amount. In the agreement, both the parties have written that if lessee, you want to cancel the lease, you can cancel, but you pay me this much amount. Suppose one big amount, penalty you need to pay. And we know at the inception of the lease itself that lessee is not going to cancel it, because who will ready to pay that much big amount? For example, lessor and lessee agreed that if lessee want to cancel the lease at any point of time, he has to pay 20 crore rupees or he has to pay 2 years rent as a penalty. Now will lessee cancel the lease? No, definitely. So that means at the inception of the lease itself, there is a certainty that lessee is not going to cancel it, even though there is an option for cancellation. By paying additional amount, he can cancel, but he will not. So that is a non-cancelable lease. So AS 19 is applicable for which type of leases? non-cancelable leases. But there are how many exceptions? 4. What are these exceptions? Lease is cancelable upon happening of remote contingency, or lease is cancelable with the permission of lessor. Third, new lease with the same asset, or by payment additional amount. But at the inception of the lease itself, we know that he is not going to pay that additional amount. So these are the 4 cases. Even though there is a chance that lease is cancelable, but still we need to consider it as non-cancelable lease, and we need to apply AS 19. AS 19 is applicable only for which leases? Non-cancelable leases. This is the first definition. Second, lease term. Sir, in the definition of the lease, I told you, lease is generally given for agreed period of time, 5 years, 10 years. So the standard says lease term. Lease term means 2 things, 2 components. One is non-cancelable period. Another one is renewal period. For example, you see, there is a lessor X, there is a lessee Y. X has given plant and machinery to Y on lease basis. The lease is for how many years? 5 years. This is called non-cancelable period. This is part of lease term. Plus, in the agreement, lessor has given an option to the lessee to renew this lease after 5 years. After 5 years, if you want, you can continue the lease. And if it is reasonably certain that lessee is going to exercise this continuation option, renewal option, then this renewal period, 3 years is there now, that is also included as a part of lease term. So lease term is 2 things. What are those? Non-cancelable period plus renewal period. When renewal period will be included as a part of lease term? Only if it is reasonably certain at the inception of the lease that lessee is going to exercise the renewal option. In this example, original lease term 5 years. Renewal option 3 years. So 5 plus 3, 8 years will be the lease term. So lease term is what? Non-cancelable period plus renewal period. This is the third definition. Second definition. Next. So we completed non-cancelable lease. We completed lease term. Next, inception of lease. Sir, what is inception of lease? Because just now I used the word inception. At the inception of the lease, it is reasonably certain that lessee will exercise the option. What is inception of lease? The standard says inception of the lease means the date of lease agreement, when the parties enter into lease agreement, or the date on which commitment by the parties to the principal terms of the lease, whichever comes earlier. Date of lease agreement, date on which the parties committed for the principal terms of the lease. For example, date of agreement 1st March. The parties agreed for the principal terms on 15th March. Whichever is earlier means 1st March. So this is considered as inception of lease. Because in AS 19, so many places they use the word inception of the lease. So you should understand what is inception of lease. Inception of lease means date of lease agreement or the date on which parties committed for principal terms, whichever is earlier. So this is inception of lease. And the most important definition in entire leases is MLP. What is that? MLP. Understand what is MLP. MLP means minimum lease payments. Everybody please focus. Because in accounting, MLP plays a crucial role. Sir, what is MLP? There are 2 parties in lease. Lessor, lessee. Now think from lessor point of view. Lessor is what? Owner. He is going to receive the lease rentals, right? Lessor point of view, what is MLP means? Lease rentals, fixed lease rentals he is going to receive from lessee plus residual value guaranteed by lessee or any person on behalf of lessee or by an independent third party. Plus, if lessor has given a renewal option to the lessee, if lessor has given a purchase option to the lessee, and lessee is going to exercise that purchase option, it is reasonably certain at the inception of the lease itself that lessee is going to exercise that purchase option. Once the lease is completed, you can purchase the leased asset. If that kind of option is given by lessor to the lessee, that excise price, these 3 things will be added. Then you will get MLP from lessor point of view. So lessor point of view, MLP, 3 things. One is fixed lease rentals. Second, residual value guaranteed by lessee or any person on behalf of lessee or by exercise price or by independent third party also. Residual value guaranteed by lessee, any person on behalf of lessee or by independent third party, plus excise price. What is that excise price? Lessor has given an option to the lessee to purchase the leased asset once the lease agreement is completed. You add these 3, you will get what? MLP from whose point of view? Lessor point of view. Now come to lessee point of view. Lessee point of view, what is MLP? Lease rentals he is going to pay plus residual value guaranteed by lessee or any person on behalf of lessee. That's it. Plus this excise price, whatever the price. I mean, if there is a purchase option given by lessor to the lessee, once the lease agreement is over, he can purchase the leased asset, then that excise price will also be included. So what is the difference between lessor and lessee MLP? Only one thing, that is, in case of lessor, we will consider the residual value guaranteed by independent third party. But in case of lessee, that will not be considered. Remaining everything is same only. For example, look at this example. Suppose Mr. X, Mr. Y, two parties are there. Mr. X is lessor, Mr. Y is lessee. They entered into a lease agreement for plant and machinery. Lease term is how many years? 5 years. Now look at the terms. Fixed lease rent 1 lakh per annum. That means lessee has to pay every year 1 lakh. There is a contingent lease rent also. Sir, there are two types of lease. Fixed, contingent. Contingent lease rent you should not consider. MLP calculation. Only fixed lease rent you need to consider. Fixed lease rent means what? The rent which is decided based on time. Contingent rent means what? Other than time. For example, I am giving machinery, plant and machinery on lease basis. By using this plant and machinery, how many units you are producing? On each unit produced, you give me some amount. That is called contingent rent. So contingent rents we will not consider as a part of MLP. Only fixed lease rents we need to consider as a part of MLP. And in this lease agreement, sir, lessor has given a purchase option to lessee. How much is the purchase price? 1 lakh. That means once the lease is completed, lessee can purchase the leased asset for 1 lakh. And so in this case, can you tell? And residual value is also there. What is the residual value? 1.5 lakhs. I am going to discuss what is this residual value. Wait. So residual value 1.5 lakhs. Now in this case, how to calculate MLP? First, lessor point of view, see, take lease rentals. Fixed lease rental 1 lakh into 5 years, 5 lakhs plus purchase price, excise price 1 lakh plus guaranteed residual value. Suppose for example 1.5 lakhs is the residual value. In that 50,000 is guaranteed by lessee or any person on behalf of lessee or by independent third party. Lessor point of view kuch farak nahi padta whether it is guaranteed by lessee or any person on behalf of lessee or by independent third party. Add. So 6.5 lakhs is what? MLP. From whose point of view? Lessor point of view. Now come to lessee point of view. Lessee point of view also same. 5 lakhs, 1 lakh, GRV guaranteed by him. Both the three things will be added. So therefore, but you need to remember guys, this purchase price will be included in MLP only if the lease agreement provides an option to purchase the leased asset to the lessee after the lease term. Include as a part of MLP if it is reasonably certain that lessee is going to exercise the option at the inception of the lease. Only if it is reasonably certain at the inception of the lease that lessee is going to exercise this purchase option, then this purchase price will be included. Correct? Now, so finally conclusion is what? MLP. Lessor point of view, lease rentals, excise price and residual value guaranteed by lessee or any person on behalf of lessee or by independent third party. Lessee point of view, lease rentals he pay, excise price, purchase price, residual value guaranteed by lessee or any person on behalf of lessee. So what is the extra point here coming? Independent third party. That's the only difference. Sir, what is this residual value? What is this guaranteed? I will tell you. Listen. First of all, what is residual value is, this is the estimated fair value of the leased asset after the lease term. Estimated fair value of the leased asset after the lease term. For example, sir, A Limited lessor has given plant and machinery lease to B Limited lessee for how many years? 5 years. Now, once 5 years is over, this plant and machinery, if I sell, how much I am going to get? That is called residual value. That is called residual value. For example, lessor is expecting that once 5 years lease is over, if I sell this plant and machinery, I am going to get 1 lakh. This is called residual value. But the problem is, whether actually I will get 1 lakh or not depends on what? How this asset is going to be utilized by lessee. For example, I have given an asset to you, plant and machinery. Suppose if you are not utilized properly, if you are not maintained properly, what happens? I am generally expecting if you use this asset properly, proper service done, everything done, after 5 years, if I sell this asset, I am going to get 1 lakh rupee. But suppose if you don't utilize this asset properly, no proper maintenance, maybe I will get less than 1 lakh. Maybe I will get less than 1 lakh. So to ensure proper utilization of my asset, I will tell to the lessee that, see lessee, I am giving asset to you on lease basis for 5 years. Once 5 years over, I am going to get 1 lakh rupee. So will you give guarantee that this 1 lakh will be recovered? He said, lessee said, sir, I am giving guarantee up to 50,000. That means after 5 years, if the residual value is below 50,000, the gap will be given by lessee. For example, after 5 years, the residual value is 40,000 only. But lessee given a guarantee up to 50,000. So 10,000 will be given by lessee to the lessor. Hello. So therefore, residual value guaranteed by lessee means what? He has given a guarantee up to that amount. Suppose if the residual value is below that, he will give the balance to the lessor. Because I am the owner, sir, I am lessor. I don't want to take any loss. If you don't utilize the asset properly, what happens? My residual value will decrease. That's why I am taking guarantee from you. For example, in this case, the expected residual value is 1 lakh. Lessee has given a guarantee up to 50. Remaining is what? Unguaranteed residual value. Remaining is unguaranteed residual value. Now think from lessee point of view, how much he has given a guarantee? 50. Lessor point of view, 50. Sometimes what happens now, on behalf of lessor, see for example, lessor is A Limited now, he is selling the cars or he is selling buses of a Tata Motors for example. Now the company itself has given a guarantee to lessor. Lessor, you don't worry. If lessee has not given a guarantee now, we are going to give a guarantee to you. In order to encourage your business, because you are selling our assets, right? You are selling our assets on lease basis. So if lessee has not given a guarantee for residual value, we will give. That's how guaranteed residual value by independent third party came. Independent third party means not lessee or not any person on behalf of lessee. Some other third party may also give guarantee to the lessor. That means what? For example, if lessee has not utilized the asset properly, if you are going to get less than residual value, expected residual value, since we have given a guarantee to you, we will fill that gap. Of course, we will give the amount only to the extent guarantee we have given. If the actual residual value is more than the guaranteed amount, we don't give any amount. Hello. That's it, sir. This is the concept of residual value. So tell me, what is MLP? Come on, final conclusion. What is MLP? Lessor point of view, lease rentals, excise price, residual value guaranteed by lessee or any person on behalf of lessee or by independent third party. I explained the independent third party also. Why independent third party came into picture? Because lessee sometimes will not give guarantee. Therefore, maybe lessor in a loss position. If you don't mind, see, I am selling assets of a manufacturer on lease basis. I am asking guarantee of the lessee. Lessee, please utilize this asset properly. If you don't utilize now, my realizable value will be less. My residual value will be less. But lessee says nothing doing. I don't give guarantee. Then third party come into the picture and will encourage the lessor. Don't worry, lessor. Since you are selling our products, you are giving our assets only on lease basis, finance basis, we will give guarantee. That if lessee has not given a guarantee, we will give a guarantee. If the expected residual value is less, we will compensate you to the extent of the guarantee we have given. Okay. So lessee point of view, lessor point of view. Lessor point of view, lease rentals, excise price, residual value guaranteed by lessee, any person on behalf of lessee, third party. But lessee point of view, lease rentals, excise price, residual value guaranteed by lessee, any person on behalf of lessee. Independent third party, lessee is not connected. Lessee is no way bothered. Lessee point of view, either he has to give or any person on his behalf. On his behalf, maybe a bank, maybe a financial institution, or maybe any other institution may give. Sometimes lessee on behalf of lessee, guarantee is given by any other person. That is only he will consider. If independent third party given a guarantee, that will not be included in lessee's MLP. Okay, so most important definition we have completed, sir, because I am going to use it in so many places, sir. This MLP you have to see. Okay, now next, so in the definition, sir, we have completed non-cancelable lease term, MLP, inception of lease, residual value, guaranteed residual value, unguaranteed residual value. So residual value to the extent given by guarantee, guaranteed, remaining balance unguaranteed. Next, gross investment. Here also important definitions are coming, sir. Gross investment, everybody please see. You need to remember three formulas here. Three formulas. Please remember these three formulas. First formula you need to remember is gross investment. What is the formula? Gross investment in the lease. Sir, gross investment in lease is equal to MLP plus UGRV. MLP plus UGRV. And these are all calculated from lessor point of view. These are all calculated from whose point of view? Lessor. He is the owner, right? So gross investment in lease means MLP plus UGRV. What is MLP? From lessor point of view, lease rents plus excise price plus residual value guaranteed by lessee or any person on behalf of lessee or by independent third party. Simply speaking, GRV. So lease rent plus GRV is equal to MLP. Excise price, purchase price, if it is given, that will also be added. Generally it won't given. So only two things, lease rent plus GRV. Then you will get MLP. To this, if you add UGRV, you will get gross investment in lease. So gross investment in lease means, what is the formula? MLP plus UGRV. What is MLP? Lease rents plus GRV. Lease rents plus GRV. And so gross investment in lease means, what is my lease rentals I am getting? What is my gross investment? Guaranteed residual value. What is my unguaranteed residual value? You add everything, you will get gross investment in lease. What is net investment in lease? Listen, simple. If entire these things are converted into present value, that is called net investment in lease. So what is net investment in lease? Present value of MLP plus UGRV or present value of GIIL, gross investment in lease. Present value, because lease is relating to futures. These are all the lease rents, guaranteed residual value, unguaranteed residual value. These are all relating to future. I convert them into present value. I will get net investment in lease. Now the difference between these two is unearned finance income. The difference between gross investment in lease, net investment in lease is called what? Unearned finance income. So simple three formulas. Gross investment in lease. Gross investment in lease, what is the formula? MLP plus UGRV. MLP means lease rent plus GRV. Okay. What is net investment in lease? Present value. Present value of gross investment in lease. That means present value of lease rent, present value of gross, GRV, present value of UGRV. You convert everything into present value, you will get net investment in lease. The difference between gross and net is called unearned finance income. Unearned finance income. So gross investment in lease minus present value of gross investment in lease. The difference, or gross investment in lease minus net investment in lease. Everything is same only. You will get the unearned finance income. Sometimes in the question they will ask unearned finance income directly. You need to calculate unearned finance income. They will ask, I will show the questions also. Unearned finance income they will ask directly in the examination. Now, sir, okay. Sir, you said present value of MLP plus UGRV is net investment in lease. In order to convert into present value, which discount factor I will use? The standard says there are two choices. I mean, the most important, the first choice is, 1 minute, sir. So the standard, what is the present value discount factor we need to use? Discount factor we need to use is, to find the present value, interest rate implicit in the lease. What is it? Interest rate implicit in lease. Or if this is not available, then lessee's incremental borrowing rate. Lessee's interest rate implicit in the lease, interest rate implicit in the lease, or lessee's incremental borrowing rate. Sir, what is interest rate implicit in the lease? Sir, the interest rate implicit in the lease is the rate, the discount rate at which the present value of MLP plus UGRV is equal to fair value of the leased asset. At what discount rate the present value of MLP plus UGRV is equal to fair value of the leased asset, that is called interest rate implicit in the lease. And you need to check it at the inception of the lease. So at the inception of the lease, if the present value of MLP plus UGRV is equal to fair value, then that is the rate is called interest rate implicit in the lease. Now by using this discount rate, I need to find out these present value factors. Sometimes in the question, sir, they won't give this rate, we need to find out. Now to find out this interest rate implicit in the lease, this is the formula you need to take as a base. So tell me, what is interest rate implicit in the lease? It is the rate at which the present value of MLP plus UGRV is equal to fair value of the leased asset. Correct? Okay. So interest rate implicit in lease is the present value of MLP plus UGRV is equal to fair value of the leased asset at the inception of the lease. So these are the definitions, sir. Total definitions in the standard. We have completed all the definitions. The contingent rent, economic life, useful life. Economic life means what? The total life of the asset. Useful life means the life which is covered in lease. For example, asset life is 10 years. Economic life, I have given the asset on lease for 5 years. So useful life for 5 years, economic life which can be economically useful for 10 years. Okay. Now see, since we have completed all the definitions, the next one is what? Types of leases. I told you there are two types of leases. What are those? Finance lease, operating lease. What is finance lease? Risks and rewards will be transferred. That means it is much more than just a rental agreement. I am transferring risks and rewards. That means I am selling the asset to you. But you are not making the payment at a time. You are making the payment over a period of time in the form of rents, lease rents. That is finance lease. So in finance lease, as a lessor, I will treat this as a sale. I am selling the asset on credit basis. So I will, in my books, I will recognize the amount receivable as my asset. I will de-recognize the asset from the books since I am selling the asset to you. As a lessee, what you do? Lessee, you will recognize the asset, leased asset, as your own asset, and whatever the amount you are required to pay to the lessor will you recognize as a asset, liability. So lessee will recognize asset, liability. Lessor will recognize amount receivable from the lessee, and then asset will be de-recognized in his books. That is at the inception of the lease. On the first day of the lease, this is what they will do. Okay. But if you look at the standard, sir, the standard has given some indications, sir. Important, sir, these indications, they may ask a question. They have given some indications which says the lease is considered as which lease? Finance lease. Some indications or some conditions are given. 5 conditions are there, sir. If these conditions are there, if these conditions are presented, if any one condition is met, then that lease will be considered as which lease? Finance lease. See these conditions. First condition number 1, automatic transfer. For example, the transfer of leased asset to lessee after the lease term. Suppose in the lease agreement, sir, they have written that once the lease is over, automatically the asset will be given to lessee. This is called automatic transfer. If this condition is there in the lease agreement, that is finance lease. Second, lease agreement is providing option to the lessee to purchase the leased asset, and that too at a price which is below the fair value. And at the inception of the lease, it is reasonably certain that lessee is going to exercise such an option. Lease agreement provides purchase option to the lessee to purchase the leased asset once the lease is completed, that too at a price which is lower than the fair market value, and it is reasonably certain that lessee is going to exercise such option. Then if this kind of option is there, then also that lease is which lease? Finance lease. And third important thing, sir, if the lease term occupies the major part of the economic life, suppose the economic life 10 years, lease life 8 years, 80% of the life is covered in lease, this is also finance lease. Fourth, at the inception of the lease, if the present value of MLB is equal to fair value of the leased asset, then also that lease is which lease? Finance lease. And last one, the leased asset is of which nature? Specialized nature. Special nature asset, I have given asset on lease basis to you. Only lessee can use it without any major modifications. So that kind of lease is also what lease? Finance lease. For example, lessor has given a factory on lease basis to B Limited. This factory was exclusively constructed or modified according to the B's requirement. That means this is asset of which nature? Specialized nature. Only B can use it. Anybody wants to use this, they have to make a major modifications. Without major modifications, only B can use it. Therefore, in that situation, this lease is considered as finance lease. So if the lease agreement provides any one of these 5 conditions, then that lease is considered as finance lease. First one, automatic transfer. Second, purchase option is there in the lease agreement, and it is reasonably certain that lessee is going to exercise such option. Third, the lease term occupies the major part of the economic life of the leased asset, and at the inception of the lease, the present value of MLB is equal to fair value of the leased asset. Then also that lease is called finance lease. And the asset given on lease is which nature? Specialized nature. Only lessee can use it without any major modifications. Then that situation, the lease is called what? Finance lease. Finance lease. Okay. Now, sir, see this example in the study material, sir. Important example. Everybody. Suppose annual lease rent, sir, 50,000 at the end of each year. Lease period 5 years. GRV 25 and UGRV 15, unguaranteed residual value. Fair value at the inception 2 lakhs. That means at the inception of the lease, the fair value of the leased asset is 2 lakhs. Interest rate implicit in lease not given. So interest rate implicit in the lease not given. When it is not given, how to calculate? What is interest rate implicit in lease? I told you. Interest rate implicit in lease is present value of MLP plus UGRV is equal to fair value. At what rate it is equal to fair value? So fair value is 2 lakhs. So at what present value? The present value of MLP plus UGRV is equal to fair value. At what discount rate both will be equal? That rate is called interest rate implicit in the lease. Now sometimes they won't give. We need to find out. How to find out? Simple. First I assume 10%. Suppose discount rate is 10%. Okay. Now see this. Present value of MLP unguaranteed residual value at a 10% discount rate. First year total 5 years, right? Lease rent 50, 50, 50, 50, 50. Fifth year we need to add in MLP. GRV is also there. GRV how much? 25. So GRV added. And UGRV also we need to take. Last year 15,000. Discount factors 10% discount factor, usually they will give in the question. Find out present value. How much came? 2,14,340. But I want how much? 2 lakhs. 2 lakhs. Fair value is 2 lakhs. But the present value of MLP plus UGRV is 2,14,340. That means 10% discount rate is not correct. Hello. Now next I assumed 14%. Next I assumed 14%. Why I assumed 14%? Because when I increase the discount rate, the present value will decrease. See, actually how much I got here? 2,14,340. I want how much? 2 lakhs. That means I need to reduce, right? If I need to reduce the present value, I need to increase the discount rate. That's why. So I assumed 14%. You can assume 15% also. I assumed 14%. Now at 14% discount rate, I find out the present value. How much came? 192,360. So at a 10% discount rate, 2,14,340. At a 10%, 192,360. That means 2 lakhs is in between these two. So by using the concept of interpolation, you know that concept of interpolation? Like for example, see, first I will start with 10% plus. What is the difference between these two? Difference between these two, 2,14,340 minus 192,360. This is the total difference. And the difference I want to achieve from 2,14,340 to 2 lakhs. Hello? The total difference 2,14,340 minus 192,360. Correct? 21,980. But the difference we want is 14,340. So therefore simple, sir. The difference between these two is 10, 4, 14, 4%. So 4% into 14,340 divided by 21,980. So proportionately you take 4 into 14,340 divided by 21,980. How much we got? 2.6. 10% plus 2.6. So total 12.6 is the discount rate at which the present value of MLP plus UGRV is equal to fair value of the leased asset. So this is how you need to ascertain, sir, by using the concept of interpolation. I think this is there in the FM also. How to find out the IRR, nothing but internal rate of return. So we don't know the IRR, therefore we need to find out it by using the concept of interpolation. Same thing. First I assume 10%, find out the present value. Next 14% present value. I have seen the difference. But what is the difference I need to cover? If I start with 10%, the difference I need to cover is 14,340. The difference between these two is 21,980. So the difference is 4. So therefore proportionately you take 2.6. So 10 plus 2.6, it is 12.6 rate. That means 12 at a 12.6% discount rate, the present value of MLP plus UGRV is equal to fair value. Fair value of the leased asset. Okay. Next, now come to accounting part, sir. So I told you in this standard, first we completed objective, scope, definitions we have seen. Next, accounting. Types of leases also we covered now. Types of leases, finance lease, operating lease we covered. Next, accounting treatment we will see. Accounting treatment, important. First we will see which leases? Finance lease. Which lease? Finance lease. That too lessee books we will see. Lessee books to finance lease. Sir, lessee. Lessee means the person who has taken the asset on lease basis. Now tell me, you are the lessee, you have taken the asset on lease basis, and that lease is finance lease. I told you, based on substance or form, when you take any asset on lease basis, and if that is lease is finance lease, lessee point of view, it is kind of a purchase. So therefore, in his books, lessee will recognize the asset as well as liability. Liability means the amount he is required to pay to the lessor. And asset, whatever the asset he is taking on lease basis, that asset he will recognize in his books. So at the inception, what is the entry lessee will write? Asset to lessor account or lease liability. Asset to lessor or lease liability account. At what value he will recognize this asset and liability? The standard says the fair value of the leased asset at the inception of the lease or present value of MLP from lessee point of view, because we are doing lessee books. Whichever is lower. They will ask a separate question on this. So lessee point of view, whenever he has taken any asset on finance lease basis, he will recognize the asset as well as liability. At what basis? At the inception of the lease. On at what amount? Fair value or present value of MLP, whichever is lower. Whichever is lower. So this is the entry he will write. At this value he will recognize at the inception of the lease. Next, come to year end. Sir, you are the lessee. You need to pay lease rentals every year. So on your lease rent, whatever the interest portion is there, that interest portion you need to recognize. As a lessor, I am paying lease rents. In that lease rent, there are two components, principal, interest. Sir, finance lease, I am just purchasing the asset on finance basis. That means the lessor is selling the asset to me, I am purchasing, but I am not paying the amount at a time. I am paying the amount over a period of time in the form of installments. So definitely there is an interest component in the lease rent. So therefore, as a lessee, what I need to do is every year I need to calculate the interest component which is included in the lease liability or lease rent. How to find out, sir? See this. At the end of the year, over the lease term, apportionment of the finance charges and principal repayment. So first year, what is the opening lease liability? You take it. On that apply interest, you will get finance lease. What is the actual rent you are paying? Lease rent. Next, opening plus interest minus lease rent paid, you will get closing lease liability. Again, this closing lease liability interest will be calculated on the next year. Like that, every year, what is the liability, lease liability outstanding, on that I need to calculate interest. So from the lease rent, this interest will be separated. I mean, this interest will be recognized separately. So lessee point of view, finance charge is nothing but interest now. Interest is what? Expenses for him. So he will write finance charge to lease liability. He will write finance charge to lease liability. This finance charge will be transferred to P&L account, being an expenses. And next he will make the payment of lease rental. When he makes the payment, what is the entry? Lease liability to bank. And he will claim depreciation on the asset. Because in finance lease, he is taking the asset. He is recognizing the asset. So therefore, he will claim the depreciation. So what is the entry for depreciation? Depreciation to asset account. So that's it, sir. These are the entries will come in the books of lessee. Hello? For example, you see, sir, here. Illustration 1 you see. Suppose S Square Private Limited has taken a machinery on which lease? From SK Limited. So S Square is what? Lessee. SK Limited, lessor. The information is under lease term 4 years. Fair value 20. Lease rent 6,25,000 per annum at the end of the year. Guaranteed residual value 1,25,000. Expected residual value 3,75,000. The difference is unguaranteed residual value. Correct? This is residual value. This is guaranteed. The difference is unguaranteed residual value. Implicit interest rate 15%. Discount rates also given. First year, second year, they will give discount rates also for this 15%. What they are asking is this. Calculate the value of lease liability as per AS 19. So in the books of lessee, you need to calculate the value of lease liability. Just now I told. Here, this is first which type of lease? Finance lease. Whose books we need to find out the liability? Lessee books. At what value we will recognize liability? Fair value or present value of MLP, whichever is lower. Now, what is the fair value? 20 lakhs. I need to find out present value of MLP. MLP means lease rent plus GRV. GRV. So, find out the present value. See this. 1, 2, 3, 4. Total 4 years. Every year lease rent is how much? 6 lakhs 25. So 6 lakhs 25, 6 lakhs 25, 6 lakhs 25. Last year 6 lakhs 25 plus guaranteed residual value. What is guaranteed residual value? 1 lakh 25. Total 7 lakh 50. See this, 7 lakh 50. Present value factors they have given in the question itself. Convert into present value. How much we got? 18 lakh 55,850. This is the present value of MLP from lessee point of view. What is the fair value? 20 lakhs, whichever is lower. 18 lakh 55,850. So this is the liability he will recognize. Lessee will recognize the asset and liability at 18 lakh 55,850. Everybody. Next. And also, sir, see this. For example, sir, look at this illustration. Example number 2. Lease rents 50,000. Lease period 5 years. Guaranteed residual value 25. Unguaranteed 15. Fair value at the inception 2 lakhs. Interest rate implicit 12.6. Now, if you are a lessee, how you will do the accounting treatment? First, you ascertain the present value of MLP. 1,91,500 came. Plus, what is the fair value? 2 lakhs. Whichever is lower. So, therefore, he will write asset to lessor. 1,91,500, 1,91,500. This is at the inception of the lease, lessee will do. If it is a finance lease. Now, I told you at the end of every year what he will do. Interest he will recognize. What is the entry? Finance charge to lessor. When he make the lease payment, lessor to cash or bank. So, therefore, how to find out it? See this. First liability 191,500. On that 12.6% you apply. See this. 191,500 into 12.6. How much came? 24,129. So this is the interest on this 50,000. So therefore the entry for this is 24,129. At the end of the first year we will write finance charge account debit to lessor 24,129. 24,129. And you will make the payment of lease rent lessor to bank 50/50. And this 24,129 will be transferred to P&L account every year. I mean this year P&L account debit to finance charge because it is a interest. So like this every year they calculated interest. See this. Next year 20,869 they calculated. How they got it? Simple. What is the principal amount outstanding? 165,829. 629. For example, see opening 191,500 sir. In that 50,000 is the lease rent. In that 24,129 is the what? Interest. Principal portion 25,871. So from 191,500 I reduce 25,871. So I will get 165,629. Like that every year I need to find out the outstanding. Only principal amount I need to reduce from the lease rent. Interest will be transferred separately to P&L account. And on that outstanding amount I need to calculate interest. So this is the accounting treatment in the books of whom? Lessee. When the lease is which lease? Finance lease. The most important point is at what value lessee will recognize the asset and liability. Fair value, present value of MLP, whichever is lower. That is the point you need to remember. Now come to lessor books. Lessor is giving asset on lease basis and that lease is finance lease. So I told you based on substance or form, lessor will recognize this as a sale. As if he is selling the asset to you, he will recognize. So tell me, whenever you sell the asset, what is the entry? Sell. When you sell the asset on credit basis, what is the entry? Debtor to sales. Here debtor is lessee. The amount is collected from lessee. Instead of sales, I will write asset. I will de-recognize the asset from lessor books because he is giving the asset on finance lease, and whatever the amount receivable from lessee, that he will recognize as a asset. So therefore, lessee will de-recognize the leased asset from his books. No depreciation in his books. Recognize lease receivable at a what amount? Net investment in lease. So lessor, the entry he will write is this one. Lease receivable account debit to asset account. At what value he will recognize, sir? Net investment in lease. What is net investment in lease? present value of gross investment in lease, or present value of MLP plus GRV plus UGRV. Everything you add, you will get the net investment in lease. Everything of gross investment in lease, if you convert into present value, you will get net investment in lease. Okay. Next, every year, this is at the inception of the lease. Now every year end, what lessor will do? Lessor will recognize the interest income. From his point of view, interest income. So for finance income, he will write lease, receivable. That means lessee account debit to finance income account. For him, interest is income, right? So he will credit finance income, and later on it will be credited to P&L account, transfer to P&L account. And when he receive the lease rent, bank account debit to lease rent account. Bank to lease rent. So at the beginning, what is the entry? Amount receivable, lessee or lease receivable account debit to asset account. At what value? Net investment in lease. Every year end, what are the entries? Finance income. What is the income? Interest income. So interest income entry is what? So lease receivable or lessee account debit to finance income. This finance income will be credited to P&L account at the end. And when he actually receive the lease rent, bank to lease receivable or lessee account. Hello? Now, suppose, sir, in case of finance lease, if there are any initial direct cost, any expenses incurred for lease, like any agreement expenses, some expenses will be incurred, na, sir, at that, whenever two parties enter into lease agreement, some expenses will be incurred. Those are called initial direct cost. Okay. These agreements, these cost, what we need to do? See, simple. If these costs are paid by lessee, added to the cost of the asset. If these expenses are incurred by lessor, charge them to P&L account, or defer the expenses, charge to P&L, or defer the expenses and charge to P&L account over the period of lease. For example, lease period is 5 years. Charge these expenses to P&L account over a period of 5 years, or directly you can charge to P&L account. Two options given. Either you charge these initial direct cost you incurred to P&L account because you are incurred, these are incurred by lessor, or you can defer these expenses and charge to P&L account over the lease term. So this is which lease? Finance lease. Okay. Now come to operating lease, sir. Sir, what is operating leases? I told operating lease is kind of a normal rental agreement. Therefore, what lessee will do? He will recognize interest every year, whatever the lease rent he is going to pay as a normal expenses. But here the important point is, see, whenever the lease is operating lease in the books of lessee, no asset is recognized, no depreciation he will claim. But in case of finance lease, lessee will recognize the asset to liability, he claims the depreciation. But in case of operating lease, he don't recognize any asset, because risks and rewards are there with whom? Lessor only. No depreciation will be claimed. Whatever the lease rents he is going to pay, he will recognize them as expenses in P&L account. On what basis? Either on straight line basis or any other systematic basis. This is very, very important. Lessee will recognize the lease rentals as his expenses, either on straight line basis or any other systematic basis. Sir, what is this any other systematic basis? See this. For example, sir, there is a missionary. Yeah, suppose there is a mission which is taken on lease. The lease is operating lease. Lease period is 3 years. That mission is gives an output of 10,000, 20,000, 50,000 for 3 years. Lease rent first year 25, second year 45, third year 50. Total lease rent for 3 years 1,20,000. Now see this. According to the agreement, what are my lease rents? 25, 45, 50. Total 1,20,000. 1,20,000 divided by 3. 40,000. This is called straight line method. Can I recognize every year 40,000? This is operating lease. The lease rentals will be recognized as an expenses either on straight line basis, any other systematic basis. Here straight line method I cannot apply because I will see the cost benefit. Here what is the output I am producing? So based on this output I need to recognize the rental expenses. For example, you see output 10, 20, 50, total 80,000, correct? So see, total 1,20,000, first year output 10,000, divided by total output 80,000. Proportionately you take for first year. 1,20,000 into 10,000 divided by 80,000. How much came? 15,000. So this is the lease rent for the first year, 15,000. But actually, as per agreement, how much I am paying? 25,000. Therefore, the difference is transferred to an account called lease equalization account. So therefore, first year, what are the entry I will write now? Lease rent account debit 15,000, lease equalization account 10,000, to lessor account 25,000. And I will pay lessor to bank 25. That means I am paying 25, but actual expenses 15. So extra I paid 10,000 will go to lease equalization account. This is kind of a prepaid expenses for me. This is my asset. Second year you come. Based on output, what is my lease rent? 30. So I will recognize lease rent 30. But second year, how much I am paying? 45. Another 15,000 will be transferred to lease equalization account. So lease rent account debit, lease equalization to lessor. When you make the payment, lessor to bank. Now come to third year. What is the lease rent as per output? 75. So lease rent account 75. But what is the rent I am paying? 50. So therefore, you see, lease rent 75, lessor 50. That means whatever the lease equalization account already debited will be cancelled, 25,000. Therefore, by the end of the lease term, the lease equalization will become nil. So simple, sir. Here, how lease rents are recognized, sir? Based on the output. Either straight line method or any other systematic basis. Here the systematic basis is available. When systematic basis is available, recognize the rent based on that only. Here output is available. Based on the output you recognize 15, 30, 75. If you make total, it will be 1,20,000 only. Hello? But the difference, what is the difference between the lease rents we are recognizing and paying? That is transferred to a separate account called lease equalization account. That lease equalization account, first 2 years debit to debit. Debit means asset. Last year it was cancelled. Because last year your expenses 75, but you paid only 50. That means that 25,000 already paid. Extra paid. Now it is cancelled. This is how you need to recognize, you need to do the accounting in the books of lessee when it is which lease? Operating lease. So if the lease is operating lease, he will recognize lease expenses every year on straight line basis or any other systematic basis available. Come to lessor, sir. When he give any asset on lease basis, which lease? Operating lease. What he will do? He will recognize income every year. Just lessee is recognizing every year lease rentals as expenses. Na? Lessor will recognize every year whatever the lease rents he is going to receive from the lessee. So lease rentals will be recognized as income on straight line basis unless any other systematic basis is available. For example, one important question is there in the study material. I will show you. Yeah. This question you see, sir. This question you see example. Suppose outputs from the mission of economic life of 6 years are estimated. There is a mission, sir. This mission is gives output for 6 years. 10,000 in year 1, 20,000 units in year 2, 30,000 units in year 3, 40,000 year 4, 20,000 units in year 5, 5,000 units in year 6. Okay. The mission was given on 3 years which lease? Operating lease. By a dealer of the mission for equal annual lease rentals to yield how much? 20% profit margin on cost of 5 lakhs. So 5 lakhs plus 20% margin. So it will be 6 lakhs. 6 lakhs. What is the total output for 6 years? 1 lakh 25. You add output for every year. 1 lakh 25. And how many years you are giving for lease? 3 years. 10, 20, 30, 60,000. So proportionately, what will be the amount? 6 lakhs divided by 1 lakh 25 into 60. How much, sir? 2 lakh 88,000. 2 lakhs 88,000. See this, 2 lakh 88. This is the total lease rent. But here, the amount is collected in equal annual lease rents. So 2.88 divided by 3. How much it is? 96,000. That means 96,000 every year. As a lessor, my lease rent is 96. But I have to recognize based on output. Based on output. Here output is I know. First year output, second year 20, third year 30. So therefore, this 96,000 every year. That means total 2.88 lakhs is there now. This 2.88 lakhs, see based on output. 10,000 into 60,000, 48,000. 2 lakh 88 into 20,000 divided by 60, 96,000. Third year 2,88,000, 30,000 divided by 60, 1,44,000. This is how I will recognize the lease rentals. First year 48, second year 96, third year 1,44,000. See this, based on output I will recognize. Here depreciation, how I will calculate? Sir, in case of operating lease, the asset is there with lessor only. So who will claim depreciation? Lessor. So how he is going to claim the depreciation? Here the cost of the asset is how much? 5 lakhs. Here depreciation is calculated based on the output he has given. Straight line depreciation in proportion to output. So output proportion you see 10,000, 20,000, 30,000, 40,000, 20,000, 5,000 in this ratio 10, 20, 30, 45. So therefore depreciation 5 lakhs into first year output 10,000 divided by total output 1 lakh 25. So proportionately you take how much came? 5 lakhs into 10,000 divided by 1 lakh 25. 40,000 is the first year depreciation. Like that you need to provide depreciation every year. So therefore as a lessor he will write entries like this. At the end of the year he recognized the amount receivable from lessee at 96. But actually according to the agreement what is the lease rent? 48. So therefore remaining will be transferred to lease rent, lease equalization account. See this actual rent 96. But according to the output the lease is how much? 48. So therefore this is my actual revenue 48. This will go to P&L account. But I receive 96 from lessee. Bank to lessee 96. So the extra amount I am receiving now 48,000, it is like lease received in advance, is kind of a liability for me that will be transferred to lease equalization account. So every year I have to recognize like this. Okay. And I will claim depreciation, sir. See 40. This depreciation will go to P&L account. So this is the accounting treatment in the books of lessor when the lease is operating lease. And the last concept of this standard is sale and leaseback transactions. What is that? Sale and leaseback transactions. Now before sale and leaseback transactions I would like to solve some questions here. I will come back to it. Wait. So first question I done. Second question you see illustration number 2, everybody in the study material. Prakash Limited leased a mission to Badal Limited on the following terms. Fair value of the mission 28.3, lease term 5 years, lease rental per annum 8, guaranteed residual value 1.6, expected residual value 3, internal rate of return 15, discount rates given. What they are asking? Ascertain unearned finance income. Can you tell me how to ascertain unearned finance income? Unearned finance income is equal to gross investment in lease minus net investment in lease. Or else I can say gross investment in lease minus present value of gross investment in lease. Correct? What is gross investment in lease? Gross investment in lease is equal to MLP plus UGRV. Correct? MLP is nothing but what? Lease rent plus guaranteed residual value. So therefore the formula is lease rent plus guaranteed residual value plus unguaranteed residual value. If I add all three I will get gross investment in lease. So see this question, lease rents how much? 8 every year, like this 5 years. So 8 into 5 40. Hello, plus what is the guaranteed residual value? 1.6. So take it, plus what is the unguaranteed residual value? See this, residual value 3 minus guaranteed 1.6, so 1.4. See this, so you will get 43 lakhs. This is gross investment in lease. Now I want present value of this. Present value factor is given in the question na? So take it, convert them into present values. So all these amounts, lease rentals, 5th year GRV and UGRV also, because GRV, UGRV also part of gross investment in lease. Convert them into present value. You got how much? 28 lakh 30,920. So the difference between gross investment and the present value of the gross investment is 1469.80. This is called unearned finance income. Unearned finance income. Okay. Sir, you should remember this is a marathon, not a complete session. Please understand, marathon this is, leases. Usually this standard is a very big standard, you know this. Okay. Now come to scenario based question, sir. This question very, very important, sir. See this, classify following either operating or finance lease. You have to tell me. First, lessee has an option to purchase the asset at lower than fair value at the end of the lease term. Suppose if the lease agreement providing an option to the lessee to purchase the asset at a price lower than the fair value, that is which lease? Finance lease. I told you if this option is there in 5 conditions I told. Second condition. So finance lease. Second, economic life of the asset 7 years. Lease term 6 years. But asset is not acquired at the end of the lease term. Sir, third condition. For if the useful life, I mean lease life covers the major part of the economic life. So here economic life 7, lease life 6. So 6 divided by 7 into 8. So 85%. So that means it is covering major part. So it is which lease? Finance lease. Next, economic life of the asset 6. Lease term is only 2 years. But the asset is of special nature and has been approved only for use of the lessee. So I told you if the asset is of special nature, that lease is finance lease. And last one, present value of MLP X, fair value of the asset Y. So I told you if the present value of MLP is equal to fair value, that lease also which lease? Finance lease. So therefore in this case if X is equal to Y, this is called finance lease. Everybody? This question, sir, this question, 13th question, you see, important question this is. Same, mostly repeated questions will be there here, sir. Yeah, this question already asked in exams also. Same question, question number 3. It was there in the study material. So please solve study material questions. Come to question number 13. B and P Limited availed a lease from N and L Limited. The conditions of the lease term are lease period 3 years. In the beginning of the year 2009, the equipment costing 10 lakhs and has an expected useful life of 5 years. The fair market value is also 10 lakhs. Property reverts back to the lessor on termination of the lease. Once the lease is completed, the asset is given back to the lessor. The unguaranteed residual value is estimated at 1 lakh at the end of the year 2011. Okay. 3 equal annual payments are made at the end of each year. IRR 10%. The present value of 1 rupee due at the end of third year at a 10% rate of interest is 0.7513. The present value of annuity of rupee 1 due at the end of the third year at a 10% IRR is 2.4868. State whether the lease constitutes finance lease and also they are asking unearned finance lease. So they are asking whether the lease is finance lease or operating lease. So first thing you need to understand is what is the expected life? 5 years. What is the lease period? 3. So 3 divided by 5, 60%. That may be one of the parameter, but that is not sufficient. We have to see some other parameter. What parameter you will check here? Present value of MLP is equal to fair value. Fair value is how much? 10 lakhs. Find out present value of MLP. What is MLP? Lease rent plus guaranteed residual value. Hello. So therefore, see this. First, they are saying that cost of the equipment you take. Unguaranteed residual value given 1 lakh. Convert this 1 lakh into present value. 75,130. Unguaranteed means which is not going to be realized, which is not going to be guaranteed. So from this 10 lakhs reduce 75,130. Therefore 9,24,870 is the present value of lease rentals. Present value of lease rentals. What is the total present value factor? 2.4868 for all discounting factors adding together. So 9,24,870 divided by this. So I will get annual equal installment. See this annual lease payment 371,911.70. Sir, the important point in this question is you need to understand unguaranteed residual value I need to deduct from the cost of the asset. Then I will get the remaining amount. That is the amount I am going to collect it in the form of lease rentals. So I need to divide it with the total annuity factor. Here they are given an IRR 2.4868. Then I will get the annual lease rent. So I know every year the lease rent is 3,71,911.7. See this. The present value of the lease payment, that is 924,870, which is equal to 92.48% of the fair market value. Therefore, the present value of the minimum lease payments substantially cover the fair value of the leased asset. Because the fair value of the leased asset is how much here? 10 lakhs. What is the present value of MLP? 9,24,870. So 92% covered. Parameter 2 you see. The lease term covers the major part of the life of the asset. So therefore it constitutes which lease? Finance lease. Now they are asking unearned finance income also. How to find out unearned finance income? Simple. First to take the total lease payment. 3,71,911.7 into 3 minus add unguaranteed residual value. You will get gross investment because gross investment is MLP plus UGRV. MLP means lease rentals. including guaranteed residual value. Now unguaranteed residual value I added. Now present value of the lease payments is 10 lakhs, which is nothing but the fair value. The difference is unearned finance income in this question. So please check this question once, sir. Okay. Remaining questions and all very easy, sir. Once you solve them, I think you'll understand. Okay. Now come to the last concept of this standard, sir. That is sale and leaseback transaction. See, listen. Most of the students are leaving this concept, but in examination they're testing. This is not difficult, easy only. Listen. What is sale and leaseback transaction? See, I am selling my asset. Upon the understanding that the same asset again I will take it on lease basis. So here the lease, sale and lease both are interconnected. All this is negotiated as a single package. For example, Mr. A is there, Mr. B is there. Mr. A is selling his asset to Mr. B. Upon the understanding that the same asset will be taken on lease basis. This is called sale and leaseback transactions. So therefore, this is a kind of a finance arrangement between the parties. For example, I want money, sir. Mr. A want money. He will show in his books that he sold the asset to Mr. B. Okay. So he has taken the amount from Mr. B. And the same amount he will pay by lease rentals, by taking this asset as a lease. So it is kind of a finance arrangement. So therefore, here what happens? Mr. A initially seller. Now he becomes lessee. Mr. B initially buyer. Now he becomes lessor, buyer lessor. So, sir, in case of sale and leaseback transactions, what is the accounting treatment, sir? Here there are two transactions, right? One is sale. Whenever sale happens, what will come? Profit or loss. So we need to understand profit or loss accounting treatment. Second, lease. What is the lease accounting treatment? Just now we covered. If the lease is finance lease, if the lease is operating lease. If the lease is finance lease, lessee books to lessor books. If the lease is operating lease, lessee books, lessor books. So that means this lease is already covered. The thing we need to focus is on what? Profit or loss on sale. Profit or loss on sale. Okay. So now the standard says, sir, the profit or loss on sale of asset under sale and leaseback transactions depends upon the type of leaseback involved. What is the type of leaseback involved? Whether the seller lessee, the seller selling the asset, same asset is taking back for lease, right? If the lease is finance lease or operating lease, depending upon that, the accounting treatment of profit or loss on sale of asset will depend. Because I told you both are interconnected. Hello? Now see this. Suppose if the leaseback is a finance lease, the standard says if the leaseback is a finance lease, the standard says, sir, if the leaseback is a finance lease, whatever the profit or loss arising on sale, it will not be recognized immediately. It should be deferred and amortized over the lease term. So I sold the asset, same asset is taken on lease. If the leaseback is finance lease, at the time of sale I got profit or loss. What I need to do that profit or loss? Here profit or loss will accrue to whom? Lessor. Seller lessor. Sorry, seller lessee. Seller lessee. I mean profit or loss accounting treatment we are discussing in the books of seller lessee. So seller lessee point of view, whatever the profit or loss he got on sale, he should defer and amortize over the lease term. For example, sale price 100, carrying amount 80. Compare these two. The book value of the asset is 80, sir. I sold it for 100. So what is the profit? 20. And if the leaseback is finance lease, this 20 you cannot recognize immediately. What you need to do? Defer and amortize over the lease term. Suppose the lease term is 5 years. So 20 divided by 5. Every year 4 will be recognized by seller lessee. Seller lessee. Now the most important thing is if the leaseback is a operating lease. So I sold the asset, same asset I have taken back for lease. And if the leaseback is which lease? Operating lease. Then there are 3 cases here. The standard says if the leaseback is operating lease, you need to check sale price is equal to fair value, sale price less than fair value, sale price greater than fair value. Sale price equal to fair value, then the standard says any profit or loss will be recognized immediately. If the sale price is equal to fair value, profit or loss will be recognized immediately because sale price fair value. So you can recognize immediately. Suppose if the sale price is less than fair value, see this, if the sale price is less than fair value, profit came, recognize immediately. Loss came, important. If the sale price is less than fair value, loss came on at the time of sale, the standard says if this loss is compensated by future lease payments, if this loss is compensated by future lease payments, deferred and amortized over the lease term. If this loss is not compensated by future lease payments, recognize immediately. The logic is very simple, sir. I sold my asset below the fair value. Why I am selling below the fair value? That means I am giving benefit to you. But in future, I am the same asset I am taking on lease basis. Na? So I will pay less rentals to you, less rent. Today, 100 rupees worth of asset I am selling you at 90 rupees. That means 10 rupees is loss for me. For you, that is a gain. In future, I am paying lease rents. Na? This 10 rupees I will deduct from the lease rents. That is called compensated by future lease payments. So therefore, when the sale value is less than fair value, if there is a loss on sale, you need to see whether this loss is covered, compensated by future lease payments. If answer is yes, defer and amortize. Otherwise, immediately recognize. And the last case, sir, if the sale price is above the fair value. Sir, sale price above the fair value, standard what says now? Anything above fair value. Sale price in excess of fair value, deferred and amortized over lease term. So tell me, I sold the asset, same asset is taken on lease basis. If the lease is operating lease, how many cases will come? 3 cases. What is the first case? Sale price equal to fair value. When the sale price is equal to fair value, profit or loss will be recognized immediately. Second, sale price is less than fair value. When the sale price is less than fair value, profit came, recognized immediately. Loss came. Loss compensated by future lease payments, deferred and amortized. Otherwise, charged to P&L account immediately. Last case, sale price above fair value. Sale price in excess of fair value will be deferred and amortized. Deferred and amortized. Deferred and amortized. That's it, sir. See here, the last case is an interesting case, sir. See this. For example, sale price 100, sir. Fair value 90. You need to see what is the original case. Original case is sale price above fair value. Suppose fair value 90. Sale price 100. Carrying amount 90. So now you tell me what is the profit. In order to get the profit, I need to compare 2 things. What are those? Sale price or carrying amount. Sale price 100. Carrying amount 90. What is my profit? 10. So anything in excess of fair value will be amortized. See this, deferred and amortized over the lease term. Now second case. Come to second case. Sale price, fair value 90. Carrying amount is only 80. First, how you are going to check now? Compare these two. Sale price or fair value. Here sale price 100. Fair value. Sale price is above fair value. So which case? Third case. Third case. Third case says what? Anything in excess of fair value will be deferred and amortized. How much is the difference? Excess 10. See this. 10 rupees the selling price pa, carrying amount 80. So what is the difference? 20. This is the profit. In this 20%, 20 profit, the difference between sale price and fair value is 10 na? This will be deferred and amortized. The remaining, that is the difference between fair value and carrying amount, the remaining 10 rupees we will recognize immediately. And the last case you see, sale value, fair value, carrying amount is 100. Carrying amount is 100. See, actually sir, here what I am doing now, first 3 cases. Sale price equal to fair value, sale price less than fair value, sale price greater than fair value. In each case what you need to do now, you need to every time compare carrying amount, fair value. One case, carrying amount equal to fair value. Second case, carrying amount less than fair value. Another case, carrying amount greater than fair value. When you change the carrying amount, with the fair value, by comparing the fair value, the situations will change. So therefore, 3 main cases. You should not forget main cases. And in each case, you need to compare carrying amount with fair value. For example, you see here, if you see first case, carrying amount equal to fair value. Next, carrying amount less than fair value. Last case, carrying amount greater than fair value. Suppose you see, carrying amount how much? 100. Sale value 90. Fair value 80. Original case tell me. Original case means what is the case we are discussing? Sale value in excess of fair value. That will always satisfy. See this. Sale value is above the fair value. Correct? But carrying amount I am changing. Suppose you see, in this case, when my carrying amount is 100, my sale value 90, my fair value 80. What standard says? Anything in excess of fair value will be deferred and amortized. 90 minus 80. 90 minus 80. This 10 will be deferred and amortized. Sir, but tell me one thing. Your book value of the asset is 100 and your fair value is 80. Can anybody show the carrying amount of the asset above fair value? No. Impairment loss. We cannot show more than the recoverable amount. Here, this is the fair value, but you are showing in the books 100. First, you need to bring this 100 to 80. That means straight away how much loss? 20. This will be recognized immediately. Once the asset is now come to fair value, you compare fair value and sale value. Anything in above fair value is deferred and amortized. So therefore here two things you need to do. The difference between sale value and fair value will be deferred and amortized, and the amount you brought from carrying amount to fair value 100 to 80, 20 rupees loss, you recognize immediately. You recognize immediately. So these are the cases, sir. Different cases you need to cover. Hello. So first case you see, sale price is equal to fair value. What standard says? If the lease back is operating lease, sale price is equal to fair value, recognize immediately. Whether it is a profit or loss, recognize immediately. Recognize immediately. Suppose second case, if the sale price is less than fair value, profit, recognize immediately. Loss, compensated by future lease payments, deferred and amortized. Otherwise, immediately. Case 3, anything in excess of fair value, sale price in excess of fair value will be deferred and amortized. Correct? And this concept, there are questions also. I will show you. Yeah, come to this question, sir. Illustration 3. Carefully think here. A Limited sold a machinery having WDV of 40 lakhs to B Limited for 50 lakhs. WDV means book value, carrying amount. Sale value 50. And the same machinery was leased back by B Limited to A Limited. The lease back is which lease? Operating lease. Comment if sale price 50 lakhs equal to fair value. First to see the main case. Here sale price equal to fair value. Sale price equal to fair value. What standard says? Recognize immediately. How much is the profit here? See, the sale price 10. Correct? Carrying amount 40. So 10 is the profit. This will be recognized immediately. See this. A Limited should immediately recognize the profit. Second case, fair value is 60. Sale price 50, fair value 60. So sale price is less than fair value. Which case? Second case. This says profit recognize immediately. Loss. Here profit or loss? See this. 50, 40. So there is a profit. Profit how much? 10. It should be recognized immediately. Recognize immediately. So second case you see should be recognized immediately. Next, third case. Fair value 45, sale price 38. Sale price 38, fair value 45. So sale price is less than fair value. Which case? Second case. Sale price is less than fair value. Now in this case, loss or profit? 38 is the sale value, book value 40. That means 2 rupees loss. What standard says? If the sale price is less than fair value, loss, if it is compensated by future lease payments, deferred and amortized. Otherwise, recognize immediately. That is what they say. See this. 2 rupees loss immediately if it is not compensated by future lease payments. Otherwise, deferred and amortized. Next, fair value 40 lakhs, sale price 50 lakhs. So, fair value, sale price. Sale price is greater than fair value. Case 3. Anything in excess of sale price, deferred and amortized. Now, here what is the carrying amount? 40. Correct? Sale price 50. So, see here. Sale price 50, fair value, sale price 50, fair value 40. Correct? And then carrying amount also 40. So, what is the difference? 10. This is deferred and amortized because anything in excess of fair value, deferred and amortized. Next, fair value 46, sale price 50. So, sale price 50, fair value 46. So, case number 3. Carrying amount 40. Now, you see. So, profit, total profit how much? 10. In that, the difference between sale price and fair value 6. So, this will be deferred and amortized. Remaining 4 recognized immediately. Correct? E case you see. In the E case, the total profit is 10. In that 6 will be immediately recognized. 4 lakhs will be deferred and amortized. Yeah, correct only. Fair value 46, right? 4 rupees, sorry. 4 rupees will be deferred and amortized, and 6 rupees will be recognized immediately. Because anything in excess of fair value will be deferred and amortized. Last case, sir. Fair value 35, sale price 39. Hello? So last case. Can you tell me the last case? What is that? Last case, what is the sale value? 39. Fair value? 35. Carrying amount? This is the important case where students confuse. See this. First, the carrying amount is more than fair value. This is not correct. First, brought this from here to here. 40 will become 35. That means there is a loss. How much loss? 5. You recognize immediately this loss. Now the asset value came to 35 now. Anything in excess of fair value will be deferred and amortized. How much? 4. So this will be deferred and amortized. So therefore here carrying amount first will come to fair value. So there is a loss of 5. Then the difference between sale value and fair value 4, that will be deferred and amortized. So that is the answer, sir. See this. So 4 should be deferred and amortized over the lease term. You understand this? That's it, sir. This is accounting standard 19. We have completed, sir. It's a very big standard, sir, but you can practice this. Not difficult, easy only. Big but easy. You can score in examination. Okay, sir. The next standard we are going to cover is accounting standard 10, property, plant, equipment, sir. So this standard, first we need to understand what is the definition of PPE, sir. Then objective of the standard, scope of the standard, and when to recognize PPE, the recognition criteria. Initially PPE will be recognized in the books, how it will be measured, at what value initially PPE will be measured. Subsequent measurement on balance sheet date, at what value PPE will be shown. Depreciation topic, there is one concept called component accounting, and then derecognition concept. These are the things we are going to cover in this standard, sir. Property, plant, equipment. Okay. So let us start the standard, sir. First of all, what is PPE? PPE means tangible items, which is held for sale, held for use in production or supply of goods or services, or for rental to others, or for administrative purposes. And condition number 2, which is expected to be used during more than one period, 1 year. So in order to become PPE, 2 conditions, sir. First of all, PPE is basically what, sir? Tangible item, which is held for. Why the organization is holding them? For use either in production like plant and machinery, factory, like this. Supply of goods. For example, we have delivery vans, trucks for supply of goods. Services, if you are a service provider, anything, any asset you are using for providing services, or rental to others. Suppose for example, I have a building. My main object is to get rental income. Or for example, we purchased any asset for earning rental income. So that is also okay. Administrative purposes. Administrative purposes means the scope is so wider. Administrative purpose includes selling and distribution, financing and accounting, personnel and other functions of the enterprise. For selling and distribution of goods, we purchased some assets. And for example, finance and accounting. In finance department, accounts department, computers we purchased, scanners we purchased, printers we purchased, equipment we purchased, all these things. Personnel, I mean like employees. For example, for transportation of employees, we purchased a bus. That is also covered under administrative purpose. So here the word administrative purpose scope is so big, sir. It includes selling and distribution, financing and accounting, personnel, and all other functions of the enterprise. So any PPE, any tangible asset you held for either in production use or services or rental to others, or your object is to use it for administrative purposes. And the most important thing is it is to be used for more than 1 period. Suppose, sir, even spare parts, standby equipment also covered under PPE if they meet the definition of PPE. If this definition they satisfied, na, sir, then even spare parts, standby equipment also covered under accounting standard 10. Now what is the object of AS10? To provide the accounting treatment for PPE. Okay. Scope of the standard is very, very important, sir. Sir, the standard says the standard is applicable for all kinds of PPE except those PPEs for which the accounting treatment is provided in other standards. For that, we are not applicable. If there is any other specific standard, we need to follow that. For example, leases. Just now we have seen. If any asset acquired on lease basis, if the lease is finance lease, at what value the asset will be recognized? Fair value or present value of MLP, whichever is lower. That is prescribed in which standard? AS 19. So therefore follow AS 19. Okay. And AS 10 is not applicable to, important, listen to me. Sir, the standard says AS 10 is not applicable to biological assets. Any biological assets are there. Other than bearer plants related to agriculture activity, the standard is not applicable. And any wasting assets like any mineral rights, expenditure on exploration and extraction of minerals, natural gas and similar non-regenerative resources. That means any rights relating to intangible assets. Any rights relating to intangible assets, the standard is not applicable. So first one is what, sir? Biological assets. The standard is not applicable. Biological assets relating to which activity? Agriculture activity. The standard is not applicable. But here, if you see carefully, they are saying other than bearer plant. That means for bearer plant, the standard is applicable. First of all, what is this biological assets? See this. This standard says biological assets means living animals and plants. Living animals, plant, or biological assets. Now, what is bearer plant, sir? Because they said biological assets other than bearer plant related to agriculture activity, the standard is not applicable. That means the standard is applicable to bearer plant. When a plant is called bearer plant, three conditions are there. If all three conditions are satisfied, then that plant is bearer plant and AS 10 is applicable for that bearer plant. It is also treated as PPE. AS 10 is applicable. What are the three conditions, sir? First, that plant must be used in production or supply of agriculture produce. That plant must give agriculture produce. Second, it is expected to bear produce for more than 12 months. It should give us, or we are expecting that it is going to give produce for more than 12 months and has a remote likelihood of being sold as an agriculture produce. Remote means very rare chances that it is sold as an agriculture produce except for incidental scrap sales. That means that plant is not meant for sale. Except for incidental scrap sales means once the life is over, we can cut down and we can sell it. That's okay. But in general, that plant is not meant for sale. Okay. Then if these three conditions are satisfied, that plant is called bearer plant. So it must give produce, expected to bear produce for more than 12 months, remote likelihood of being sold as an agriculture produce. Best example is what? Mango tree, for example. You take mango tree. Is it giving agriculture produce? Yes, mangoes. It is expected to bear produce for more than 12 months. Yes, mango tree will give produce more than 12 months. Third, is it mango tree is grown for its wood or for its mangoes? Mangoes. That means there is a remote likelihood of being sold as an agriculture produce, except for incidental scrap sales. That means once the life is over, companies or farmer, whoever having these plants, they will cut down and they will sell. That's okay. But in general, these plants will not be grown for their wood. For example, there is a teak wood, teak tree, teak. Teak tree is exclusively grown for its wood. Therefore, it will not a bearer plant. So, to become a bearer plant, it must give agriculture produce. That produce will be given for more than 12 months and it is not sold as an agriculture produce. The plant itself cannot be sold as an agriculture produce. Another example would be coconut tree. Coconut tree will give agriculture produce. Coconuts, more than 12 months it will give. Yes. Whether coconut tree will be cut down and sold as a scrap? No. Generally, it is grown for its coconuts. Right? So, these kind of plants are what? Bearer plants. Like tea plants, coffee plants, these are all bearer plants only. Because they will satisfy the definition of bearer plant. Now, you need to understand, sir. Biological assets means living animals and plants. Plant includes bearer plant. But for bearer plant, the standard is applicable. So that means if any company is having this bearer plant, treat them as PPE and apply this standard. But they must be related to which activity? Agriculture activity. And now, which are not bearer plants? For example, any tree is grown for use as lumber. Lumber means wood. Any tree exclusively grown for its wood, like teak tree, is not a bearer plant. Because the tree itself is cut down and sold. Any tree exclusively grown for their lumber and as well as their fruit. Sir, some trees will give you both fruit, lumber, wood. So these trees are grown for their wood and fruit. They will be cut down, fruits will be taken and sold as a wood. So they are also not a bearer plants. And also annual crops. Annual crops means this paddy, maize, wheat, annual, every year they will give 1 year, less than 1 year crops will be there, na? They will be. They are also not a bearer plants. So 3 plants are not a bearer plants. You understand? So tell me, what are the exceptions to AS10? AS10 is not applicable to biological assets. But exception, bearer plant. Bearer plant, this standard is applicable. When a tree is called bearer plant, it must give agriculture produce more than 12 months, remote likelihood of being sold as agriculture produce. That means it is not grown for its wood generally. 3 exceptions is what? Any tree grown for wood, not a bearer plant. Any tree grown for its wood and fruit, and annual crops like paddy, wheat, maize, they are not bearer plants. Next, recognition criteria. Sir, when PPE will be recognized in the books? 2 conditions: probable future economic benefits and cost is measured reliably. Probable future economic benefits, we must expect some probable future economic benefits, and the cost is measured reliably. Then only we will recognize this. PPE will be recognized in the books. Hello? Now see this illustration number 1. Suppose there is an entity who is having a supermarket chain. Now it is renovating one of its major stores, sir. They are doing renovation. Because of renovation, they will get more space, sir. So what they will do is they can store promotion outlets after the renovation, and it will include a restaurant also. Management is preparing budget for the year and after the stores reopens, which include cost of remodeling and expectation of 15% increase in the sales resulting from the store renovation. Sorry, after renovation their sales will increase 15%. Now which will attract the new customers. State whether the remodeling cost will be capitalized. So there is a store, sir, they are doing remodeling. Because of the remodel, after renovation and remodeling, the sales will increase 15%. Now tell me whether that remodeling cost will you capitalize? Will you treat it as PPE? Will you add to the building cost or not? The answer is yes. Because the standard says what? Probable future economic benefits, cost is measured reliably. Here what is the probable future economic benefits, sir? Sales increases by 15%. Therefore, we will capitalize it. We will recognize it. Next. Sir, measurement of PPE, this is very, very important, sir. Questions generally will come from this only. Measurement of PPE. Listen. First, at recognition, initially, first time when you want to recognize PPE, you purchased PPE or different ways. PPE you want to recognize in the books. Initially, you follow cost model. Balance sheet date, you follow cost or revaluation model. You have 2 options. At what value the asset will be carried in balance sheet, either cost model, revaluation model. But initially when you want to recognize, cost model. See this. Initial recognition. The standard says initially you need to recognize PPE at its cost. For example, you purchased a PPE. You need to find out the cost of PPE. At that value you need to recognize the PPE. And the standard says the cost of PPE. 3 types of cost are included. First is purchase price. See this. Purchase price is the first type of the cost. See this, purchase price. So when you purchase any asset, sir, whatever the taxes you are paying, non-refundable duties and taxes, you add. Any other expenses you incur. For example, you purchase an asset, machinery. Whatever the transportation cost, insurance cost, loading, unloading cost, whatever the expenses you incurred at the time of purchase, add everything. Minus any trade discount rebate given by the supplier, deduct. You will get the purchase price. This is the first component of the cost of PPE. Okay. Next, any directly attributable cost. So here I have given purchase price means import duties, non-refundable duties, non-refundable purchase taxes, trade discount and rebates must be deducted. Now directly attributable cost is the second part of the PPE, cost of PPE. So the standard says what is directly attributable cost? Directly attributable cost means the cost which is incurred to bring the PPE to its present location and condition. Whatever the cost incurred by the management to bring the PPE to its present location and condition. necessary for it to be operate as intended by management. To bring this PP to the manner as intended by management, what are all the expenses we are incurring to bring this PP to its present location and condition, capable of operating in the manner intended by management? All these expenses are directly attributable cost. See this, these are the costs which we incurred to bring the PP to its location and condition, necessary for it to be capable of operating as intended by management. So guys, important, directly attributable cost like employee benefits, directly linked to the construction or acquisition. For example, you are acquiring an asset, you used some of your labor, whatever the salaries you are paying to them, which is directly related to acquisition of asset, capitalize. Suppose for example you are making own construction, in your own construction you are using your own labor, the salaries you paid to them for construction, that will also be directly attributable cost, we need to add. Similarly, any site preparation cost, for example you purchased a machinery, you are installing, so you make the site ready, so site preparation cost. Delivery and handling cost, installation and assembly cost. The most important thing is testing cost. Testing cost means trial run. Even trial run cost is also directly attributable cost. But in case of trial run, the important point is you do the trial run, you samples are produced na? First these samples, whatever the amount generated from sale of samples will be deducted, only remaining amount will be added to the cost of the PPE. See this, after deducting proceeds from selling assets, and also professional fees. Suppose if you appoint any professional for acquisition of a machinery, the professional fees, the brokerage, the commission you pay will be added. But you need to remember, standard says there are some cost, any cost you should not include. You should not include some cost. What are the costs, sir? Simple. Opening cost, like inauguration cost, cost of opening a new facility or business, such as inauguration cost. Suppose inauguration cost you incurred, you done some puja, some ceremony you done. For example, you are opening one plant and machinery, for that some puja expenses, inauguration expenses done, don't include them. And also cost of introducing a new product or service, including cost of advertising, promotional activities. You are launching a new product, advertisement expenses, promotion expenses don't include as a part of cost of PPE. Next, cost of conducting business in new location with a new class of customers, including staff training. Any cost you incurred for conducting the business in new location, like shifting, transfer from one location to another location, giving training to employees, these costs you should not include. You should not include. Administration and other general overheads you should not include. So here also you can see this. Any, and also initial operating losses, any losses initially you will get, don't capitalize them. And also relocation, reorganization cost of operations. Relocation should not include. Relocation, for example, you shifted from one premises to another premises, the relocation expenses will be there now, don't include. And also reorganization cost, and also cost incurred before the asset is fully operational or running at full capacity. For example, the asset is running at full capacity. Once the asset is ready, after that whatever the expenses incurred, it should not be capitalized. Guys, you need to understand, guys, training, see this, advertisement cost, promotion cost, inauguration cost, staff training cost, relocation cost, reorganization cost, administration and general overhead cost, these costs not to be included in the cost of PPE. See this question, entity has an existing freehold factory property. They have one factory, sir, which intends to knock down and redevelop. They want to completely knock down and they want to redevelop the factory. During the redevelopment period, the company moved its production facilities to temporary site. Following incremental costs were incurred. Tell me, setup cost, how much incurred? 5 lakhs to install the machinery in the new location. Will it be included? No. Rent? No. Next, removal cost? No. To transport the machinery from old location to new temporary location? No. Can this cost be capitalized into the cost of new building? No. Just now I told, any relocation cost, reorganization cost should not be included, should not be treated as cost of PPE. The cost to be incurred by the company are in the nature of cost of relocating, reorganizing operations of the company, and do not meet the definition requirement of AS 10, therefore cannot be capitalized. Okay. And now one more important point, sir. Sir, for example, there is a site, sir, vacant site is there, vacant site. In that vacant site we want to construct a building. Okay, Meanwhile, it was vacant, so we have given it for parking. So from some parking rent amount is coming. Whether this rent can I deduct from the cost of the asset? The building which I am going to construct now. From that cost, can I reduce this parking amount? Before construction, there is a vacant land. That vacant land I have given for rent purpose. From the rent, whatever I am receiving, can I adjust the cost of the asset? The answer is no, you cannot. See this. If you earned any income during development of PP, if that income is not directly related to the asset, like car parking rental income, so recognize this as an income. Don't adjust to the cost of the asset. Suppose there is a directly attributable income. Like for example, there is a site, sir. In this site there is a factory. Now this factory we want to remove, and in this place we want to construct a new factory. Now we demolished this and we got some scrap. This scrap was sold. We got 5 lakh rupees. Whether this 5 lakh rupees can I capitalize, can I reduce from the cost of the new factory I am going to? Yes, because this is directly attributable income. Example, sale of scrap material on demolition in case of redevelopment. So existing asset I need to demolish and I need to redevelop another asset. Now from the scrap of the demolition of the existing asset, whatever the income generated, that will be adjusted to the cost of the asset, sir. Hello. So the cost of PP, 3 types of cost I told. What is the first one? Purchase price. Second one, directly attributable cost. What is directly attributable cost? Any cost which we incur to bring the PP to its present location and condition as intended by management. Site preparation cost, employee benefits who are directly involved in the acquisition construction. Next, loading, unloading. What is that? These costs are delivery, installation, assembly, testing cost to professional fees. Which cost should not be included? Inauguration cost, advertisement cost, promotion cost, relocation cost, reorganization cost. These things. And any asset is already running at full capacity. After that, if you incur any expenses, no, you should not include them. And also when it comes to income, if you are redeveloping any asset, any directly attributable income relating to the redevelopment can be deducted from the cost. Otherwise, it should be charged to P&L account, treated as income. Car rental example I have given. What is the third type of cost, sir? Decommissioning cost. What is decommissioning, restoration and similar liabilities? This is important, sir. Sir, decommissioning, restoration, similar liabilities means, suppose you have installed an asset in a leased premises. Suppose there is a premises. This premises you have taken for lease. In this premises you have built plant and machinery. And the lease is for 10 years. Now as per the lease agreement, sir, once 10 years is over, I need to remove this plant and machinery from this place and I need to restore the land as it is. For that some cost is going to be incurred now. In order to remove this plant and machinery from this place and restore the land as it is, I need to incur some cost. When I am going to incur this cost? After 10 years. Therefore what company will do now? This is for this amount. For example, they are expecting that we are going to incur 20 lakhs. For this 20 lakhs we need to create a provision and we need to capitalize to the asset. This is called decommissioning, restoration and similar liabilities. So decommissioning, restoration means any cost which we incurred to remove the asset or restore the land as it is after its removal. Those costs are decommissioning, restoration cost. The standard says this decommissioning, restoration cost will also be included as a cost of PP. But the one important thing is this decommissioning, restoration cost you need to convert into the present value. You need to convert into the present value and then add. So what is the entry here? PP to provision for decommissioning. PP to provision for decommissioning. PP account debit to provision for decommissioning. Why present value we need to take? Because I am deciding the cost today. This amount is going to pay after 10 years. Therefore only the present value is relevant for capitalization. Hello. So therefore this 20 lakhs is after 20 years. After 10 years. So I need to convert this 20 lakhs into present value. Okay. Next, cost of self-constructed asset. Sir, sometimes we will construct asset on our own. Hello? Sometimes we will construct the asset on our own. Self-construction. When you make any self-construction, sir, how to determine the cost? When you make self-construction, how to determine the cost, sir? 1 minute. Sir, when you make self-construction, how to determine the cost of asset, sir? Self-construction means on our own you are constructing the asset. So what material cost, see this, whatever the material cost, labor cost, variable overheads, fixed overheads, any directly attributable cost, decommissioning, restoration cost, everything will be added. You will get the cost of PP. When you construct your own building, for example, factory building, whatever the cost you are incurring now, everything will be added. Till now, whatever the discussion we had made, directly attributable cost to purchase price, all these things, same manner only. But important point is 3 points you need to remember. Whenever you are determining the cost of self-constructed asset, 3 points you need to remember. First point is internal profit should be eliminated. What is that? Internal profit should be eliminated. What is this internal profit, sir? Simple. For example, division A is constructing plant and machinery. Now division B is a cement division. They are supplied cement, 500 bags they supplied. The cost per bag is 800, sir. And right now in the market it can be sold at 1000. For example, sir, division B send 500 bags at 1000 rupees each. That means 500 into 1000, how much, sir? 5 lakhs cost, cement cost. So I added this 5 lakhs to plant and machinery. Correct? Because I am making a construction. Now the question is, in this 5 lakhs there is a profit of how much? 1 lakh profit, because the cost is 800, the sale price is 1000. So therefore 1 lakh profit is there. Now this profit is which profit? Internal profit, because you are both are same company. So therefore this asset is for the organization. So whatever the internal profit is there in this 5 lakhs, 1 lakh should be eliminated. So when you are making a self construction, internal profit should be eliminated. Second point, as per AS2, inventory cost should not include abnormal wastage. I told you, any abnormal wastage of material, labor, overheads, same thing they are saying. In self construction, any abnormal loss may occur, abnormal wastage of materials, labor, overheads, please don't include it, because the reason is your inefficiency cannot become your asset. I told you in AS2, same principle. Third, interest cost. Sir, whether interest cost will be capitalized? Answer is yes, subject to A16. If A16, borrowing cost, if the PP is a qualifying asset, capitalized. If PP is not a qualifying asset, then interest cost is charged to P&L account. So this is how the self-constructed asset will be determined. You understand this? So how the self-constructed asset cost will be decided? Same manner like purchased, self-acquired. Same manner like purchased asset. All cost will be added. Directly attributable cost, purchase cost, any material, labor, everything will be added. Only 3 points you need to remember. What are those? Internal profit you should not include. Second, abnormal wastage you should not consider. Third, interest. Interest when will you add? If it is a qualifying asset. If it is not a qualifying asset, don't add. Interest will be charged to P&L account. Next, PP acquired by exchange of assets. Sir, sometimes we will acquire PP by exchange of assets. Exchange. Now important, listen to me. When you acquire any PP by exchange of assets, sir, what we need to check is whether the transaction has commercial substance or not. We need to check whether the transaction has commercial substance or not. When PP acquired by, sir, PP acquired by exchange of assets. Sir, when any PP is acquired by exchange of asset, how the cost will be decided? You need to see whether the transaction has commercial substance or not. You need to see whether the transaction has commercial substance or there is no commercial substance. If there is a commercial substance, the standard says fair value of the asset given up. Whatever the asset you are giving up in exchange, the fair value of the asset given up, that is the first priority. That will be the cost of the newly acquired asset, PP. Second, if it is not available, fair value of the asset given up not available, fair value of the asset received, you take it. If that is also not available, carrying amount of the asset given up. Carrying amount of the asset given up. So these three. So tell me, when there is a commercial substance, so at what value the asset which is acquired by PP, exchange, will be recognized? Fair value of the asset given up. See, this is the first priority. If it is not available, fair value of the asset received. Third, WDV of the asset given up. WDV or carrying amount of the asset given up. Now the question is, what is commercial substance? What is commercial substance? Simple, sir. If my amount, risk, timing of cash flows are affected by the exchange, then I say there is a commercial substance. If my cash flows, the risk, the timing, the amount of cash flows are got affected by the exchange, then there is a commercial substance. If they are not affecting, there is no commercial substance. Okay, sir, when there is no commercial substance, then at what value the PP acquired will be recognized? Simple. In such cases, assets acquired will be measured at the WDV of the asset given up. Whatever the asset we are giving up, na sir, whatever the book value, WDV of that asset is there, na, that is the cost of the newly acquired PP. Because when there is no commercial substance, no need to consider fair value. Just whatever the book value of the asset is there in the books, that value only carried for the newly acquired asset also. Hello? Now see, what is commercial substance? I will tell you. For example, sir, imagine your company is having one old truck, sir, old delivery truck. Now I am exchanging this with a new one, which is advanced GPS fuel efficient technology. Now you see, you compare nature first. Old truck generates inconsistent cash flows due to frequent breakdowns. New truck offers more reliable operational cash flows. Second, amount. Maintenance cost of the old truck is very high, reducing the cash inflows, while the new truck reduces the cost and increases the net cash inflows. Timing. The new truck delivers cash flow savings earlier due to reduced fuel and repair cost. So you see, if I exchange my old delivery van with the new one, obviously my maintenance cost will reduce, my fuel cost will reduce. Obviously, that means my cash flows are getting affected. That is called commercial substance. Commercial substance. So if I am exchanging the same assets, same type of assets, same nature assets, there is no commercial substance. That means if I exchange homogeneous same type of assets, there is no commercial substance. If I am exchanging heterogeneous assets, different assets, obviously there is a chance that my cash flows got affected. When my cash flows, that is the risk, timing, amount of cash flows are getting affected, then we say there is a commercial substance. When there is a commercial substance, the fair value of the asset given up, or the fair value of the asset received, or WD of the asset given up. In this order, I need to recognize the asset acquired. You understood? Next, some special cases you see, sir. Determination of cost in special cases. Special cases means, for example, deferred payment beyond normal credit terms. Sometimes we will acquire a PP by asking more credit period. When we ask more credit period, the supplier will charge extra amount. So anything we pay, the total payment minus the cash price. Right now, if I purchase the asset, what is the price? That is called cash price. What is the total payment I am making? The difference is treated as interest expenses. Okay, the difference is treated as interest expenses, and it will not be capitalized. It will not be capitalized. Sometimes, sir, PP purchased at consolidated price. Consolidated means single price. With single price, if we purchase multiple assets, na sir, this consolidated price will be apportioned between all the assets based on their fair values at acquisition date. For example, we purchased 10 assets. 10 assets we purchased for 100 lakhs. Now, how much cost will be allocated? Based on the fair values, this 10 lakhs, this whatever the cost 100 lakhs, you apportion. PP is held under finance lease. Any asset acquired under finance lease, how the cost will be determined? As per AS 19. And then government grant related PP. You know, sometimes we will receive assets from the government grant in the form of government grant. You know, in that case, AS 12 is applicable. AS 12. If any asset is received free of cost, if we receive free of cost, we will recognize them at a nominal value. You remember AS 12 says. If you recognize if you receive any asset from government at a concessional price, then we will recognize at acquisition price. At whatever the price we acquired, we need to recognize at that value. Okay. Next. So that means we have completed the cost of PPs. Cost of PPs are completed. Now see this question, sir. Illustration number 3. Wait. Some questions we'll do, sir. Important questions. We completed the initial measurement of the cost of PPA. Yeah. Come to scenario based question 13. See this question. ABC Limited is installing a new plant at its production facility. It has incurred these costs. Cost of the plant. Cost per supplier invoice plus taxes. Definitely it will be taken. Initial delivery and handling cost, capitalize. Site preparation cost, capitalize. Consultant used for advice on the acquisition of plant, professional fees, add. Interest charge paid to supplier of plant for deferred credit, don't include. Just now I told, when you acquire any PP beyond deferred credit terms, beyond the normal credit terms. That means whatever the payment we make, we compare with cost price. Anything extra we paid is interest. Interest should not be included in PPE. Next, estimated dismantling cost to be incurred after 7 years. Dismantling cost, add. But we need to convert this into present value. But they have not given. Not given means ignore it. Just take whatever the value given. Operating losses before commercial production? No. Just now I told you. Any operating losses, initial operating losses, we should not include. Important pa. Any initial operating losses I told na, we should not include as a part of cost of PPE. So see this. So this is the answer. 43 lakhs. Correct? Next. See, come to question number 18. I think this question they have asked in examinations also. Question number 18. Yeah. Preet Limited intends to set up a steel plant for which it has acquired a dilapidated factor having an area of how much? 5,000 acres at a cost of 60,000 per acre. Okay. Preet Limited has incurred 1.1 crore on demolishing the old factory building. A sum of 63 lakhs including 5% GST was realized from the sale of materials salvaged from the site. Preet Limited incurred stamp duty registration charges of 7% of land value, paid legal and consultancy charges 8 lakhs for land acquisition, and incurred 1,25,000 on the title guarantee insurance. Compute the value of the land. Sir, see this. First of all, land cost, purchase price how much, sir? 5,000 acres into 60. Correct? 3,000 crores. 5,000 acres, sir, into 60,000. Okay. 3,000. I think they are taking in lakhs. Yes. Lakhs. Rupees in lakhs. 3,000 lakhs. Next. Preet Limited incurred 1.1 crores on what, sir? Demolition of the old factory. Will you add this 1.1 crore? Demolition of the old building. And see, from demolition we got some scrap. The sum of 63 lakhs was realized from the sale of material salvaged from the site. Now, but the 63 lakhs including GST. So therefore, 63 lakhs including GST. That means it is at 105. Correct? 100 plus 5% GST. So how much is the GST? 3 lakhs GST. You remove 3 lakhs. That means what is the scrap value without GST? 60. That 60 will be deducted from this 1.1 crore. Only remaining net demolition cost will be capitalized. See this, demolition expenses 50. Correct? 110 lakhs minus 60 lakhs only they considered. See this. So this is one thing. Next. And also stamp duty registration charges 7% of the land value. Land value 3,000 on that 7% apply. 210. Correct? And legal and consultancy charges capitalize. And title, see 1,25,000 on the title guarantee insurance will also be added. So total cost of the land 3269.25. That's it, sir. This is how you determine the cost of PPE, sir. This question, sir, I think question number 5. This is a very important question. Examination question. This question is there in the study material also. Srishti Limited contracted with a supplier to purchase machinery, which has to be installed in Department A in how much time? 3 months time. Special foundations were acquired for the machinery, which are to be prepared within the supply lead time. The cost of the site preparation, laying foundation is how much? 141,870. So site preparation cost will be capitalized. These activities are supervised by technician during the entire period, who is employed for this purpose 45,000 per month. So 45,000 into 3 months. How much, sir? 1,35,000. This is the employee benefits we pay, who is exclusively engaged in construction, acquisition. So this is also capitalized. The technician services are given by Department B to Department A, which billed services 49,500 per month after adding 10% gross margin. Hello. Sir, I told you here department B has provided services to department A. They are charging how much, sir? 49,500 per month after adding how much? 10% profit margin. That means this 49,500 into 100 divided by 110, correct? You will get the true cost, 45,000. So 45,000 only cost we need to consider. Okay. Because the technician who is supervising these activities is given by department B to department A. Anyway, we have considered only 45,000, right? This is including profit, but I told you internal profit should not be included. The mission was purchased at 1,58,34,000 including IGST of 12%, for which ITC is available. Sir, I told you any non-refundable taxes will be added, refundable taxes will be deducted, but this 1,58,34 already including 12% GST na. So therefore 1,58,34 into 100 divided by 112. So suppose cost is 100, 12% GST, it is equal to 112. Make it for 100, it will be 1,41,37,500 only we need to consider. 55,770 transportation charges, add. Architect was appointed at a fees of 30,000, add. Ascertain the amount at which machinery should be capitalized. See this. This is the purchase price after reducing GST. Site supervision cost 141,870. Site supervision cost is there na, added. And technician salary, important, we need to consider only for 45,000 for 3 months. Don't consider 49,500. Initial delivery cost 55,700. Transportation nothing but. Professional fees for installation 30. Architect fees. So total 1,45,00,000, 140. Hello. That's it, sir. This is the question, sir. And the same question, sir, if you see question number 7, sir, actually same question. See this question number 7 also. They have tested this question in May 2025. The same question. Here also see they are first purchasing 250 acres at a cost of 25,000 per acre. Stamp duty, registration fees 5% of the land value. Legal fees 4,75,000. Incurred 37,85,000 for demolishing the old premises. A sum of 12,60,000 including 5% GST thereon realized from sale of material salvaged from the site. Same question we solved na? Same. Here some extra information given, sir. The following increment cost will be incurred. The company needs to remove the present production facilities. For that, setup cost 7,50,000 they need to incur. Rent 12 lakhs. Removal cost 2,50,000 to transport the machinery from old location to new. See, tell me, setup cost, rent, removal cost, will you add in the cost of the new building? The answer is no, no, no. I told you. Hello. So all these costs we should not include. I told you. When you are shifting your premises to some other place, any relocation cost, any reorganization expenses, setup cost, they are not part of cost of PPE. Okay. So that means we have completed the cost initial measurement we have completed, sir. What is we completed, sir? Initial measurement. Now treatment of subsequent cost. Sir, once you recognize PPE, any subsequent expenses you incur. Like for example, there are some machineries. For these machineries you are incurring regular day-to-day repairs and maintenance. Generally they will be charged to P&L account as an expenses. Regular day-to-day repairs. First, any expenditure you incurred on the PPE which increases the life and efficiency of the asset, then capitalize. Beyond the previously assessed levels of performance, if because of the subsequent expenditure, if the capacity of the asset increases, the efficiency of the PPE increases, capitalize. And the most important is this one. Suppose, sir, you done any major repairs, major replacements, major inspections, major overhauling. Overhauling means complete examination. Generally for aircrafts, ships, they will do this. Complete overhauling examination. For that some cost will be incurred, sir. So how to deal with them? Major replacement. For example, there is a huge aircraft or there is a machinery. In that machinery, we replaced old part with new part. Then how to determine the cost? Simple. Take the WDV of the total asset. Old part is there now, old part which we are replacing. The WDV of the old part you deduct. Cost of the new part you add. You will get the revised WDV. So whenever you are replacing any part, WDV of the old part will be minus, cost of the new part will be added. Similarly, major inspection and overhauling cost also. Whatever the cost you are incurring, major inspection cost to major overhauling cost. So old WDV of the old part will be removed, cost of the new part will be added. You see question number 2, I think RTP November 2022 question. In this question there is a company RS Limited, sir. They have acquired a heavy plant, sir. What is the cost? 2 crores. Estimated useful life 10 years. At the end of year 2, one of the major components, that is boiler, has become obsolete, which was acquired at a price of 50 lakhs and requires replacement. A further maintenance is uneconomical. The remainder of the plant is perfect and it is expected to last for next 8 years. The cost of the new boiler is 60 lakhs. Can the cost of the new boiler be recognized as an asset, and if so, what should be the carrying value of the plant at the end of the second year? First of all, original cost of the plant how much, sir? 2 crores. Correct? And now life is 10 years. They are asking at the end of the second year. First to remove depreciation for first 2 years. 2 crores divided by 10 into 2. 40 lakhs depreciation will be deducted. So WDV at the end of the second year is 1.6 crores. Correct? Now, what is the cost of the new boiler you want to add? 60. Add. See this. Cost of the new boiler. Add. And the new boiler we are adding now, the old part. WDV of the old boiler we need to remove. This old part was acquired at what price? 50 lakhs. 2 years already over. Correct? So this 50 lakhs divided by 10 into 8. No, I want WDV, right? Correct. 50 lakhs at the original cost divided by 10. That means every year how much cost? 5 lakhs, right? 5 lakhs into 2, 10 lakhs. So WDV is 40 lakhs. So 40 lakhs. I remove 40 lakhs, I will add 60 lakhs. So therefore 1.8 crores is what's the revised carrying amount of the plant. So this is treatment of which cost? Subsequent cost. Subsequent cost. Now next. So till now in accounting standard 10 what we have covered? Initial measurement. Initially PP will be recognized at cost. Different cases. Self-acquired, self-construction I covered, exchange I covered. Relating to exchange also, we'll see some questions. 7, sir. Illustration 7, you see. Exchange of assets that lacks commercial substance. Suppose entity A exchanges a car X with a book value of 13 lakhs and a fair value of 13 lakh 25,000. Mr. Entity A exchanges car X with a book value 13 and a fair value of 13 lakh 25 for a cash of 15,000 and car Y, which has a fair value of 13 lakh 10,000. That means we are giving away what? Car X. What we are receiving? Car Y as well as cash. Cash is 15,000, car Y fair value 13 lakh 10. The transaction lacks commercial substance. So tell me, when there is no commercial substance, at what value assets received will be recognized? WDV of the asset given up. What is the WDV of the asset given up? 13 lakhs. So therefore, you see, this is the asset we are giving up. So in our books, car X will be de-recognized, credited 13 lakhs. And 15,000 cash we are receiving now. Cash or bank 15,000. The remaining balance will be the car Y value. Because you need to recognize that WDV of the asset given up. The WDV of the asset is 13 lakhs. So 13 lakhs is the value at which you need to recognize the assets. In that 15,000 fixed na cash. So remaining 12 lakh 85,000 I need to recognize. Hello? Now come to measurement after initial recognition, sir. Okay. Initially you have recognized PP at cost. Now you need to measure the PP in the balance sheet. In the balance sheet. See, there are two methods, sir. There are two models. Okay. What are the two methods available for recognition of measurement of PP after initial recognition? Cost model, revaluation model. In cost model, how the PP will be measured, sir? Cost of PP minus accumulated depreciation minus accumulated impairment loss. till now what is the total depreciation, total impairment loss, you deduct, you will get the carrying amount. That value will be shown in the balance sheet. Suppose there is a revaluation model. This is important model, revaluation model. In revaluation model, what we do? We will show the asset at its fair value. We will recognize the asset at its fair value. For example, there is an asset, the carrying amount is 10 lakhs, fair value is 15 lakhs. So now we want to revalue the asset at 15 lakhs. So from now onwards, the asset value is how much? 15 lakhs. That means how much increase happened? 5 lakhs. This is called revaluation surplus. This will be transferred to revaluation surplus. So suppose if you are following revaluation model, sir, first take the fair value of the PP, the value at which you have revalued the asset. After that, any subsequent accumulated depreciation, subsequent accumulated impairment loss. See, once you brought, suppose an asset 10 lakhs into 15 lakhs. This is the value now, 15 lakhs. On this, from now onwards, whatever the depreciation impairment loss came, that will be deducted. That's why subsequent accumulated depreciation, subsequent impairment loss. In cost model, initial cost minus accumulated minus impairment loss. But in revaluation model, we will start with what? Fair value. So once you done the revaluation at the fair value, that value, after that any subsequent depreciation impairment loss is there, you will be deducted. So basic idea is what? Recognize the assets at its fair value. Okay. Now sir, okay, no problem. Suppose I want to apply revaluation model. Can I apply selectively? So for example, our company has 5 buildings. Can I apply for 3 buildings cost model, 2 buildings for revaluation model? The standard says you need to apply revaluation model for entire class of PPE. Selective application is not allowed. So suppose revaluation model is applied for entire class of PPE. For example, if you have 5 office buildings, all 5 office buildings, if you want to apply revaluation model, you can apply. Same class of PPE should be applied. That means selective application of revaluation model is not allowed. Second, frequency of revaluation. Sir, how frequently I need to revalue the PPE? See, that depends upon the change in the fair value. If the changes in fair value is significant and volatile, fair value is fluctuating, every year it is changing, very significant and volatile changes in fair value, then every year you need to do revaluation, annual revaluation. Sometimes significant changes are there but not frequent. There is significant but they are not volatile. Significant, not frequent changes in fair value, then once in every 3 or 5 years is okay. And what is this fair value? The fair value is nothing but market based evidence. In market, this asset, what is the value available, that will be the fair value. Hello? Now the important thing is account. So frequency of revaluation, I told you, no sir. How frequently we need to do the revaluation? If fair value changes significantly and volatile changes, annual. There are significant changes but not volatile, then every 3 to 5 years you can do revaluation. Now what is the accounting treatment for revaluation? This is important, listen to me carefully. Sir, the standard has given two techniques, sir. For accounting, there are 2 techniques. Listen to me carefully. 2 techniques for revaluation accounting. First technique, restatement approach. First technique is what? Restatement approach. Restatement approach. What is this restatement approach, sir? For example, PP is there. Before revaluation, the cost is 10 lakhs, sir. Accumulated depreciation on it, 5 lakhs. So net book value, 5 lakhs. Now, I want to do the revaluation. Fair value is 7 lakhs. So therefore, 5 lakhs asset must brought to 7. So what is the revaluation gain? 2 lakhs. Now this approach says, restatement approach says, when you are revaluing the net book value of the asset to fair value, proportionately cost and accumulated depreciation also increase. For example, see this. If 5 lakhs has become 7, 5 lakhs has become 7. So if my cost is 10, if my cost is 10 lakhs, net book value 5 lakhs na? Everybody, suppose if my net book value or fair value is 7, what should be the cost? Proportionately you do. You understanding? Suppose net book value 5 sir, cost is 10 na? If it is 7, what should be the cost? So 10 lakhs into 7 divided by 5. 14 lakhs is the PPE after revaluation. Similarly, accumulated depreciation also. See this. For 5 lakhs net book value, 5 lakhs accumulated depreciation. For 7 lakhs, how much it is? 5 lakhs into 7 by 5. 7 lakhs. So therefore, your cost of the asset 14, your accumulated depreciation 7. 14 minus 7, 7. That is exactly the fair value of the asset. So what is the entry here? PPE account debit. How much? 4 lakhs. 2 accumulated depreciation. How much? 2 lakhs. Remaining will be revaluation gain. That's it. PPE 4 lakhs. Accumulated depreciation 2 lakhs. Revaluation gain 2 lakhs. Everybody, this is called restatement approach. This is called restatement approach. Very, very important. I think I explained very easily. So therefore, cost of the asset, accumulated depreciation, book value. Now, fair value. Proportionately, you increase cost and accumulated depreciation. If net book value is 5, cost is 10. If net book value is 7, if this fair value is 7, what will be the cost? 14. If 5 is the accumulated depreciation. If net book value is 7, what will be the accumulated depreciation? 7 lakhs. Proportionately, you increase. That means cost of the asset increased 10 to 14. 4 lakhs gain. So asset value. Accumulated depreciation has 5 to 7 depreciation. Accumulated depreciation 2 lakhs. So it will be created. So therefore the net is revaluation gain of 2 lakhs. This is one approach, sir. Second technique is also there. What is the second technique? Elimination approach. What this technique says is, in elimination approach, whatever the accumulated depreciation is there, first you adjust this against the cost of the asset. So therefore the entry is accumulated depreciation to PPE. This entire accumulated depreciation is just adjusted to cost. Once you brought this cost, I mean accumulated depreciation is adjusted with cost, then you compare with fair value. For example, see here, original cost of the asset 10, accumulated depreciation 5. After revaluation, this will become 0 because entire accumulated depreciation is adjusted against cost. So it is 0. Now the cost will become how much? Tell me. 5 lakhs reduced because of this, plus now I am doing revaluation now. Because of the revaluation, how much added? 2 lakhs. So therefore 7 lakhs. So therefore the entry is, see this, first accumulated depreciation is adjusted against the cost of PPE. The entry is accumulated depreciation to PPE. Then adjust PPE to its fair value. That means PPE to revaluation gain. PPE to revaluation gain. So that means 2 entries. First accumulated depreciation is adjusted against the asset. The entry is accumulated depreciation to PPE 5. Then PPE will be brought to its fair value. PPE to revaluation gain. Revaluation gain 2 lakhs. So what is the net effect of both the methods? Same. Sir, net effect is same. Here in this method you see cost 14, accumulated depreciation 7, 7 lakhs is the carrying amount of the asset. Here also see cost 7, accumulated depreciation nil. So carrying amount of the asset is 7. So what is the difference between restatement approach and elimination approach? In restatement approach, cost to accumulated depreciation both were proportionately increased, corresponding with fair value. But in elimination approach, accumulated depreciation is completely adjusted, first adjusted, and then brought to fair value. Okay. Sir, what is the accounting treatment for revaluation? See this. See, when you do revaluation, sir, when you bring the asset to its fair value, either there can be upward, there can be downward revaluation. For example, upward revaluation, first time you are doing, that will be transferred to revaluation surplus or revaluation gain account. For example, PPE to revaluation surplus, 10 lakhs, 10 lakhs, increase. Suppose downward revaluation is there, downward. Asset value decreased. Whenever asset value is decreased because of the revaluation, loss will be transferred to P&L account, first time. Next, subsequent revaluation. First time upward, sir, second time also upward, same entry will be written. Upward means PPE to revaluation surplus. First time downward, sir, second time also downward, same entry. P&L to PPE. Now see, important. First time upward, sir, second time downward. What we need to do is, second time, for example, asset value decreased by 15 lakhs. First time increase how much? 10 lakhs. That increase is transferred to revaluation surplus. So second time when there is a decrease, na sir, to the extent of this 10 lakhs adjust to revaluation surplus. Remaining excess loss will be transferred to P&L account. So therefore revaluation surplus P&L to PP. First time downward, second time upward, sir. Second time when there is an upward, suppose 15 lakhs increase. First whatever the amount you transfer to P&L account, na, first that will be adjusted. See this, P&L account previously debited to 10. Now to the extent debited 10 earlier, it is created. Remaining will be transferred to revaluation surplus. Hello? Now, one interesting point I will tell you, sir. This revaluation surplus arised, na? Why revaluation surplus arising? Because you are valuing the asset at its fair value. Now, whenever you sell the PP, that asset is sold, the revaluation surplus will also be closed, transferred. Where it will be transferred? It will be transferred to retained earnings, revenue reserves, not to P&L account. Important. Sir, whenever an asset which is revalued earlier, so there may be revaluation surplus. That revaluation surplus, when that asset is sold, transfer it to retained earnings. That means revenue reserve, not to P&L account. Simple. Sometimes, sir, you sold only part of the asset. For example, there is a PP, property, plant, equipment is there. It was revalued. Now in that PP, part of the PP you are selling, na, part of the revaluation surplus will be transferred to retained earnings. How much part I will transfer? The standard says is this. If part of the PP is sold, depreciation based on revalued amount is how much? Depreciation based on original cost. Suppose if there is no revaluation, what is the depreciation on original cost? Take it. What is the depreciation on revalued amount? The difference only will be transferred from revaluation surplus to retained earnings. This is the important point. Whenever any asset is sold, in respect of which there is a revaluation surplus, if that asset is completely sold, that revaluation surplus will be transferred to revenue reserve. Suppose only part of the asset is sold, then you need to transfer only part of the revaluation surplus to retained earnings. How much is that part? Simple. You calculate depreciation based on the revalued amount. Without revaluation, what is the depreciation? Suppose if there is no revaluation, what is the depreciation? 7. Because of the revaluation, what is the depreciation? 10. Generally, sir, because of the revaluation, depreciation will increase. So whatever the increase is there, na, sir, to that extent I need to transfer from revaluation surplus to retained earnings. This is the important point. So we have completed the subsequent measurement also. We have completed subsequent measurement. So these are all the points I claimed. And the last concept is remaining. What is that? Depreciation. So depreciation of the asset. See this. First of all, when to commence depreciation? When the asset is available for use. When the asset is available for use. Important, sir. Depreciation begins when the asset is available for use. That is, when the asset is in the location and condition necessary for it capable of operating in the manner intended by management, you start depreciation. Not when the asset is actually started using. The moment the asset is ready for use, you can provide depreciation. Next, when to stop depreciation? When to stop? The standard says when the asset is classified as held for sale or when the asset is derecognized, whichever comes earlier. That is the point you need to stop providing depreciation. When the asset is classified as held for sale, that means when the asset is, you don't want to use it, you held it for sale, you want to sell it, you want to sell that asset, dispose that, or the asset is derecognized from the books. Suppose that asset is derecognized from the books, whichever comes earlier, that is the starting point. For example, the asset is held for sale on 1st January 2024. Asset was derecognized on 31st March 2024. Now tell me, when will you stop providing depreciation? 1st January onwards you stop providing depreciation because the asset is held for sale. Important, sir. The moment the asset is held for sale, you please stop providing depreciation. And next, depreciation method. Sir, which method I need to follow? Standard saying depreciation method should reflect the pattern in which the economic benefits are generated from the PP. Sir, that asset is generating economic benefits. What is the pattern of those economic benefits? Based on that, you need to select the method. For example, if the asset is constantly giving same benefits, straight line method. If the asset is giving initially high benefits, later on gradually decreasing, WDV method. So therefore, the method selection is depending upon, it should reflect the pattern in which the asset's future economic benefits are consumed by the entity. You can follow straight line method, WDV method, units of production method. Whichever method you want to follow, you follow. But that method should reflect the benefits I am receiving from that particular asset. These wordings are very, very important. They should reflect the pattern in which the asset's future economic benefits are consumed by the entity. And sir, whenever you change any depreciation method, what is that? Change in depreciation method is change in accounting estimate. And you need to do which accounting? Prospective, not retrospective accounting. Only prospective accounting you need to do. Next, retirement concept. What is retirement? I told you just now. When the asset is held for sale, see this, items of PP retired from active use and held for disposal. See this. For example, there is a plant and machinery, sir. That plant and machinery we don't want to use. Okay, just we put it in the godown. That means it is retired from active use and held for disposal. The moment you are hold any asset for sale, you are not using it for active use, the standard says you need to value that asset at a lower of the carrying amount, net realizable value. Compare the carrying amount of that asset and net realizable value. Whichever is lower, you need to show. For example, carrying amount is 1 lakh. NRV 80,000. So 20,000 loss you need to book, sir. This is 80,000, sir. So suppose the carrying amount of the asset is 1 lakh, sir. Net realizable value 80. So how much decreased, sir? 20. So that 20,000 you need to recognize as a loss. The standard says any write down will be recognized immediately in the statement of P&L. This when will you do? When the asset is retired from active use and held for disposal. The moment the asset is held for disposal, you stop providing depreciation also. I told you when to cease depreciation. When the asset is held for disposal or the asset is derecognized, whichever comes earlier. That means if the generally earlier event is what? When the asset is removed from the active use and held for disposal. That is only initial event will come. Okay, generally. Now derecognition. What is derecognition? When the asset is sold. You sold the asset. Or when asset is no longer generating future economic benefits. You derecognize it. When the asset is sold, derecognize. We will remove from the books. Or when the asset is no longer generating future economic benefits, then also derecognize. If any one of these things happens, then asset will be derecognized. Now, when you derecognize, you will get any gain or loss. Gain or loss. For example, you sell at the time of sale. If the sale value is more than carrying amount, gain. If the sale value is less than carrying amount, loss. Loss or gain will be recognized and transferred to P&L account. Sometimes you don't sell. You just scrap that, return off that asset. Entire carrying amount is a loss that will be transferred to P&L account. So net gain or loss is net disposal proceeds minus carrying amount of the item. So relating to depreciation, you need to remember, I think 4 points. What are those, sir? First point, when to commence depreciation. First of all, what is depreciation? Systematic recognition of loss of an asset. What is depreciable amount? Cost minus residual value. Correct? And when to start depreciation? When the asset is available for use, not actual usage. Asset is available for use. When to stop providing depreciation? When the asset is held for disposal or asset is derecognized. Whichever comes earlier. Whichever comes earlier. This is the second point you need to. Next, third method. Which method you need to select? The method should reflect the economic benefits generated by that asset. Fourth point, retirement. The moment the asset is retired from active use and held for disposal, the asset will be recognized at a carrying amount, net selling price, whichever is lower. Any gain or loss will be transferred to P&L account. And derecognition, when the asset is sold or when the asset no longer generating future economic benefits, you derecognize the asset from the books. Remove. At the time of removal, any gain or loss came, that will be transferred to P&L account. That's it. This is accounting standard 10, sir. Entire standard we have discussed it, sir. This question, sir, illustration 10, very good question, sir. Actually, this is important question actually. You see, entity A is a large manufacturing group, sir. It owns a number of industrial buildings. What are the buildings? Industrial. Such as factories, warehouse and office buildings in several capital cities. Industrial buildings are located in industrial zones, whereas office buildings are central business districts of the cities. Entities A management want to apply revaluation model as per AS 10 to the subsequent measurement of office buildings, but continue to apply historical cost model to the industrial building. State whether it is acceptable. Sir, revaluation model, I told you. Can I make selective application of revaluation model? I need to apply revaluation model for entire class of assets. Here, what are the assets? Buildings. Which buildings? Office buildings, industrial building. Both are same class or different class? Different class. That is the twist here. So industrial buildings are different from office buildings. Therefore, company want to follow. They want to follow what? Cost model to industrial buildings, revaluation model to entire office building, which is accepted. So company can do so. Suppose, for example, within the industrial buildings, for some industrial buildings, for some godowns, they want to follow cost model. For some godowns, they want to follow revaluation model. Is that allowed? No. So therefore, you need to understand the nature of the asset. Depending upon that, you need to decide which is belongs to which class. Hello. Next. This question, sir, I think examination question this is. See this question, illustration 6. Gain on replacement of insured asset. This question they have asked once in examination. Entity A carried plant and machinery in its books at 2 lakhs. These were destroyed in fire. The assets were insured new for old and were replaced by the insurance company with the new machines that cost 20 lakhs. The mission was acquired by the insurance company and the company did not receive 20 lakhs as cash compensation. State how entity should account for the same. First, what happened? There is a plant and machinery. What is the cost of book value of the plant and machinery? 2 lakhs. It was destroyed by fire. And we have insurance. Insurance is what? New for old. That means in place of old one, insurance company will give new machinery they will give. They won't give cash. Hello. So it was replaced by insurance company with new mission. What is the cost of the new mission? 20 lakhs. Mission was acquired by the insurance company and company did not receive 20 lakhs cash compensation. So tell me how you are going to do the accounting in this case. How you are going to do the accounting, sir, in this case? Hello? How you are going to do the accounting? Simple, sir. See this. So first, loss of accident. We have loss, na, sir. How much worth of asset lost? 2 lakhs. De-recognized from the books. So loss of plant and machinery by accident to plant and machinery. 2 lakhs, 2 lakhs. Next, you are going to receive insurance. Insurance claim. IC receivable 20 lakhs. Loss of plant and machinery by accident 2 lakhs. Gain on settlement 18 lakhs. Your asset book value 2 lakhs. But you are receiving plant and machinery worth of 20. So therefore, insurance claim receivable 20 lakhs. Loss adjusted with this. So remaining is gain on settlement. Everybody. And finally, you need to record the new plant and machinery. Plant and machinery to insurance claim receivable 2020. So 3 entries, sir. First entry, loss. What is the entry? Loss by accident to plant and machinery 2. Next, insurance claim receivable. IC receivable 2 loss. Loss is adjusted against insurance claim. Balance is gain. And finally, you record the new asset which you received from insurance company. Plant and machinery to IC receivable. Insurance claim receivable. Settle. Correct? So this is one question they have asked in examination. Please check this question. Next, theory questions are there, sir. Here, please check all these questions. 13th done. 14th. 15th you see. 15th question. Skanda Limited acquired a machinery for 2 crores 50 lakhs for 5 years ago. Depreciation was charged at 10% on SLM basis. 5 years ago they acquired, sir. Useful life 10. At the beginning of year 3, see this, the machinery was revalued to 3 crores with the surplus on revaluation being credited to revaluation reserve. Depreciation was provided on the revalued amount over the balance life of 8 years. The machinery was sold in the current year for 1 crore 12 lakh 50. Give the accounting treatment for the above in the company books. What will be the treatment if the machinery is fetched only 42 lakh 50? First of all, you have to be very careful here. When I purchased the machinery 5 years back, how much is the cost? 2 crores 50 lakhs. So take the first cost. Second thing is, now I am at the beginning of year 3. That means 2 years already over. So on this 2.5 crores depreciation you calculate for 2 years. What is the depreciation amount? 10%. 2.5 crores into 10% means 25 lakhs for 2 years. That means 50 lakhs. So what is the WDV value? 2 crores at the end of second year. Correct? Now they have done the revaluation. What is the revaluation amount? 3 crores. Correct? So therefore asset will be brought to 3 crores. So there is a gain of how much? 1 crore. See this revaluation surplus 1 crore. Everybody? Now what they are doing? Depreciation was provided on the revalued amount over the balance useful life of 8 years. Correct. The revalued amount is 3 crores, right? So 3 crores divided by 8. 3 crores divided by 8. That is depreciation from third year onwards. Third, fourth, fifth. Now what happened? The machinery was sold in the current year for 1 crore 12 lakh 50. What is the current year, sir? We purchased asset 5 years ago. 5 years ago we purchased. That means we are at the beginning of the 6th year. That means revaluation happened at the beginning of 3rd year. That means, see, first cost 2.5, depreciation reduced. This is the WDV at the beginning of the 3rd year. 3rd year beginning there is a revaluation, so 3 crores. That means 3rd year, 4th year, 5th year, you need to provide depreciation on the revised carrying amount. What is the revised carrying amount? 3 crores. So 3 crores divided by remaining life is how much? 8. Divided by 8 into 3. 1 crore 12 lakh 50. Remove it. You will get the carrying amount at the end of 5th year. What is the carrying amount? 1 crore 87 lakh 50. Now you sold this for 1 crore 12 lakh 50,000. Hello. So therefore disposal proceeds 1 crore 12 lakh 50. Carrying amount is this. So there is a loss of 75 lakhs. Now I told you, whenever an asset is sold, in respect of that asset already there is a revaluation surplus that will be transferred to retained earnings. Here the revaluation surplus is how much? 1 crore. So entire 1 crore will be transferred to retained earnings. Now suppose they are asking one more question, sir. What will be the treatment if the machinery fetched only 42 lakh 50,000? Suppose if it fetched only 42 lakh 50,000, your loss will be 1 crore 45 lakhs. 1 crore 45 lakhs. And here also entire revaluation surplus will be transferred to retained earnings. This is one question, sir. I will not take much time. See this question number 17. Important question, examination point of view. Can RTP January 2025 attempt. This question given. There is a company, Bharat Infrastructure Limited. They acquired a heavy machinery at a cost of 1000 lakhs. Okay. The breakdown of its component is not provided. It is estimated useful life of the machinery is how much? 10 years. At the end of year 6, see this, at the end of year 6, the turbine, which is a major component of the machinery, needed replacement. As further usage and maintenance was uneconomical. The remainder of the machine is good condition and it is expected to last for remaining 4 years. The cost of the new turbine is how much? 450. Give the accounting treatment of new turbine assuming SLM depreciation and discount rate is 8%. Sir, tell me, this question is relating to replacement of major part. Correct? How to find out the WDV after replacement? First we need to take the WDV of the original asset. For that, cost of the new part will be added, WDV of the new part will be deducted. Correct? So see this. First, here there is a machinery, 1000 crores, 1000 lakhs. Life is 10. In this machinery there is a component called turbine. Now we are replacing this turbine. The new turbine cost is how much? 450. See, first you take the cost of the machinery. For that, add cost of the cost of the new turbine you should add, cost of the old turbine you need to deduct. And this is happening when? At the end of 6th year. So therefore first you take the cost, sir. From that reduce depreciation for 6 years. You will get the WDV. Depreciation how to provide, sir? What is the life? 10 years. So 1000 divided by 10 into 6 years. 600 lakhs. So therefore what is the WDV? 400. For this you add cost of the new turbine. What is the cost of the new turbine? 450 given in the question. Now I want what? WDV of the old turbine, carrying amount of the old turbine. But I don't know the original cost of the old turbine. If I know the original cost of the old turbine, from that 6 years depreciation I will deduct, then I will get the carrying amount of the old turbine. In the question, have they given old turbine cost? No. They have not given any breakup. Then how to find out it? In the question, they have given you discount rate of 8%. Now what we can do is, based on the cost of the new turbine, what is the cost of the new turbine? 450. Now it is at the end of the 6th year. At the end of the 6th year, the new turbine cost is 450. Based on that, you estimate You go to past and estimate before 6 years what will be the cost. Before 6 years. How to find out it? See this. The formula is to find out the past cost. Current cost divided by 1 plus r whole power n. Current cost 450 divided by 1 plus 8% for 6 years. 283.58 lakhs. This is the cost of what? Old turbine at the beginning of the first year. From that 6 years depreciation you deduct. 283.58 divided by 10 into 6. 170.146. This is the WTV. Remove it. So therefore, the same question may come in exam, sir. What is the twist, sir? You understood the twist? Based on the current value, you need to find out past. What is the formula we used? 450 cost divided by 1 plus r whole power n. That's how we need to find out. That's the only thing. So this is one question, sir. Okay. So remaining questions you solve, sir. I think this question is also very easy question. Simple question only. Okay, with this we completed AS 10. Okay, the next accounting standard we are going to discuss is AS 26, intangible assets. Generally AS 10 to 26. Once first complete AS 10, sir, after that AS 26, because some of the provisions of AS 26 is exactly same as AS 10. Okay, it is just a duplication. That's why. See, for tangible assets, AS 10 is applicable. If you see AS 10, we have discussed right from what is PPE, when PPE will be recognized, okay, recognition criteria, the cost, initial measurement, subsequent measurement, depreciation, everything we discussed it now. Similarly, relating to intangible assets, AS 26 they have brought. So the entire journey of intangible assets, definition, recognition, initial measurement, subsequent measurement, amortization, derecognition, retirement, disposal, disclosures, everything relating to intangible assets is covered under this standard. Okay. Now first let us try to understand what is the intangible asset. That is the important thing in this standard, sir. What is intangible asset? Sir, the standard says intangible assets are identifiable non-monetary assets without physical substance, which are held for use in production of goods or supply of services, or maybe rental to others or for admin purposes. Just like PPE definition. PPEs are assets held for use in production or supply of goods, rental to others, administrative purposes. Similarly, intangible assets also held by the organization for any one of these purposes. But here the main thing is identifiable. See the one by one, sir. First, identifiable. Intangible assets are identifiable. What is identifiable means? Identifiable means these intangible assets must be separated, must be separable. They must be sold. They can be exchanged. They are capable of generating some benefits. Identifiable. So this identifiability means it is distinguished from goodwill. The most common intangible asset is what? Goodwill. But if you want to say anything as your intangible asset, it must be separated. It must be separated from goodwill. When we say an asset is separated, two ways. There are two ways to say the asset is identifiable. Two ways to say the asset is identifiable. One is separable. You must be able to separate it. Separated means you must be able to rent it, sell it, exchange it, distribute it. You must be able to generate future economic benefits from it. Then we say it is separable. Second, that must arising from contractual or legal rights. Then we say if any one of these things happen, then it is called identifiable. So to become intangible asset, that intangible asset must be identifiable. Identifiable means either it must be separable, or it must be arising from contractual or legal rights. That right must arising from contractual or legal rights. Then we say it is identifiable. And here separable means you must be able to generate revenue from it. That asset you can rent it, sell it, exchange it, distribute it, and you can able to generate future economic benefits independently from that asset. Then we call it as separable. Okay. Next to non-monetary asset. Intangible assets are what? Non-monetary. Non-monetary means they see monetary, non-monetary. Monetary means an asset which is realizable in terms of money is called monetary. Like for example, debtors, financial assets. They are monetary assets. Intangible assets are not monetary. They are non-monetary in nature. They are non-monetary in nature. For example, I said intangible asset is 1 lakh. Is this 1 lakh is going to be realized in terms of cash? No. This 1 lakh is not going to be realized in terms of money. So it's a non-monetary asset. AS 11 actually. AS 11 talks about monetary, non-monetary items. Monetary items are what? Money held and any assets to be received in fixed or determinable terms of money. Any asset to be received in fixed or determinable terms of money is a monetary item. For example, debtors. Debtors is the best example for monetary items, monetary assets. Okay? Or for example, investment in debt securities. When you invest in debt securities, it is an asset which is realized in terms of money. So basically that asset must be realized in terms of money. Then it is called monetary asset. But intangible asset is which asset? Non-monetary, other than monetary. Other than monetary. Without physical substance. Sir, if the asset is having physical substance, that will become PP, tangible asset. Without physical substance, intangible asset does not have any physical substance. Like for example, patents, copyrights, trademark, franchises, these are all intangible assets. And why they are held? Either they are held for use in production, supply of goods, services, rental to others, or for administrative purposes. So this is the definition of intangible assets. So to recognize intangible asset, tell me, separability test or legal or constructual test. That intangible asset must arise either from law or contract, or it must be separated. Separated means you must able to identify it separately, you must able to gain revenue, generate revenue from that. Then we say it is identifiable. So that is the first thing. See, this intangible asset should be identifiable. Okay. Now measurement of intangible asset. One important point, sir. See, sometimes what happens here, without physical substance, I told now. Intangible assets means without physical substance. Sometimes intangible assets are mixed with physical. For example, a software included in the CD. There is a CD. CD is a physical component. In that software is there now. Software is what? Intangible. Now tell me that CD is tangible asset or intangible asset? We need to see in that CD what is the most important thing? Software. So therefore it is intangible asset. For example, there is a painting. Mona Lisa painting is there. For example, painting is what? Tangible or intangible? Intangible. Why? Because the paint is what? Art. Art is a knowledge, formless. So the value is for the painting, not for the photo frame. Correct? Sir, Ravi Verma painting is there, 10 crores. 10 crores cost you are paying for photo frame? No. The art inside the thing, right? So, point you need to understand, sir. In case any tangible, intangible asset are mixed with each other, you need to see which one is important, which one is substance. Which one is substance? Accordingly, you need to decide whether it is tangible or intangible. Hello? See this. Sometimes some intangible assets may be maintained in physical substance. Example, software in a CD, patent in legal documents. The cost of the physical substance is typically not significant and part of the intangible asset is significant. Suppose if an asset is combined with both tangible and intangible elements, you need to see the predominant element. Which is the predominant? Tangible or intangible? Accordingly, you need to decide. If software embodied in a mission tool is treated as fixed asset because it's integral to the hardware. Non-integral software is treated as intangible assets. I will give you some examples. For example, there is a MRI scanner. You went to a hospital. There is a MRI scanner, right? Now tell me, MRI scanner tangible or intangible? In that MRI scanner, there is a software. Correct? But software is only integral part of it. Software is inside the MRI scanner mission, which is only integral part. So therefore here intangible asset is software, sir. Tangible asset is hardware, nothing but. But basically entire MRI scanner will be treated as what? PP, tangible asset only. Because even though here both tangible intangible elements are mixed, which one is predominant? Hardware is predominant. Software is only an integral part of it to run. For example, you take another example I will give. For example, you take a car. In car, there is an engine. Suppose engine control software is there. Now tell me, car tangible or intangible? Tangible. Even though in car there is a software included in it to control the engine, but still we are considering it as tangible. Why? Because their software is only integral part of it to run the hardware. Everybody. So therefore, if both tangible and intangible elements are mixed with each other, sir, the software is only an integral part to run the hardware. Then you need to see it as a PPE only. No, sir. Software is predominant, sir. The hardware is nothing. Hardware is nothing, sir. No value in it. Then it is treated as intangible asset only. Like CD, software inside the CD is example for what? Intangible asset. Okay. Next, sir, recognition of intangible asset. Sir, you want to recognize the intangible asset, sir. How you are going to recognize the intangible asset? Same as accounting standard 10. What accounting standard 10 says? Two conditions: probable future economic benefits, cost is measured reliably. Two conditions must be satisfied to recognize the intangible asset. Next, measurement, initial measurement of intangible asset. Important, sir. Sir, AS 10 says initially PP will be recognized at cost. Same thing is applicable for intangible asset also. Initially, when you acquire intangible asset, you will recognize at cost. Now the question is how to determine the cost. I want to recognize intangible asset in my books initially at cost. How to determine the cost? That depends on the mode of acquisition. You see here there are different modes of acquisition, sir. Mode of acquisition. Suppose for example, what are the modes of acquisition? Separate acquisition. You purchased intangible asset by cash or credit. Self-generated. Sometimes intangible assets are self-generated. Next, intangible assets acquired by government grants. We will acquire intangible assets by government grants. Next, sometimes intangible assets are acquired by exchange and intangible assets acquired by amalgamation. You need to see the mode of acquisition and accordingly you need to determine the cost. First we will see separate acquisition. Suppose intangible asset you purchased, sir. Intangible asset you purchased. Any copyright, patent, trademark you purchased. How to determine the cost? Same. Purchase price. Add all duties and taxes, and these duties and taxes should be non-refundable. Non-refundable duties and taxes. And any brokerage, commission, professional fees you pay, any trade discounts, rebates given, then you will get automatically cost of the intangible asset. Just like we discussed in AS 10. Purchase price, all the duties and taxes, non-refundable in nature, all the things, and also directly attributable cost. Any directly attributable cost. There, site preparation cost, installation cost, assembly cost. Okay, those costs are there now. Employee benefits, which is involved in construction acquisition of intangible asset. Same here also will be added. If all those costs are necessary for intangible asset, they will be added. Just like AS 10. Any directly attributable cost to bring the intangible assets to its present location and condition, we will add. Okay. Now intangible assets acquired by government grants. Sir, sometimes government will give you intangible assets. Now same as AS 10. It is covered in AS 12. Suppose AS 12 says if intangible asset is given free of cost, nominal value. Recognize intangible asset at nominal value. Nominal value means some immaterial value. Suppose if they are given at concessional price. Concessional price means discounted price. Recognize at acquisition price. For example, 10 crores value of intangible asset, government is giving at 5 crores. You recognize at 5 crores. This is intangible assets acquired by government grants. Next, intangible assets acquired by exchange. Sir, provisions are exactly similar to AS 10. So, if you recollect, just now we discussed AS 10. How to recognize the intangible assets, tangible PPE which is acquired by exchange of assets. I told you whether the exchange transaction has commercial substance or not. If there is a commercial substance, fair value of the asset given up, fair value of the asset received, WDV of the asset given up. This is the order. If there is no commercial substance, WDV of the asset given up. WDV of the asset given up. Same thing. Whenever exchange is happening, suppose you are acquiring one intangible asset, you are giving another intangible asset. For example, you are acquiring PP. Okay, you are giving trademark. So the PP which you are, the patent you are acquiring will be recognized at what value? You see whether the transaction has commercial substance or not. I told you what is commercial substance. Because of this exchange, our cash flows, the timing, the nature, amount must be affected. Then we say there is a commercial substance. If there is a commercial substance, this is the order. First, fair value of the asset given. This is the first priority. If not available, fair value of the asset received. If this is not also not available, WDV of the asset given up. Suppose if there is no commercial substance, then WDV of the asset given up. Next, intangible assets acquired by amalgamation. Out of all the concepts available, sir, this is one of the very good concept which is available from AS26, sir. Most of them doesn't know this. Please learn this. I think till now they have not tested any question on this, but I am expecting this time I want them to test this concept. Okay, listen to me carefully. Intangible assets acquired by amalgamation. You know, generally in amalgamation, what happens, sir? We will take over a company, right? That means one company will assets and liabilities will become our assets and liabilities. Amalgamation AS14. You know, amalgamation is two types basically. Amalgamation in the nature of purchase, amalgamation in the nature of merger. Now, suppose there is a company A Limited, which is a transferor company. Transferor company means the company which is transferring its business. There is a company called transferee B Limited, which is B Limited acquired A Limited, sir. This company is acquiring A Limited. This is amalgamation in the nature of purchase. Example, amalgamation in the nature of purchase. Because in amalgamation and merger, assets and liabilities will be taken over at their book values. So therefore, this will not work there. So if is amalgamation in the nature of purchase, here B Limited is taking over A Limited. Now, generally in amalgamation in the nature of purchase, assets and liabilities will be recognized at what values? Fair values. We will take the fair value of the transfer company. We will recognize in our books. Right? Now see this. Suppose if there are any intangible assets of transfer company, there are intangible assets in transfer company. We need to see, does they have active market? Whether the intangible assets which is there in the transfer company, do they have active market? Yes, no. Suppose yes, they have active market. Then standard says recognize them at their fair values. No restriction on the amount. Sir, when you acquire any company, if it is amalgamation in the nature of purchase, in that company, whatever the intangible assets are there, those intangible assets, if they have active market, you recognize them in your books. Transferee company will recognize the intangible assets. At what value? Fair value. There is no restriction. Suppose if they does not have active market, those intangible assets does not have active market, then the standard says, important, recognize them maximum to the extent of goodwill raised in amalgamation. Whatever the goodwill amount raised on amalgamation. When goodwill rise in amalgamation? When your purchase consideration is more than net assets. When purchase consideration is more than net assets, we will treat the difference as what? Goodwill. Only to the extent of the goodwill you will recognize the intangible assets. Sir, can you give any example? Yes. See this example, case number 1. Purchase consideration 100, sir. Net assets taken over excluding intangible assets 90. So how much excess you are paying? 10. That is called goodwill. Goodwill. Now fair value of intangible asset 15. Now tell me, active market exists. Active market is there for intangible asset. I told you when there is an active market, intangible asset will be recognized at a fair value. What is the fair value? 15. So therefore intangible asset is recognized at a fair value of the intangible asset 15. Now you see here 90 is the net assets. Now another 15 is added. 90 plus 15 105 is the net assets taken. But how much you are paying? 100. So therefore it will be capital reserve. When purchase consideration is greater than net assets, it is goodwill. Loss is goodwill. When you pay more than the net assets, that is a loss. Loss is treated as goodwill. But when PC is less than net assets, it's a gain. That gain will be transferred to capital reserve. Here you see, intangible asset is recognized at fair value because there is an active market. So 90 plus 50, 15, 105. We are paying 100. So how much excess? I mean, net assets excess we are taking 5. This will be treated as capital reserve. Now come to the second situation. Suppose if there is no active market for intangible asset. Now you tell me this intangible asset fair value 15, but it does not have active market. Then I told you we need to recognize only to the extent of goodwill. What is the goodwill? 10. So recognize at 10. Therefore no goodwill, no capital reserve will come. Because net assets 10, intangible asset will be recognized at 10. So therefore 90 plus 10, 100. PC also 100. Therefore no goodwill, no capital reserve. You understand? Now case number 2 you see. Suppose PC 100. Net assets 120. So there is a capital reserve. Correct? You are paying 100 but you are getting 120 pa. 20 is what? Capital reserve. Now fair value of the intangible asset 15. Now active market exists. When active market exists, fair value. So therefore intangible asset will be recognized at 15. So when you recognize in another intangible asset, what happens? Excluding intangible 120, now 15. How much? 135 is the net assets. But PC we are paying 100. So this is capital reserve 35. When you pay less than the net assets, that is a gain. That gain will be transferred to capital reserve. Now suppose if this intangible asset does not have active market, then does not have active market means you need to recognize only to the extent of goodwill. But in this case there is no goodwill. There is a capital reserve. Therefore intangible asset will be recognized at nil. No, it will not be recognized. And your capital reserve will be at 20 only. So therefore the concept is, if no active market exists for an intangible asset, then recognize maximum to the extent of goodwill arising in amalgamation. The cost of the intangible asset initially recognized is restricted to an amount that does not create or increase capital reserve. Because of the recognition of intangible asset, it should not create or increase capital reserve. That means only if there is a goodwill, to the extent of the goodwill, we need to recognize the intangible asset. If there is no active market for intangible asset. If there is no active market for intangible asset, this is what you need to do. Are you understanding, sir? Sir, you understood? So tell me, when you acquire any company, in that companies there is an intangible asset. Now at what value that intangible asset will be recognized in your books? If there is an active market, fair value. If there is no active market, to the extent of goodwill. Goodwill means PC, net assets you compare. PC is more than net assets, goodwill. You recognize only to the extent of goodwill. Suppose there is no goodwill, don't recognize. Don't recognize. When there is no active market, you need to remember, there is no active market, there is no goodwill. Then only you should not recognize. Suppose there is an active market, there is no goodwill, no problem. You have to recognize at a fair value. In that situation, even capital reserve created, increase, no problem. Next, sometimes a self-generated intangible asset, sir. Self-generated. Sir, we are discussing what, sir? Initial measurement. Correct? There are 5 cases. One is separate acquisition, we covered. Next is self-generated. Self-generated we are discussing now. See this. We completed separate acquisition, government grants, exchange, amalgamation. Now come to self-generated, sir. Sir, like PP, even intangible assets also self-generated. Here when it comes to self-generated, no, sir, there are 2 things. One is internally generated goodwill. Goodwill, self-generated goodwill. Goodwill is intangible asset. Self-generated goodwill. Other than goodwill, self-generated. Other than goodwill, self-generated means research and development, R&D. R&D. Now see, important point I am telling, sir. Standard AS 26 says internally generated goodwill should not be recognized in the books. Should not be recognized. Why? Because in order to recognize intangible asset, I told you, probable future economic benefits, cost is measured reliably. One thing is you cannot measure the cost reliably. Can you measure how much is the cost of self-generated goodwill? Are you spending any amount for generation of self-generated goodwill? No. What is basically goodwill? Your reputation, right? Whatever the reputation, fame, extra advantage you had is called goodwill. Are you paying something to acquire? No. Self-generated. Sir, if it is a purchased goodwill, we will recognize. AS 26 says goodwill basically two types. Purchased, self-generated. Now, just now we have seen amalgamation. In amalgamation, generally what will come? Purchased goodwill come. This will be recognized if required. Purchased goodwill will be recognized. But self-generated goodwill will not be recognized, because the cost cannot be measured reliably. One more thing is, self-generated goodwill, identifiability is not there. We have seen intangible asset definition now. Intangible assets are first identifiable. I told you, identifiable means separated, or it should arise from contractual or legal rights. That means if it is a purchased goodwill, it is arising from contractual or legal rights. But if it is a self-generated goodwill, can I separate it? Now, can I separate the goodwill from the business? No. Can I self-generated goodwill, can I sell? Can I exchange it? Can I generate future economic benefits out of it? No. You cannot separate self-generated goodwill from the business. Therefore, it cannot be recognized as an intangible asset. Only purchased goodwill can be recognized because it is arising from contractual or legal rights. Hello. So therefore, self-generated goodwill other than goodwill. Self-generated goodwill, ignore. Don't recognize. Next, purchased goodwill you recognize. Now come to other one. Internally generated other intangible assets. How can you develop other intangible assets? Through R&D, research and development. Companies doing research and development now. Now, research and development important, listen. All expenses you spend in the research stage charge to P&L account. For example, there is a company which is doing research to develop a new medicine. Whatever the expenditure they are spending in the research stage, charge to P&L. Now come to development phase. Important. Sir, in research and development, first phase research. All expenses spent in research stage, P&L account. Now come to development phase. Sir, in the development phase, can I recognize intangible asset? The answer is yes, subject to 6 conditions. Subject to 6 conditions. So the standard says, in case of self-generated other intangible asset, intangible assets can be recognized subject to satisfaction of 6 conditions. This may test in exam, sir. Say this. 6 conditions, very, very important, sir. Yeah, mark it as important. They may. So 6 conditions. What are the 6 conditions? First, technical feasibility should be there. Whether it is technically feasible to complete the intangible asset. Technical feasibility of completing the asset for use or sale. Intangible asset, is it technically possible to develop it? See it. It should come from top management. Hello. Next, intention to complete and use or sell the asset. Whether you have the intention to complete the development, research and development, and use or sell this asset, whether management has the intention, top management has the intention to focus on this development of intangible asset, they are ready to spend the amount. You need to see the intention. Intention to complete and use or sell this intangible asset. Third one, ability to use or sell the asset. Can the company has the ability to use or sell this intangible asset which we are able to develop? Ability. What is the ability to use or sell? Next, asset is going to generate probable future economic benefits? Suppose you are developing something, you are for any formula, patent, copyright, anything. Suppose you are developing one new medicine for heart disease. Now, whether this medicine, suppose if I develop, can it give some economic benefits? You need to see. Next, adequate resources. Whether company had adequate resources to complete the development. And last one, ability to measure reliably. Can company able to measure what is the expenditure we spend for development? If all the 6 conditions, yes, the answer is yes, then in development stage, you can recognize intangible asset. So technical feasibility, intention to complete should be there, probable ability to use or sell that asset should be there, probable future economic benefit should be there, company should have adequate resources to complete the development of intangible asset should be there, and you should be able to measure the cost reliably. How much amount I am spending, you should be able to measure it. Then in that situation, you can recognize intangible asset in which stage? Development stage. And next one, sir, prohibited reinstatement. Sir, suppose any expenditure previously recognized as charge to P&L. Later on, development happened. Once the expenditure is charged to P&L account, again, can I capitalize? No. The standard says no. Bakwas Bankar. Once you capitalize, for example, once you charge any expenditure to the P&L account, that's it. Later on, you cannot capitalize. Reinstatement is not allowed. So expenditure previously recognized as an expense cannot be reinstated as an asset. Okay. Next. Next, sir, subsequent expenditure. We have completed initial measurement. Subsequent expenditure, sir. Sir, suppose you have recognized an intangible asset. Relating to that intangible asset, you have subsequently some expenditure has been incurred. Whether that subsequent expenditure will be capitalized or not. Simple. If the subsequent expenditure, same condition, if the subsequent expenditure is giving me future economic benefits and it will improve the performance of my asset, thereby I am going to generate some future economic benefits, and the cost is measured reliably, then I can capitalize the subsequent expenditure. Otherwise, the subsequent expenditure should be charged to P&L account. Okay. So subsequent expenditure on an intangible asset should be expensed when incurred. Generally expense, but if it is probable the expenditure will enable the asset to generate future economic benefits exceeding its originally assessed performance. If the subsequent expenditure is enable the performance of the asset beyond its originally assessed performance, and if the measurement is reliable, then subsequent expenditure can be what? Subsequent expenditure can be capitalized. Subsequent expenditure can be capitalized, sir. Next concept is amortization, sir. What is that? Amortization. Sir, for PPE, we have provided what? Depreciation. For intangible assets, we will provide amortization. Why the word amortization? Why can't it be depreciation? Because see, every PPE is a kind of a physical asset, right? That is, every physical asset will have a limited life. But intangible assets are not physical assets. So, some of the intangible assets will have a long life, very long life. Therefore, writing depreciation is not technically correct. What we will do is we will amortize it. Amortize the cost. That's why they use the word amortization. Now, here the important point I am going to tell you, sir. Same as depreciation only, sir. Amortization is exactly same as depreciation only. But the important point is, in case of intangible assets, sir, there is a rebutable presumption that the life of the intangible asset cannot exceed 10 years. This is a very important point. AS 26 says you need to make an assumption that intangible asset life cannot exceed 10 years. Like that, you need to assume and you need to provide depreciation, amortization. Sir, rebutable presumption. This is which presumption? Rebutable presumption. What is rebutable presumption? Rebutable means something which we can prove otherwise. That means if you have a solid evidence to say, no sir, my life of the asset is 15 years, take 15. No sir, my life of the intangible asset is 5 years, take 5 years. So suppose if there is no evidence available, what is the life of the intangible asset? So then you assume it is a 10 years. So there is a rebutable presumption that the life of intangible asset cannot exceed 10 years. And when to commence providing amortization? Same as AS 10. AS 10 says when to commence depreciation? When the asset is available for use. Same here. When the intangible asset is available for use. When to stop providing depreciation? When the asset is held for sale or asset is de-recognized, whichever comes earlier. Same point. What are the methods we need to follow? Same. AS 10 says the method should reflect the pattern of economic benefits which that asset is going to generate. I told na, depreciation method should reflect the pattern in which the economic benefits are generated from that particular asset. So therefore you follow straight line method, WDV method, any other method, but the method you select should reflect the pattern in which the economic benefits are generated from the intangible asset. Sir, generally, sir, in case of intangible asset, the residual value is assumed as 0. Residual value is assumed as 0. Suppose if there is a third party who has given a guarantee that I am going to pay some amount for this, then residual value will be considered as that amount. Hello, if there is an active market for intangible asset and if there is a third party who promised some amount, then it will be residual value will be considered for intangible asset. Otherwise, generally the residual value of intangible asset is what? 0. Okay. And derecognition of intangible assets same as AS10. When will you derecognize? When it is sold, when it is no longer generating future economic benefits. Disposed, no future economic benefits. And I told you now, when you derecognize, any gain or loss will be charged to P&L account. That's it. This is the standard. So if you see the main thing, this is the standard, sir. Main things I have completed, sir. Main things. So after AS10 you complete the standard, sir. Almost it is exactly same, sir. Majority of the topics it is same only. But the interesting important points I told you. What is that? Any intangible assets acquired by amalgamation and method of depreciation, amortization. Life cannot exceed 10 years. That one is important. Exchange of assets, so all these are same. Entire expenditure which is spent on research stage, charged to P&L account. Development phase, 6 conditions, correct? Now you see some study material, they have given some examples, sir. See this two examples I will tell you. Hydroelectric power. A company buys the right to generate hydroelectric power for 60 years. Suppose you acquired a right to generate hydroelectric power. Any right is an intangible asset. How many years you get the right? 60. Power generation is cheaper than other sources. This hydroelectric generation, and the demand in the area is expected to last for at least 60 years. Demand is also there for the electricity. The company amortized the asset over 60 years unless proven otherwise. That means here clearly the evidence is available. What is the evidence here? We have taken the right for 60 years and the demand is also there for 60 years. That's what standard says. There is a reputable presumption that the life cannot exceed 10 years. Here reputable means something you can prove otherwise. You can prove otherwise, na? Here 60 years you have taken the right and 60 years there is a demand. Everybody. Next, toll motorway. For example, a company gets exclusive right to operate a toll road for 30 years. No new roads are planned and the toll road is expected to operate for 30 years. So in this case, amortization will be given for 30 years. Whatever the right you are getting, it is an intangible asset. Some amount you will pay now, that is intangible asset. That will be written off, amortized over a period of 30 years. For example, another example, a company X buys a 10 years copyright for safety product. After 7 years, new environmental laws make the product obsolete. See this. Actually, you buy copyright for how many years? 10 years. But after 7 years, what happened? There was changes in law. That means this copyright has become obsolete. That means you need to amortize only for 7 years. After 7 years, whatever the balance is there, you should completely written off in the 7th year itself. The company must write off the remaining value immediately in the year of law changes. Okay. Now see the questions. See the questions in AS26, sir. First question, very simple question. There is a company, sir, ABC Limited, which is a developed one. Know-how, intangible asset. Expenditure they spend is 20 lakhs. Know-how is intangible asset, right? This was used from 1/4/2011. Useful life 10 years from the year of commencement. The company has not amortized the asset till 31st March 2018. So from 1/4/2011 to 31st March 2018, how many years? 7 years. 7 or 8? 7. Past journal entries to give effect to the value of know-how as per AS26. Sir, simple, sir. This question asked in September 24 also. What is the cost of the intangible asset? 20. Divided by life 10. Hello? Into 7. Till now 7 years completed. So 20 divided by 10 into 7. 14 is the amortization. In that 14, current year amortization 2. That means remaining 6 years prior period. So AS5 says, when any expenditure you have omitted to record in the previous years and you are recording in the current year, you need to write it as what? Prior period item. So therefore here see this. Prior period item which is debited to P&L account 12 lakhs. Current year depreciation 2 lakhs is amortization. Of course this is also go to P&L account. But see, you need to write like this as per AS5. This is AS5 which says any prior period item must be recorded, because these 12 lakhs not belongs to this year. They belong to last 6 years, but you are recording in the current year. That's why in order to separate from the other items, you need to give a separate disclosure as per accounting standard 5. And this amortization will also go where? P&L account only, but presentation. Know-how 12, 14. Next question you see. Suppose there is a company spend 45 lakhs for publicity and research expenses on one of its new consumer product, which was marketed in the accounting year 11-12, but proved to be failure. State how will you deal with the matters. Sir, tell me, in AS10 we discussed one point. Any expenditure, advertisement expenditure, promotion expenditure, will you capitalize? No. Similarly here also, companies spend how much? 45 lakhs for publicity and research expenses, one of its new consumer product. It cannot be capitalized. It cannot be capitalized. So company spend 45 lakhs but proved to be failure. It is clear that in future there will be no future revenue or benefit. Therefore AS26 says don't recognize. Then this 45 lakhs, what we need to do? Charge to P&L account. Next, illustration 3. Company has a turnover of 250 crores, sir. Their annual advertising budget is how much? 2 crores for marketing a new product. It was estimated that company could have a turnover of 25 crores from the new product. The company has debited to its P&L account the total expenditure of 2 crores and incurred an extensive special initial advertisement campaign for the new product. Sir, is this procedure adopted by the company is correct? First of all, you need to understand, sir, their annual budget for advertisement how much? 2 crores for meeting a new product advertisement, marketing of the new product. It was estimated that the company would have been a turnover of 25 crores from the new product. They are expecting 25 crores. Company has debited to its P&L account the amount of total expenditure of 2 crores incurred on extensive special initial advertisement campaign. Whether, see, entire 2 crores they debited to P&L account, advertisement cost. Is this correct? Yes. Advertisement cost should be charged to P&L account only. They should not be treated as asset. Intangible asset we cannot recognize. That's what AS10 also says. When you launching a new product, any advertisement cost you incurred, you cannot capitalize. Similarly here also same thing. You should not capitalize. Because there is no guarantee that this advertisement is going to future economic benefits. Sir, intangible asset will be recognized only when there is a probable future economic benefits. Because of advertisement there will be sales. There is a guarantee. Huh? No. Even there is an advertisement, there is no guarantee that you are going to generate the sales. So therefore in the given case, advertisement expenditure of 2 crores had been taken up for the marketing of a new product which may provide future economic benefits to an enterprise by having a turnover of 25 crores. Hence no intangible asset or other asset is acquired or created but can be recognized. Therefore the accounting treatment by the company by debiting entire advertisement expenditure of 2 crores to the P&L account is what? Correct. So the treatment done by the company is correct only. Okay. Yeah, these are all theory questions. Theory questions you can manage. This question is good, important question. See this. This question is important. Suppose there is a company Swift Limited. This question is relating to amortization. Important question, sir. They acquired a patent. Patent means intangible asset. Now what is the cost, sir? 80 lakhs. Life 5 years. And the product life cycle is also 5. The company capitalized the cost and started amortizing the asset at 10 lakhs per annum. The company has amortized the patent at 10 lakhs per annum in the first 2 years on the basis of economic benefits derived from the product manufactured under the patent. That means first 2 years, what is the amortization, sir? 10 lakhs, which will go to P&L account, correct? After 2 years, it was found that the product life cycle may continue for another 5 years. Initially, we estimated for 5 years. Once 2 years is completed, we are estimating another 5 years. So whenever, sir, any life of the asset changed, sir, you need to provide depreciation based on the revised life. Hello. So that means this 80 lakhs minus 20 lakhs, 60 lakhs is the carrying amount, right? This 60 lakhs will be depreciated over the remaining life. Correct? We'll see. After the 2 years it was okay. The patent was renewable and Swift Limited got it renewed after the expiry of 5 years. Okay. The net cash flows from the product during these 5 years are expected to be 36, 46, 44, 40 and 34. Sir, next 5 years the net cash flows is given, sir. So find out the amortization cost of the patent for the each of the years. First 2 years amortization cost is 10. From 3rd year onwards, how to provide amortization? I told you amortization should reflect the pattern in which the economic benefits are generated. Economic benefits generated, the cash flows given us, sir, 36, 46, 44, 40, 34. So in proportion to these cash flows, you amortize, sir. In proportion to the cash flows, you amortize. See this, these are the net cash flows for the next 5 years, total 2 crores. So total asset cost 80 lakhs na. In this 80 lakhs, first 2 years amortization is 20 na. Now third year onwards, what is the balance left? 60 lakhs into third year cash flow, how much? 36 lakhs divided by total 200. So in proportion to this, please share it. 10 lakh 80,000. See this, 10 lakh 80. This is the third year depreciation. Fourth year also same. Fourth year how much? 60 lakhs into cash flow 46 divided by 200. 13 lakh 80,000. Like this every year based on cash flows, you provide depreciation. Hello? So this is how you need to do, sir. First 2 years, this is the ratio, amortization ratio. Next, this is the amortization ratio we have done. So this is a good question, sir, important question. First 2 years 10 lakhs, sir. Third year onwards, based on the cash flows, you need to provide the amortization. Next, this question you see, AB Limited launched a project for producing a product. The company incurred 20 lakhs towards what? Research. Due to prevailing market conditions, the management came to conclusion that product cannot be manufactured and sold in the market for next 10 years. So the management hence want to defer the expenditure right off to future years. Advise the company. No, sir, no. When they said when there is no future economic benefits, entire expenditure will be transferred to P&L account only. I told you research development. All expenditure in research phase will be transferred to P&L. Development says 6 conditions should be satisfied. One of the 6 conditions is what? You must able to generate future economic benefits. But here clearly says in the next 10 years, it is not possible for the company to manufacture and sold. So therefore, there is no future economic benefits. Therefore, this entire expenditure should be charged to P&L. So management contention is absolutely wrong. See this. Next. See this question number 12, sir. During 11-12, there is an enterprise who is developing and producing a routine low risk software computer. That means they are developing one intangible asset, sir. Phase 1, phase 2, 3, 4, phase 3, 4, like that, phase wise details given. They are developing one intangible asset through research and development. Now you see, after completion of phase 2, it was established that product is technically feasible for the market. You know that means first two stages research. Correct? After completion of phase 2, that product is technically feasible. You know, one of the 6 conditions, first condition is what? Technical feasibility. In the development stage, when you recognize intangible asset, only when there is a technical feasibility. Therefore, first 2 stages research. Correct? In research stage, you incurred 1 lakh rupee, 50 plus 40, 90. This will be transferred to P&L account. From there onwards, this one 3 and 4, 63 plus 3 testing phase, add 18,000. Product master for training material, add. Sir, you said any training cost, employees training, say their employee training, A10 says any training given to the employee, staff, that will not be capitalized. But here training is not for employees. We are developing a new software na, for that trial run. This testing we are doing for the product, not for asset, not for the employees. So it will be included. And also product masters for training materials, add. So these 3. What about packing the products? Packing should not be included now, because only the cost which is necessary to bring the asset to its present location and condition, capable of operating in the manner intended by management, will be added. So 63 plus 18 plus 19,500, 1,05,500. Packing cost should be recognized as an expense and charged to P&L account. Don't capitalize it. Hello. Next, same question, Swift Limited question. This is same. This question same we completed. See this examination RTP question, same question just now we completed. See question number 5, you see, May 2020 question. There is a company PQR, sir, which has acquired a brand from another company for 100 lakhs. PQR Limited contends that since the said brand is very popular and famous brand, no amortization needs to be provided. Comment on this. Sir, brand. So intangible asset. They don't want to provide amortization. Is it correct? Because they are saying this brand is very popular. What AS10 says, AS26 says, there is a repeatable presumption that the life cannot exceed 10 years. Therefore, you have to provide amortization unless otherwise provided. Therefore, here, based on the information given, sir, there is no other information available. Therefore, this brand has to be amortized. But the company contention that it is very popular is not correct. So, therefore, the contention of PQR that brand is very popular, famous, hence no amortization need to be provided is not correct, as there is no evidence that the useful life of the intangible asset will exceed 10 years. Next. Same question of Swift Limited question. This is again repeated. One more question I will solve, sir. This question important question, sir. Question number 6. See this. PASA Limited is developing a new production process, intangible asset. During the financial year ending 31st March 2019, the total expenditure incurred on the process is 80 lakhs. For the year ending 31st March 2019, the production process met the criteria for recognition of intangible asset when 1st November 2018. That means recognition criteria is met on 1st November 2018. That means till that point of time it is research. 1st November 2018 recognition criteria satisfied, sir. That means till that time whatever the expenditure you incurred is research. All the expenditure incurred on research will be transferred to P&L account. How much actually you incurred? 80 during the year. See this, expenditure incurred till that date is how much? 42. That means from 80 minus 42, how much? 38. This 38 is what? Intangible asset. Because this 38 is incurred after recognition criteria is met. Hello. In the question itself they clearly said recognition criteria met. Next. Further expenditure incurred in the process for the financial year ending 31st March 2020, 90 lakhs. Next year 90 lakhs was incurred. On 31st March 2020, the recoverable amount of know-how embedded in the process is estimated to be 82 lakhs. This includes estimates of the future outflows and inflows. Okay. You are required to work out what is the expenditure to be charged to P&L account for the year ending 31st March 2019. How much, sir? Expenditure 42 lakhs. This will be charged to P&L account. The first bit answer 42 lakhs. Sir, by 31st March 2019, what is the total expenditure you incurred? 80. Recognition criteria met on 1st November 2018. Till that time, how much you spent? 42. 42. That means that is research stage. Entire expenditure is charged to P&L. That is what they are asking. So 42 will be charged to P&L. Next. What is the carrying amount of the intangible asset on 31st March 2019? 38. 38 is the carrying amount. Come on. 80 minus 42. 38 is the carrying amount by 31st March 2019. Next. What amount of expenditure to be charged to P&L account for the year ending 31st March 2020? Sir, next year 31st March 2020, how much amount you will charge to P&L account? Suppose, sir, next year how much we spend? 90 lakhs we spend. Correct? So, already in my books, what is the asset value we recognize? 38. Suppose this subsequent expenditure also satisfies the criteria. I told you, subsequent expenditure will be capitalized when it is, previously assessed performance of the intangible asset is improved. Assume. So 90. So my intangible asset now become 128. This is the carrying amount of the intangible asset. But what is the recoverable amount given? 82 only. Recoverable amount 82. Here AS22 come into the picture. AS28, which says, AS28 says, at the end of the year you need to compare two figures, carrying amount to recoverable amount. If carrying amount is more than recoverable amount, then there is a impairment loss. In the books, you are showing 128, but the recoverable amount is only 82. Therefore, what is the difference? 46. That is impairment loss that will be transferred to P&L account. So 46 lakhs will be charged to P&L account. See this, 46 lakhs will be charged to P&L account as which loss? Impairment loss. Next, actually AS28 you will see, you will understand impairment loss. Okay. That's why I said 10, 26, 28 connected. Next, what is the carrying amount of the intangible asset on 31st March 2020? Simple. The carrying amount is recoverable value 82. Because see, first 38, next 90 added, 128. From that 128, impairment loss. How much impairment loss? 46. So 128 minus 46, 82. That is the carrying amount of the asset. So from now onwards, amortization will be provided on this 82. That's it, sir. This is one question, sir. So I think we have completed AS 26, sir. All questions I solved, sir. See this. Very simple chapter, simple standard, sir. Focus on only on the areas which I have taught you. So questions will be done. Okay, sir. Next standard we are going to cover is AS 28, sir. Impairment of assets. So please, impairment of assets, please do after AS 10 and 26. Once you complete 10 and 26, then only come to 28. That is actually link. So if you directly come to AS 28 now, that will not be that much good. First you need to complete 10 and 26. 10, 26. Then come to 28. You will understand, I mean, little bit comfort you will get. Okay. Sir, what we are going to learn or cover in this standard? Impairment of asset. What is this impairment of assets is all about? See, if you are for AS PP, for property plant equipment, what is the standard applicable? 10. For intangible asset, 26. Now what is the loss for PP? PP subject to depreciation. Intangible asset subject to amortization. Correct? Both are losses only. Both are losses only. Now this tangible asset, intangible asset subject to losses. The most common losses is depreciation or amortization. Now suppose if there is any other reason, if there is a fall down in the value of asset, that is called impairment loss. What is basically impairment loss? Loss in value of asset due to reasons other than depreciation or amortization. An asset may loses its value because of other reasons also, because depreciation and amortization is the natural common loss. But apart from depreciation and amortization, there could be so many reasons why an asset may lose its value. So this standard will guide you that. This standard says we will give you some indicators. If any one of those indicators are presented in our organization, kindly check the assets are subject to impairment. Generally we say he is physically impaired. Impaired means loss in value. Similarly, an asset loses its value because of other reasons, then it is covered in AS 28. That we are technically call it as impairment. Okay, listen. Sir, what we are going to do in AS 28? Sir, AS 28, there are some assets not covered here, like inventories. Inventories are not covered in AS 28 because there is a separate standard. Assets under construction contracts, AS 7. Financial assets, investments, AS 13. Deferred tax assets, AS 22. So when there is a separate standard, this is not applicable. Okay? Okay. Now come to the main concept of AS 28. Main concept of AS 28. This standard says at the end of every financial year, for each asset, check is there any indicators for impairment of that asset. So in our organization, what are all the assets are there? Tangible or intangible? Check for each asset. Is there any indicators of impairment? Indicators of impairment. See, this standard says there are two types of indicators. External indicators, internal indicators. See this. Indicators of impairment, external, internal. External indicators, internal indicators. For example, you see, first internal indicators. Physical damage of the asset. Asset physically damaged. Definitely there is an indication. Impairment indication. Check whether there is impairment loss or not. Suppose change in asset usage, such as plan to discontinue, restructure or dispose. For example, you have one asset. Right now you are using as office building. Now you want to use it as a warehouse. You are changing the asset usage. That is also one of the indicator. Poor economic performance. Your performance is not at all good. That's an indicator. Suppose cash flows for asset acquisition or maintenance significantly exceed the budget. Maintenance cost of the asset exceeded the budget. Actual cash flows or operating profit significantly worse than budget. Significant decline in the budgeted cash flows for profits, increasing budgeted loss. Operating losses or cash outflows exceeding the projections. So these are all internal indicators. You see, within the organization, these indicators are available. There are some external indicators also outside. For example, significant decline in the company's market value beyond normal depreciation. Suppose company's asset market value has been decreased. Or adverse changes in technology. New technology came in the market. Adverse, external indicator. Legal environment. Maybe increase in market interest rate. Sir, even increase in market interest rate is also one of the indicator. If the interest rate increases, how it is an indicator? Tell me. If the interest rate increases, how it is an indicator? Today, AS 19, we have seen interest implicit in the lease. First, we started with what? 10% discount rate. That question, sir. 10% we started. Next, we taken 14%. Why you taken 14%? Because when I take 10%, I got 2,14,000 something, right? Present value 2,14,000 came. But I need to reach 2 lakhs. So when I reduce the present value, I need to increase the discount factor. So when the discount rate increases, present value will decrease. Similarly, when the interest rate, discount rate means market rate, interest rate. When the interest rate increases in the market, the present value will come down. Hello? Present value will come down. The asset value will come down. That's why that is also one of the indicator. Hello? And also, enterprise net assets carrying amount exceeds its market capitalization. So these are the indicators, sir. I am not discussing much these indicators, sir, because in classroom I am going to discuss everything. But here, revision purpose, these are all not required. Just you read these indicators once, that's it. My intention is, as per AS 28, the intention of AS 28 is, at the end of every financial year, in respect of each asset, you need to see whether there are indicators. Indicators can be external, internal. Now, if there are indicators, yes, answer is yes. Then standard says you calculate recoverable amount. What is that? Recoverable amount. Calculate recoverable amount. And compare this carrying amount. Compare the carrying amount with recoverable amount. If carrying amount is greater than recoverable amount, then there is an impairment loss. Compare carrying amount with recoverable value. If the carrying amount is more than recoverable value, there is an impairment loss. Suppose, sir, there are no indicators, ignore. There are no indicators, ignore. Sir, so tell me, in order to compute impairment loss, what are the things we required? Carrying amount, recoverable amount. Two things required. Carrying amount or recoverable amount. If carrying amount is more than recoverable amount, impairment loss is there. Impairment loss is there. Your book value carrying amount of the asset cannot exceed recoverable value. Now see. Sir, these are the formulas you need to remember. Very, very important. See this. Impairment loss is equal to carrying amount minus recoverable amount. What is recoverable amount? Recoverable amount is either you use the asset or you sell the asset. If you use the asset, you are going to get cash flows. So the present, you see, recoverable amount is net selling price or value in use. Net selling price or value in use, whichever is higher, not lower par, whichever is higher you need to take. Recoverable amount means if you sell, what is the net selling price? What is the value in use? How to get net selling price? Sale price minus cost of disposal. If I sell this asset, what is the sale price? Minus cost of disposal. You will get net selling price. What is value in use? Value in use is present value of the future cash flows from the continued use of the asset plus disposal proceeds from the sale of assets at the end of the life. Disposal proceeds from sale of assets at the end of the life. So present value of the future cash flows generated from this asset plus disposal proceeds. Once the asset life is over, if I sell, I will get disposal proceeds. That you convert both of them to their present value. You will get value in use. Compare value in use, net selling price. Whichever is higher, that is recoverable amount. That is recoverable amount. Now, I want carrying amount. Recoverable amount done na? carrying amount. How to find out carrying amount? Simple. Cost minus accumulated depreciation, accumulated impairment loss. That's why I said A is 10. A is 10, sir. Subsequent measurement. A is 10 says cost model. In cost model, how the asset will be recognized? Cost minus accumulated depreciation minus accumulated impairment loss. You will get carrying amount. Hello? That's it. Generally, you will get the impairment loss. Now, relating to this concept I discussed, sir, we'll discuss some questions. See this illustration number 1. See, this is the right way to understand AS28. First, learn the concept, do the related sums. Because here, main thing is 2 or 3 formulas. That's it. Basic concept. Basic concept is only 2 or 3 formulas. Right? So, in order to calculate impairment loss, first of all, what are the 2 things required? Tell me. Carrying amount, recoverable amount. How to get carrying amount? Cost minus accumulated depreciation minus accumulated impairment loss. How to get recoverable amount? Net selling price or value in use, whichever is higher. Simple logic. Either you use the asset or sell the asset. When you sell, you will get net selling price. If you use, you are going to get cash flows. How to get value in use? Present value of the future cash flows from the asset plus any disposal amount you are going to get on sale of this asset. Convert both of them into present value. That is value in use. So value in use, net selling price, whichever is higher. Compare with recoverable value. If recoverable value is greater than this, impairment loss. If the carrying amount is greater than recoverable, impairment loss. Suppose if the carrying amount is less than recoverable value, no impairment loss. Ignore. Hello. So the accounting treatment is simple. See this. When you compare recoverable amount and carrying amount, sir, if recoverable amount is greater than carrying amount, no impairment loss, sir. No impairment loss. If recoverable amount is greater than carrying amount, less than carrying amount, that means carrying amount is greater than recoverable. Then we will get what? Impairment loss. Now this impairment loss, what we need to do? Listen, if there is an impairment loss, sir, the entry is impairment loss account debit to PPE account, I mean asset account. Hello? This impairment loss will be transferred to P&L account. When this entry will be written when you are following cost model. When you follow cost model. Suppose if the asset whose asset subjected to impairment is revalued already, it is following revaluation model, there is a revaluation surplus na? There is a revaluation surplus. Then impairment loss will be adjusted to revaluation surplus. Don't transfer to P&L account. For example, there is a revaluation surplus of 10 lakhs. Impairment loss 15 lakhs came. So first we need to adjust reserves and surplus 10 lakhs. Remaining impairment loss, which will be transferred to P&L account. Hello? So tell me, you checked recoverable value, carrying amount. Carrying amount is greater than recoverable value. Impairment loss is there. What we do? Transfer to P&L account. Generally. Suppose if there is a revaluation surplus is there, adjust to revaluation surplus. Remaining balance, transfer to P&L account as a normal loss. Hello? Yeah. See question number, illustration number 1. This is a basic question. I will do this question. See this, everybody. Ergo Industries Limited gives the following estimates of cash flows relating to PPE. They have given cash flows, sir. Equipment on 31st December 2011, discount rate is 15%. Cash flows of the asset given as, sir. Hello? These cash flows will help you to find out what? Value in use, present value of future cash flows. Residual value at the end of 2016 is how much? 1000. Okay. Property, plant, equipment purchased on 1/1/2015. 40,000 lakhs. See here note, you see the year, this immediately preceding the year before 2010. That means this is 2009. Okay. This is before 2010, sir. This 2009. Okay. We purchased useful life 8 years. Net selling price 20,000. Calculate on 31st December 2011. That means they are following calendar year at the end of the first year. What they are asking first, carrying amount on at the end of 2011. How to find out carrying amount? Cost minus accumulated depreciation. Now what is the cost? 40,000. Correct? 40,000 cost pa. From that you need to reduce depreciation. Depreciation for only 1 year, because they are asking at the end of 31st December 2011. No. You purchase the asset on 1/1/2009. That means 2009, 10, 11, 3 years. So therefore 40,000 minus residual value is there 1,000. So depreciable amount is 39,000 divided by 8 years into 3. 14,625. That is the total depreciation. Minus it from 40,000. 40,000 minus, you will get the carrying amount. How much? 25,375. See this. I think this one. This is the carrying amount. Depreciation you need to reduce, because I want carrying amount on 31st December 2011. So 40,000 is the cost of the asset minus residual value, depreciable amount divided by 8 into 3 years. So 14,625. So 25,375 is what? Carrying amount of the asset. Next, what is the second question they asked? Value in use on 31st December 2011. How to find out value in use? Present value of the future cash flows and also disposal proceeds. Correct? So this 4,000, 6,000, 6,000, and at the end there is a residual value, right? This is also included at the end. Convert them into present value by using discount factor of 15%. Everybody? So see this, value in use 19,025 we got. Convert them. You see here how they have done it. Cash flows. Last year residual value will also be included, because the definition of value in use is present value of the future cash flows plus disposal proceeds also. Discount factor they have given. Convert them. You will get 19,025. Correct? So value in use 19,025. Next, third bit. Recoverable amount on 31st December 2011. How to find out recoverable amount? Recoverable amount is net selling price or value in use, whichever is higher. Value in use already we just now find out. How much? Value in use 19,025. Hello. Value in use 19,025, sir. I want net selling price. Net selling price they given. See this. How much? 20,000. Whichever is higher. How much? 20,000. That's it. So 20,000 is the recoverable amount. Got it? Next, fourth bit. Impairment loss to be recognized. How to calculate impairment loss? Carrying amount minus recoverable amount. What is the carrying amount? First bit 25,375. What is the recoverable amount? Just now we got 20,000. So carrying amount is greater than recoverable amount. So impairment loss is there. How much? 5,375. 5,375. See this. Carrying amount minus recoverable amount. Next, revised carrying amount. Sir, after reducing this 5,375, what will be the revised carrying amount? 20,000. Correct? 25,375 minus impairment loss. So it will be 20,000. Common sense. Next, depreciation charge for 2012. How much depreciation you will charge? What is the revised carrying amount? 20. Divided by what is the remaining life? Actually, total life of the asset is how many years? 8 years. In that, how many years already done? 3. Correct? 9, 10, 11. So how many years still pending? 5. 20 divided by 5. 4. This is the depreciation for. Sorry. We need to reduce this residual value. That I forgot it. Sorry. Here 20 minus 4,000 divided by 5. How much? 3,200. 200, 800. 20 minus 1000 divided by 5. Oh, this is 1000 residual value. 4000. 1000. Okay. Wrongly considered. So it is 1000 only. Divided by 5. How much? 800. That's it, appa. See how easy it is. Just remembering 3 formulas. How to calculate carrying amount, how to calculate recoverable amount. Recoverable amount means net selling price or value in use. Value in use is present value of the future cash flows plus disposal proceeds. Convert them. Sorry. Next, come to illustration number 2. See, in this illustration, they have given the carrying amount. How much? 100 lakhs. Life 5 years. Residual value 5 lakhs at the end of the 5th year. Estimated future cash flows given. You need to calculate value in use. Very simple now. How to find out value in use? Value in use here. Value in use. Present value of the future cash flows. Convert them into present value. What is the discount factor they given? 10%. Everybody. And when you are calculating, you need to take residual value also. At the end, we need to add 5 lakhs residual value. So say this. So cash flows. Last year residual value also considered. Discount factors will get 121.92 is the residual value. See this 121.92. They are also asking recoverable amount. If the net selling price is 60, how to get recoverable amount? Value in use, net selling price, whichever is higher. Value in use 121.92. Net selling price 60, whichever is higher means 121.92. That's recoverable amount. That's it. Hello. Next. This question, important question, sir. Illustration number 3. See this illustration, sir. There is a company G Limited, sir, which acquired a machinery on 1st April 2010 for 7 crores that had an estimated useful life of 7 years. Estimated useful life is 7 years. The machine is depreciated on which basis? Straight line basis, and does not carry any residual value. Okay. On 1st April 2014, that means 10, 11, 11, 12, 12, 13. 13, 14, 4 years over. Correct? Sir, we purchased the machine on 1st April 2010. So 10, 11, 11, 12, 12, 13, 13, 14. Now on 1st April 2014, the carrying value of the machinery was reassessed at 5.10. That means revaluation happened. And the surplus arising out of the revaluation being created to revaluation surplus. For the year ending March 2016, the conditions indicating the impairment of the machine existed and the amount of recoverable estimated ascertained at 79 lakhs. You are required to calculate the loss on impairment of the machine and show how this loss be treated in the books of G Limited. So they are asking how to calculate impairment loss and how this loss will be treated. Had the followed the policy of writing down the revaluation surplus by increased charge of depreciation resulting from the revaluation. Now this is a very good question actually. You see how we are going to calculate this. First start from the 1st April 2010. 1st April 2010, tell me what's the asset value? 7. Correct? 7 crores. Now next, when revaluation happened? 1st April 2014. That means after 4 years. First reduce 4 years depreciation. 7 crores divided by 7 years life into 4. 4 crores. So what is the carrying amount? 3 crores. Now you are doing revaluation. Revalue to 5.1. That means how much is the revaluation surplus? 2.10. Correct? Now the revised value of the asset is how much? 5.10 on 1st April 2014. Now next what happened? For the year ending March 2016. That means after 2 years. 14, 15, 15, 16. 2 years depreciation you provide on this. 5.10 divided by, what is the total life, sir? 7. Already 4 years done. That means remaining life 3. So this will be depreciated over remaining life and 2 years now expired. So 5.10 divided by 3 into 2. How much? 3.4. So what is the carrying amount at the end of 31st March 2016? 1.7. Are you understanding? Now what happened? They have given the recoverable amount. What is the recoverable amount they have given? 79 lakhs. Net selling price not given. When net selling price not given, whichever is higher, take recoverable amount as directly recoverable amount given 79. Correct? What is the book value carrying amount? 1.7. What is the recoverable amount? 7. So there is an impairment loss there or not there? There. Carrying amount 1.7. Recoverable amount 0.79. What is the impairment loss? 0.91. This is the impairment loss. First you need to find out like this. Because on which date you are ascertaining the impairment loss? 1st April, 31st March 2016. So therefore 0.91. Now here comes the most important treatment, sir. Tell me, sir, this 0.91, what will you do? I told impairment loss. If the asset is subject to cost model, we will transfer to P&L. But this asset is already revalued. So revalued already. There is a revaluation surplus. There is a revaluation surplus. How much surplus is there? 2.10. Therefore, entire 0.1 will be adjusted to 2.10, which is wrong. We need to understand here. I told when there is a revaluation surplus, this impairment loss will be adjusted to revaluation surplus. But here you read the question, they said impairment and how this loss will be treated had followed the policy of what? Writing down the revaluation surplus by increased charge of depreciation resulting from the revaluation. Sir, because of revaluation, what is the increased charge on depreciation? They are adjusted to revaluation surplus. Now you see, normally what is the depreciation? Normally depreciation is 1 crore per annum. Now because of revaluation, the depreciation is for 5.1 divided by 3, 1.7. That means how much increase? 0.7, 0.7 increase because of revaluation. Into how many years it is that? 2 years. 2. How much? 1.4. That means in the revaluation surplus, how much is there? 2.10. First, in this 2.10, because of revaluation, what is the increase in depreciation? 0.14. Adjust. From the revaluation surplus, 1.4 you adjust. So 2.10 minus 1.4. How much balance is there? 0.7. Only 0.7 we will adjust with impairment loss. Up to 0.7 we will adjust. Remaining will be transferred to P&L account. So therefore 0.71 is my total impairment loss. In that 0.70 I will adjust with revaluation surplus. Remaining only I will transfer to P&L account. You understand why I have done this? Because the company policy is whatever the enhanced depreciation is there, they met from the revaluation surplus. They have not transferred enhanced depreciation to P&L account. They adjusted in the revaluation surplus. What is the enhanced depreciation here? 2 years. Normally depreciation per annum is 1 crore. But because of the revaluation, the depreciation is 1.7. Correct? So 1.4 I will adjust it. Very good sums are these actually. You understand this question? So 0.91. In that 0.7 adjust against revaluation surplus. 0.21 charge to P&L account. This is one question. Similarly, you see this illustration 4, sir. There is a company X Limited, sir, which purchased PP for 4 years ago at 150 lakhs and depreciated it at 10% on which basis? Straight line method. At the end of the 4th year, it has been revalued the asset at 75 lakhs and has written off the loss on revaluation to P&L account. Okay. However, on the date of revaluation, the market price is 67.5 and expected disposal cost is how much? 3. What will be the treatment in respect of impairment loss on the basis that fair value for revaluation purpose is determined by market value and the value in use estimated at 60. Now you see the question. In this question, when we purchased the asset 4 years ago, what is the cost? 150. Okay. Now at the end of the 4th year we are. So find out the first carrying amount of the asset. 150 lakhs, 10% depreciation. Correct? So 150 divided by the life of the asset is given a life. Straight line method or 10%. That means 10 years. Correct? 4 years depreciation is how much? Tell me. 150 into 10% means 15. 15 into 4, 60. So carrying amount 90. What happened at the end of the 4th year? we have revalued, correct? Revaluation happened at 75. My book value 90, but I revalued to 75. So there is a revaluation loss, not revaluation surplus. How much? 50. Now next, what happened? My asset value is now at 75 carrying amount. On that date, the market price is how much? 67.5, and expected disposal cost 3. Minus it. 67.5 minus 3. 64.5. What is this? Net selling price. Correct? Value in use 60. So whichever is higher means 64.5. So carrying amount is 75. Recoverable amount 64.5. What is the impairment loss? 9.5. 9.5 or 10.5? 10.5. See this, 10.5. Will be recognized as expense in the statement. Since there is a downward revaluation of asset which was already charged to P&L account. In the question clearly said there is a downward revaluation, and the downward revaluation is charged to P&L account. Just we have seen in AS 10 also, whenever there is a downward revaluation, that loss is transferred to P&L. Whenever there is an upward revaluation, we transfer it to revaluation surplus. Same thing. See, these are the basic questions. See this. So these are all we completed in AS. Okay. Now comes the next part of AS 28, sir. This is one part of AS 28, sir. This is the basic part. Suppose if you don't want to complete entire AS 28, even if you complete till here, it is okay, not a problem. But I am going to explain one more concept, sir. The concept of CGU. What is that? CGU concept I will explain. What is this CGU? So listen, sir, tell me, in what we are doing in impairment loss AS 28, sir, in respect of each asset, we are seeing there are indicators. If there is an indicator of impairment, what we are doing? We are calculating recoverable amount. Recoverable amount consisting of net selling price, value in use. Here comes the value in use. This is the main culprit. Main culprit is value in use. This value in use is nothing but what? Present value of the future cash flows. Is it possible for every asset to find out value in use? For example, right now we are in the classroom. I am using this laptop. 2 laptops I am using. This touchpad I am using. And this is using. Can I able to generate cash flows, or can I able to calculate cash flows for each of this calculator or touchpad, all these things? All of them together I am using to teach you. I am generating revenue. I am teaching you, I am providing services, I am generating revenue. To generate this revenue, each asset individually I am using, or is each asset is capable of generating individual cash flows? No. Here everything, the chairs, the fans, the ACs, the TV, everything, AC, all these assets together providing services to you. So therefore sometimes it is not possible to find out value in use of each individual asset. Then because they are not made for generating cash flows independently. In this classroom is the best example you see. All these assets which is available, they are not individually have the capacity to generate cash flows. All of them I am using to generate cash flows. So therefore, it is not possible to individually identify impairment loss for each asset. Because how can I ascertain impairment loss? Only I can compare 2 things. What are those? Carrying amount to recoverable amount. If I want recoverable amount, I want value in use. Value in use I want. Whichever is higher, I need to take net selling price, value in use, whichever is higher. Sir, you cannot say, sir, value in use not available, net selling price available, we'll take it. No. Net selling price or value in use, whichever is higher. Value in use should be available. Even net selling price not available, it doesn't matter. You take value in use. Value in use is such an important component for the organization. Now that's why they brought one concept called CGU, cash generating unit. When you are unable to calculate the impairment loss for an individual asset, calculate as a group of asset. What is CGU? CGU is nothing but smallest group of assets together generating cash flows. It's called CGU. Smallest group of assets together capable of generating cash flows. See here, I have taken one best example. Suppose Guntur, we have one Reliance Mart. Reliance Mart. You go. In Reliance Mart, AC unit is there na? AC, centralized AC. Generator is there na? Furniture trolley is there na? Computers is there na? Refrigerator, freezers is there na? Shelves, racks is there na? Building counters is there na? Building is there na? Now tell me, in this Reliance Mart showroom, whether each asset is capable of generating cash flows independently? No. All of them are working as one individual unit to generate cash flows. Each asset, is it possible to find out value in use? No. AC, what will be my cash flows from AC? No, I can't. Therefore, they said, in case of this, you cannot find out impairment loss for an asset individually. When you don't find out the impairment loss individually, identify the group which together working to generate cash flows, and accordingly you calculate impairment loss. That is called CGU. Now in this case, this is CGU, cash generating unit. In case of this, what you need to do? You find out the carrying amount of this CGU. You find out the recoverable amount of the CGU. Compare. If the carrying amount is more than recoverable amount, impairment loss is there. Otherwise, ignore. That is called cash generating unit concept. You understand CGU concept, sir? Hello? So CGU is what? Nothing but smallest group of assets that generate independent cash inflows from continuing use, separate from other assets or group of assets. Okay. For example, there is a company, sir. There is a mining company which owns a private railway to support mining activities. This private railway could be sold only for scrap value, and the private railway does not generate cash inflows from continuing use that are largely independent of the cash inflows from the other assets. See, we have one mining site, sir. In that mining site, whatever the material we collected, extracted, that will be carried. So they lay down one private railway track. This private railway, tell me, is it capability is there to generate individual cash flows? No. So therefore, entire mining will be treated as what? One CGU, one cash generating unit. It is not possible to estimate the recoverable amount of the private railways because the value in use of the private railway cannot be determined. It is probably different from scrap value. Therefore, the enterprise estimate the recoverable amount of the CGU to which the private railway also belong. That is, whole mine is treated as what? One CGU. Everybody? Okay. So therefore, when individually it is not possible to generate the cash flows, then you need to see the CGU to which this asset belongs. Then accordingly, you calculate and provide. Everybody? Suppose, sir, one question, sir. See this question. There is a publisher, sir. There is a publishing company. They have 150 magazine titles. Publishing company has 150 magazine titles, of which 70 were purchased, 80 were self-created. We purchased, sir, magazine titles, sir. India Today, Deccan Chronicle. Magazine titles is a Swati. Different types. Magazine title. Magazine title is intangible asset. Masthead, they call it as. Masthead means title. Title of the book. Title of the publication. In this self-created, how many? 80. Purchased, how many? 70. The price paid for the purchased magazine title is recognized as what? Intangible asset. The cost of creating magazine titles and maintaining existing titles are recognized as expense when incurred. Okay. Cash inflows from direct sales and advertising are identifiable for each magazine title. Sir, magazines will be sold, na? Revenue will be generated. And what is the main revenue for publishing company? Advertisement. In that magazine, advertisement will be published, na? Advertising. So, if a publishing company releases a magazine, direct sales will come. At the same time, advertisement income will also come. Now here what they are saying, cash inflows from direct sales as well advertisement are identifiable for Each magazine title they can identify. Titles are managed by customer agents. The level of advertising income for magazine title depends upon this range of titles in the customer segment to which the magazine title rules. Okay. Management has a policy to abandon old titles before the end of their economic life and replace them immediately with the new titles. What is the CGU unit? Is it individual magazine for an individual magazine title? Tell me. Now what they're asking is whether each individual magazine title is treated as CGU or all of them together treated as one CGU. All of them one CGU or each individual magazine title is one CGU. Simple, sir. What is CGU? What is smallest group of assets that generate cash flows which is different from other assets. They can able to generate cash flows together. Now here in this question, each magazine title generating direct sales and also advertising. So therefore each magazine title will be treated as what? One separate cash generating unit. See this. It is likely that individual magazine titles generate cash inflows that are largely independent of each other, and that each magazine title is a separate cash generating units. So each one will be treated as what, sir? Separate cash generating units. Hello. This is one question, sir. Remember, they may ask this in examinations. Sir, in case of cash generating units, sir, CGU, how impairment loss will be calculated? For example, first we will see the individual assets in the CGU. For example, see asset 1, asset 2, asset 3. There are 3 assets are there. This is a CGU, 3 assets. Each asset carrying amount you know. Carrying amount will know. Na? Carrying amount. For example, 50, 20, 30. So total, what is the total? 100. Total is 100. Now recoverable value. Individually recoverable value available or not available? Available or not available, because this is CGU. Why we are applying CGU concept? Value in use we don't know for each asset, because these 3 together generating cash flows. Hello. Sir, when you can able to identify recoverable value individually, don't apply the concept of CGU. When you are applying CGU, each individual asset impairment loss cannot be determined because value in use cannot be determined. So here, this is CGU, 3 assets are there. The recoverable amount is, for example, 40. Tell me, what is the impairment loss here? 60. This impairment loss, what you are going to do? You need to apportion to all the assets based on their carrying amount. That means, see this, 60 into 50 by 100. 30, next 60 into 20 by 100. How much? 12. Next 60 into 30 by 100. 18. That's it. So therefore, after deducting this impairment loss, what is the carrying amount of the assets? 50 minus 30, 20. 20 minus 12, 8. 30 minus 18, 12. This is the revised carrying amount of the assets after impairment. This is how you need to calculate impairment in case of CGU. So in case of CGU, take the recoverable amount, carrying amount. Impairment loss came. Apportion to all the assets in their carrying amount basis. Okay. But there is one more concept, sir, here, goodwill. Goodwill. Why goodwill came into picture? Because every organization will have some goodwill. Now, if there is a goodwill, and this goodwill, whether it can be allocable to CGU, not allocable to CGU, 2 cases will come in case of goodwill. Whether it is reasonably allocable, not allocable. If it is reasonably allocable to segments, then you need to perform bottom-up test. There is a test called bottom-up test. See here, I have given in my material. Yeah, goodwill, you see. Can be allocated on reasonable and consistent basis. Perform bottom-up test. Cannot be allocated on reasonable and consistent basis. Then perform bottom-up, top-down test both. What is this bottom-up and top-down test? All these things, sir. See, very simple. In case of goodwill, sir, you need to see whether goodwill can be allocated or not allocated or unallocable. You need to see, is it allocated or unallocable? Because see, goodwill is something which you cannot, it is there for the entire organization. It's a intangible factor which is there for the entire organization. Suppose this goodwill you can allocate to particular segment. For example, you have two CGUs, CGU 1, cash generating unit 1, cash generating unit 2, two CGUs are there. To these CGUs, for example, your goodwill is 100. Okay, suppose 30 70 70%, 30% 70% you can allocate. That means CGU 1, how much is the goodwill? 30. CGU 2, 70 you allocate. If it is reasonably allocable, you need to perform which test? Bottom up test. What is this bottom up test? Simple. Suppose there is a CGU, see this, not, see, listen to me, asset 1, asset 2, asset 3, there are 3 assets, and then goodwill, correct? Goodwill is reasonably allocable here. First to see the carrying amount. Suppose 50, 20, 30. Goodwill for CGU 1, I am doing CGU 1, how much? How much, sir? 30. Total carrying amount? 130. Now see the recoverable amount. Individually available? No. Suppose the recoverable amount is 80. Hello? Tell me, how much is the impairment loss? 50. Now they say, if there is an impairment loss, you are saying you have goodwill, na? Nothing doing. First to do one thing. Out of this 50, goodwill how much is there in the company, in the segment? 30. This will be first adjusted. That means 30 will be first adjusted to goodwill. Entire goodwill will be adjusted. What is the remaining impairment loss? 20. This will be allocated to other assets. This will be allocated to other assets on their carrying amount. That means this 20 I need to allocate. 20 into 50 divided by other assets only. Hello? How much? 10? 20 into 20 divided by 100. 4. 20 into 30 divided by 100. 6. Like this you need to allocate. So after this, what will be the carrying amount of the assets? 40. This is 20 minus 4, 16. This is 30 minus 6, 24. Goodwill, 0. This is called bottom up test. That means bottom goodwill is there. First adjust the entire impairment loss to goodwill. Then the balance impairment loss will be adjusted to other assets in proportion of their carrying amounts. Correct? Suppose this is when goodwill is allocated reasonably. Suppose if you don't allocate goodwill, unallocable goodwill, you cannot say, suppose there is a goodwill in your organization, but you cannot say goodwill is allocated to which segment, how much, which cash generating unit, how much, you don't know. Then they say you need to perform 2 tests. First bottom up, then top down. Bottom up test, what you need to do is, first except goodwill you take all the assets. Except goodwill you take the carrying amount, take the recoverable value, compute impairment loss. This impairment loss you proportionately allocate to all the assets. Next including goodwill, you take the carrying amount. But this time when you are taking the carrying amount, now revised carrying amounts you need to take. After performing of that bottom up test, whatever the revised carrying amount, take it. Including goodwill you take. Same, compare with recoverable value. You will get impairment loss. First that loss will be adjusted to goodwill. Remaining will be adjusted to this. Then you will get the amount. This is called top down, bottom up, top down. Bottom up. Bottom to up. Goodwill to other assets. Top down. So this is how they will be done, sir. Not necessary, sir. So there are no questions in the study material also. So I am not. Even the same concept is applicable for corporate assets. There is one concept called corporate asset. What is that corporate asset? Head office building. For example, head office building is there. That head office building is helping to every CGU. That is providing services which is common. So same like goodwill also, in case of corporate assets, you need to do the accounting treatment. See this. Even corporate assets also, if it can be allocated on reasonable and consistent basis, perform bottom up. If it cannot be allocated, bottom up and top down test, both will be done. Okay. Next is a reversal of impairment loss, sir. When you're doing reversal of impairment loss, suppose, sir, you provided impairment loss, but next suppose your recoverable amount may improve. For example, carrying amount is more than recoverable amount, you are saying impairment loss. Suppose in future your recoverable value may improve, na? Then impairment loss, whatever you recognize, must be reversed. See this. For example, there is a carrying amount of 1 lakh. Recoverable amount 70. What is the impairment loss? 30. In future, if the recoverable amount becomes 85. Hello? 70 has become 85. So how much? 15,000. So reversal allowed 15,000. So then what is the net carrying amount? New carrying amount. Recoverable, see, first 1 lakh asset, recoverable value 70. So there is an impairment loss of 30. That means asset is now at 70. Reversal allowed means another 15 will be added. So it will be 85,000. But here you need to remember, this new carrying amount should not be not more than what it would have been if no impairment. Suppose if there is no impairment at all, what will be the carrying amount? You see once. The new carrying amount because of reversal cannot exceed that value. For example, in this case, if there is no impairment loss, see this, if there is no impairment loss, what is the carrying amount? 1 lakh. So when you are reversing, the new carrying amount at any cost should not exceed 1 lakh. That's the concept. So when you are reversing the impairment loss, make sure that the reversal, the new carrying amount should not exceed the cost of the, the value of the asset, as if there is no impairment. If there is no impairment, what will be the carrying amount? That should not be exceeded. Hello? That's it, sir. So that's it for AS 28, sir. So my suggestion to AS 28 is, see the basics of AS 28 if you have not covered so far. Look at 7th question, very good question. This is scenario based question. This is very important question also. They may test this. In this question, you see, an asset does not meet the requirements of environmental laws which have been recently enacted. So recently there is some amendment came in the environmental laws. The asset has been destroyed as per the law. The asset is carried in the balance sheet at the year end at 6 lakhs. The estimated cost of destroying the asset is 70. See, because of the change in law, one of the asset, as per law, they have destroyed it. That asset may be outdated asset, generating a lot of pollution, so they destroyed. For destroying this asset, what is the cost we incurred? 70. What is the carrying amount? 60. How is the asset to be accounted? In this case, how the accounting will be done? In the books, what is the carrying amount of the asset? 6 lakhs. What is the cost we are incurring to destroy? 70,000. So how you are going to treat it? Tell me. Hello? See, the standard says carrying amount versus recoverable amount, correct? What is recoverable amount? Net selling price, value in use, whichever is higher. Suppose here net selling price, value in use, both are zeros. Both are zeros. But here one problem is there. This asset, in order to dispose, how much extra cost we incurred? 70,000 cost incurred minus 70,000. This is cost of disposal. So can I consider my recoverable value as minus 70? No. Any cost you need to see, you can restrict it to 0 only, value in use. Recoverable value should be restricted to 0. Suppose sometimes what happens, to dispose any asset, you may incur some additional cost. Like in this case, you incurred 70,000. The carrying amount becomes 0, this 70,000. For this 70,000, what is the accounting treatment? What is the accounting treatment? The standard says, for this 70,000, we need to create a provision as per AS 29. This 70,000 is a liability. See this. The amount estimated for impairment loss is greater than the carrying amount of the asset. to which it relates, enterprise should recognize a liability. So in this question, if you see, sir, in the given case, the recoverable amount will be nil, which is higher of value in use and net selling price. But the net selling price is negative here. Hello? Thus impairment loss will be calculated as 6 lakhs. Entire carrying amount is loss only. Carrying amount, but recoverable amount is 0. Therefore, the asset is fully impaired and the impairment loss of 6 lakhs is recognized as an expense immediately in the statement of P&L. What about that 70,000? They are saying that 70,000 will be recognized as a liability and required by another accounting standard. AS 28 does not addressing it. It is discussed in AS 29. So hence entity should recognize a liability for cost of disposal at 70,000 as per AS 10 and 29. Very good question actually. This one you see. That's it. Now let us see AS 20, sir. I am going to discuss the important aspects of AS 20. Important things I will focus, sir. Okay. Since we have reasonable less time, so I will focus on the important things in AS 20. Okay. See this. First of all, AS 20 is talking about what? EPS calculation. EPS, earning per share. And this is one of the important financial tools, sir. Key financial tool. And you know, according to schedule 3, when a company is preparing P&L account, last we need to disclose EPS. If you remember, basic EPS, diluted EPS, two things we need to disclose. Okay. Now this standard will provide you the methodology, how to compute basic and diluted EPS. This standard will provide. Okay. Now first we will focusing on the basic EPS. Sir, what is basic EPS? Simple. There is a formula. The formula is net profit or loss for the period attributable to equity shareholders. What is the net profit or loss which is attributable to the equity shareholders? Divided by weighted average number of equity shares outstanding during the period. So that means I want two things. So numerator I want what? Net profit or loss for the period attributable to equity shareholders. Denominator, weighted average number of equity shares outstanding during the period. Now first, net profit or loss for the period attributable to equity shareholders. Sir, what is this? PAT minus preference dividend. Net profit or loss for the period attributable to equity shareholders is nothing but what? PAT minus preference dividend. What is PAT, sir? Profit after tax. Once you get profit after tax, not before tax. Suppose they will give you PBT. From PBT first you reduce tax, then you will get PAT. From PAT you reduce preference dividend. Then whatever the balance left, this is called net profit or loss attributable to equity shareholders. Now the question is, sir, this preference dividend, in your company you may have cumulative preference shares, non-cumulative preference shares. If you have cumulative preference shares, this preference dividend will be considered even if they have not provided in the books. If the preference shares are non-cumulative, consider preference dividend only if it is provided in the books. So one aspect is completed. So now you got the net profit or loss for the period. How to calculate net profit or loss attributable to equity shareholders? What is the formula? PAT minus preference dividend. Preference shareholders dividend you reduce. Okay. Now the most important thing is weighted average number of equity shares outstanding during the period. Sir, how to calculate this weighted average number of equity shares outstanding during the period? Simple pa. Opening shares, during there how many shares we should add, minus how many shares we bought back. And every time the shares are multiplied with a time weight factor. Time weight factor. Suppose in a year there are 12 months. Now from which date onward these shares are coming into effect? From that day onwards we need to consider the time weight factor. Number of shares multiplied with time weight factor, sir. For example, you see this example number 1, sir. Suppose, sir, on January 1st, 2011, number of shares at the beginning is 1800, sir. On 31st May 2011, company issued 600 shares. On 1st November 2011, company bought back. Bought back means company buy back its shares and cancelled it. How many shares? 300. At the end we have 2100 shares. Find out weighted average number of shares. So how will you find out weighted average number of shares here? Simple. See this. Opening, how many shares are there? Opening, how many shares are there? 1800. They are there from the beginning. So into 12 by 12. Well, I will apply 1800 into 12 by 12 plus how many shares we are issuing? 600. When we issued? May. That means June to December. How many months? 7 months. 7 by 12. Minus next, because buyback reduces the number of shares. Minus 300 shares. And when they bought back? 1st November. That means they are not there in the company for November, December. 2 months. So therefore, opening shares 12 by 12. 600 added. They are outstanding for 7 months. Minus 300 shares bought back. 2 months outstanding reduced. So you will get number of weighted average number of equity shares. How many? 2100. What is the logic, sir? Logic is very simple, sir. From which date onwards the shares are coming into effective? In the standard itself, they have given the effective date of, because shares are issued for different reasons, right? So when the company issued shares, from which date onwards these shares are coming into effect, from that day till the year end, I need to take the time weight factor. Because as a shareholder, I am participating. My shares coming into effect from the particular date means I am eligible to share in the profits from particular date only. So that's why in EPS calculation, you are taking weighted average number of equity shares. So that means you are eligible for profit sharing only from that particular date. That's why they are multiplying with the time weight factor. Suppose in this case, you are issuing 600 shares on 31st May. That means your shares are there in the company for how much period? 7 months only. That's why 600 into 7 by 12. Equivalent number of shares for your time we are considering. 600 shares you invested, but in the 12 months your shares is there in the company only for 7 months. This is called time weight factor. Weighted average number of equity shares. Number of shares multiplied with what? Time weights. Okay. Sometimes shares can be partly paid up shares. In case of partly paid up shares, what do you do? So if they are partly paid up shares, sir, convert them into fully paid up shares. Like they are treated as fraction of an equity share to the extent they are entitled to participate in the dividend in relative to the fully paid up equity shares. For example, see here, in the beginning we have 2000 shares, 100 rupees face value, amount also 10 paid, sorry 10. On 1st July 2023 we issued 800 shares, face value 10, but amount paid is only 4. So therefore when you are calculating weighted average number of shares, see this, 2000 shares into 12 by 12. This 800 shares when we issued? July. So July, August, September, October, November, December. How many months? 6 months. So 800 into 6 by 12 into, what is the face value? 10. How much you paid? 4. Only to the extent of the amount you paid, you take. So therefore see this, 800 into 6 by 12 into 4 by 12. 4 by 10. So therefore here multiplied with 2 things. What are those? Time weight factor, amount weight factor. Time weight factor, amount weight factor. Time weight factor, because you issued shares on 1st July. That means they are outstanding for 6 months. And next, amount weight factor, 10 rupees face value paid 4 only. So only to the extent of that we need to take. So if they are partly paid up shares, what we need to do is to the extent of the amount paid only we have to consider the weight, your number of shares. Okay. Now the most important thing in AS20 is bonus issue, right issue. First bonus shares I will explain, then right shares concept I will explain. Important, sir, very simple. Listen to me. Sir, bonus shares, share split, reverse share split. First of all, tell me what is bonus shares. Bonus shares means shares issued freely. Now, is there any inflow to the company? No funds will come. That means whether my net profit will be affected? No. Sir, suppose you purchased the shares. Capital will come to the company. Company will invest in the business. Net profit can be affected. Bonus shares means no new funds. That means only one thing will happen. What is that? Number of shares will increase. So see this. Number of shares will increase. For example, already in the company, 1000 shares are there. Another 1000 was added. So total 2000. Imagine, sir, our company, current year 2024, previous year 2023. Suppose net profit is same. Assumption, sir, assumption. Suppose net profit is same, 10 lakhs, 10 lakhs. Last year number of shares, 1 lakh. So therefore EPS is 10 because net profit divided by number of shares. 10 lakhs divided by 1 lakh. What is the EPS? 10. This year what happens is you issued a bonus issue. That means 1 lakh shares has become 2 lakhs. Therefore your EPS is 5. Now you tell me, sir, last year EPS of this company 10. This year 5. EPS decreased or increased? Decreased. Decrease of EPS is a negative thing or positive thing? Negative thing. When the earning per share decrease, basically earning per share means how much each share earned. When the EPS is down, people will think that this company performance is bad, worst. 10 rupees last year, this year 5. But in fact, here that is not the case. Why EPS has been down by 5 rupees? Because of bonus issue. And bonus issue just increased my number of shares without corresponding increase on my net profit. It does not have the capability to affect my net profit because no new funds are coming to the organization. And similar to this, can you tell me any other type of issue of shares? Share split. For example, one single share is split into multiple shares. There also any new amount is coming? No. Just suppose one share split into 10 shares. Number of shares are increasing. Similarly, reverse share split, like consolidation, subdivision of shares. Reverse share split means multiple shares are treated as one share. Because of that, what happens? EPS will increase because number of shares will come down. But our profits is not going to be impacted. Correct? In general, if you talk. So therefore, understand, the standard says, see, because of bonus issue, your number of shares are increasing. Even though your performance is constantly same, because of the bonus issue, your EPS down. People are misled. People, when they compare EPS, they are thinking that your performance is not good. But in fact, that is not the case. My performance is same only. Last year 10 lakhs, this year 10 lakhs only. That means because of the bonus issue, people are misled by knowing that the EPS has been decreased. How to avoid this? That's why standard says make one assumption. Whenever bonus issue happened in the current year, make an assumption that this bonus is there from the beginning of the last year, and accordingly last year EPS also reached it. Suppose if I make an assumption that this 1 lakh bonus shares is there from the last year also, accordingly I will restate what? Last year EPS. So last year EPS will be how much then? 5. Suppose if this bonus issue is all there in the last year, means last year number of shares will be 2 lakhs. 10 divided by 2, it will be 5. Then they will compare current year EPS 5 with the restated EPS 5. So they will come to know that my performance is same. In fact, the net profits are same. You understand this? So this is what. So therefore, when EPS will be restated? When there is a issue of shares without corresponding increase on my resources, but there is an increase on just on my number of shares. Best example is bonus issue. So in the current year, if there is a bonus issue, sir, we need to calculate current year EPS, and also we need to calculate restated EPS of the previous year, assuming that this bonus is there from the beginning of the last year. Assuming that this bonus is there from the beginning of the last year. Hello. Sir, come to illustration 3, sir. Illustration 3. Suppose there is a company, sir, net profit for 2011, how much? 18. 2012, 60. Number of equity shares outstanding until 30th September 2012, 20 lakhs. Next, bonus issue happened, sir. See this. On October 1st, 2012, 1st October 2012 was 2 equity shares for each equity share outstanding on 30th September 2012. 2 equity share for each outstanding equity shares. That means how much bonus shares? 40 lakhs. Correct? Calculate basic EPS. Tell me, what is the current year? 2011. Hello? What is the net profit? 18. Divide by number of shares. 20 plus 40. 60 lakhs. 20 already there, yaar. Now another 40 added, na? Everybody. How much? No, sorry. Here I need to take current year. Current year profit is 60. This one, na? 60 divided by 60. How much? 1 pa. Current year EPS 1. Last year EPS pa. Previous year EPS 2010. Can you 2011? This is 2012. 2011 EPS 18 lakhs divided by 20. 0.9. And also here what I need to do? Restate the last year EPS. So if I restate the last year EPS, this bonus is there from the beginning of the last year. So therefore here 18 lakhs divided by 60. This 20 plus 6 total 60 lakhs. So therefore what will be my restated EPS? 0.30. So users will compare this one and this one. Okay. Now next, the most important topic in this chapter is right issue. See, whenever in the question if there is a right issue, how to calculate? Sir, I will tell you simply, listen to me. Sir, what is right issue? Company offering shares to existing shareholders at concessional price. So in right issue, what is there? Bonus element is there. Bonus element. For example, the market value of the share is 20. Company offering at 15. That means what is the concession? 5. So there is a bonus element in right issue. When there is a bonus element in right issue, the treatment is similar to that of bonus issue. This bonus is there from the beginning of the last year, because here the assumption is I am giving bonus means I am not receiving any funds, just my number of shares are got impacted. Therefore I need to restate the last year EPS by assuming that this bonus is there from the beginning of the last year, in order to avoid the confusion to the users of financial statements, in order to give correct presentation, fair presentation to the users of financial statements. But the problem is, in case of right issue, how much is the bonus element? That I need to find out. Bonus element I need to find out. So therefore in the standard they have given a formula for bonus factor. In the right issue, I know I am offering at a concessional price. There is a bonus element. But how much is the bonus is there? I need to find out. For that there is a formula. What is the formula they have given, sir? Fair value of the share before right issue. Before right issue, what is the fair value? You take it. Fair value, market value, before right issue, whatever the share, divided by TERP. TERP means theoretical ex-right price per share. Theoretical ex-right price per share. Nothing but average book value of the share. TERP means market value or fair value before right issue divided by TERP. How to find out TERP? See this. TERP is equal to what is the fair value of the shares outstanding before right issue plus what is the amount company is receiving from issue of right shares divided by total number of shares after right issue. Fair value of the existing shares plus what is the amount received by the company from issue of rights divided by total number of shares after right issue. For example, before right issue, see this, 10 shares are there. Market value 20. So 10 into 20 plus company is giving 20 shares, right shares. That means for one share, 2 shares they are giving at 15 rupees divided by existing shares 10, right shares 20. Find out the TERP. How much we got? 16.67 is what? TERP. If I want bonus factor, what I need to do? Fair value divided by TERP. What is fair value? 20. Fair value 20, sir. See this. Fair value 20, 16.67 is TERP. Multiply, divide 20 divided by 16.7. 20 divided by 16.67. 1.19. That means 1.2. Hello. This is bonus factor. Simple. This 1.2 you multiply with 10 shares. These are the number of shares existing. 10 into 1.2. 12. 12 shares. That means 2 shares are bonus shares. 2 shares are bonus. Already how many shares are there? 10. Bonus factor 1.2. Therefore the assumption is this bonus is there from the beginning of the last year. Suppose if the last year shares are 10, I need to multiply this 10 with bonus factor. 10 into 1.2. 12. So therefore last year EPS I need to restate. So you need to remember the formulas here. You need to remember the Formulas. The formulas are very, very important. So therefore, 10 into bonus factor, that is 2 shares are the bonus shares. Like this, you need to find out. Okay. Yeah. One question I will solve, sir. Superb question. This question only again and again they are repeating in exams. Sir. Same question they are repeating. See this illustration 4, everybody. See this illustration. Net profit for the year 2011. How much? 2012, 15. Number of shares outstanding prior to right issue? 5. Right issue price? 15. That means offer price. Last date to exercise rights? 1st March 2012. Right issue is 1 new share for each 5 outstanding. That means how many right shares? 1 lakh shares. Because already 5 lakh shares are there. Divided by 5 into 1. Correct? Fair value of 1 equity share immediately before right issue, how much? 21. Calculate basic EPS. So, current year 2012 na? Everybody. See, in this question, what is the current year net profit? 15. Number of shares before right issue, how many? 5. Now, how many shares company is giving as right shares? 1 lakh. When they are giving, what is the last date to exercise right? 1st March. 1st March. That means, if I apply time weight factors here, 5 lakh shares are there from the beginning. And from 1st March, another 1 lakh shares were added. Correct? That means this 1 lakh shares, they are following calendar year here. January to December. So therefore, this 1 lakh shares are outstanding for how much period? 10 months. From 1st March to December. This 5 lakh shares are outstanding for 12 months. Hello? But here the assumption what we are taking? The assumption is in the right issue there is a bonus element. That bonus is there from the beginning of the last year. That is the assumption we are taking now. So that's why in case of right issue, first calculate bonus issue. How to calculate bonus issue? What is the formula? See this, bonus factor or adjustment factor. Fair value per share immediately before exercising of right. How much given? 21 divided by TERP. Theoretical exercise fair value per. How to find out theoretical exercise fair value per share? See this. What is the fair value immediately before exercising of right? 21 into how many shares? 5 lakhs. Plus each share we are offering at 15. How many shares? 1 lakh shares. Divided by 5 lakhs plus 1 lakh. How much we got? 20. So 21 divided by 20. 1.05. So you see 5 lakh shares into 1.05. How much 5 lakhs into 1.05? Before right issue, how many shares? 5 lakhs. 5 lakhs. This 25,000 is nothing but bonus element in the right shares. So therefore, if I want to find out current year EPS, see this. EPS for 2012, how I am finding this is, see this. EPS of the current year, 15 lakhs is my net profit. Divided by weighted average number of shares is 5,87,500. Sir, how you got this 5,87,500, sir? How many shares are there with me in the current year? 5 lakhs into bonus factor. And this is there for first 2 months. From 1st March onwards, the number of shares will be 6 lakhs. 10 months you take. Sir, 5 lakhs into 1.05. That is 5,25,000 shares are there from the beginning of the last year. That means they are there from the beginning of the current year also. That's why 5 lakhs into 1.05 outstanding for 2 months. Now from 1st March onwards, how many shares? 6 lakh shares into 10 by 12. How much we got? 587,500. So you will get 2.55 is what, sir? EPS. So here the assumption is actually how many right shares? 1 lakh. In this 1 lakh, 25,000 shares are there from the beginning of the last year. 75,000 added from 1st March. That's why see when you take weights, 5 lakhs into 1.05. I consider 5 lakh 25. That means this 25,000 shares I am considering for how much period? 2 months. From 1st March onwards, 6 lakhs I done. That means in the 6 lakhs, 1 lakh shares is there, na? Hello? That is taken for 10 months. Everybody? So this is how right shares treatment will be done, sir. So in case of right shares, first find out the bonus factor, sir. This bonus factor, assume it is there from the beginning of the last year, and accordingly last year EPS will be restated. Here in this case, last year EPS is restated, sir. You see, 11 lakhs divided by 5 lakhs into 1.05, 2.10 is the restated EPS of the last year. Last year number of shares 5 lakhs now, multiplied with bonus factor 1.05. So 5 lakh 25,000 we restated. You understand how this outstanding amount we have arrived, sir? Why I multiplied 5 lakhs with 1.05 in the current year? Because that bonus is there from the beginning of the last year. That means it is there from the beginning of the current year. So first 2 months, then next it will become 6 lakhs. That 75,000 is also added. So that means bonus element in the right issue is there from the beginning of the last year, and from 1st March onwards, original shares with full consideration, I can say 75 added. Correct? Now this is basic EPS, sir. Right issue factor questions. Now see, there is one more concept called here diluted EPS. What is diluted EPS? Diluted EPS. Simple. Diluted EPS means, suppose in the company there are potential equity shares. Potential equity shares means they are not equity shares, but in future they may become equity shares. For example, convertible debentures. They are not equity shares. In future they will become equity shares. If convertible debentures are become equity shares in future, my EPS will decrease, na? Because number of shares will increase. Hello? See, that's why if there are any potential equity shares are there in the company, what we need to do is, we need to consider the effect of conversion and we need to calculate EPS. If EPS is down, decreased, that is called diluted EPS. That means those potential equity shares are having the dilution effect. So what is the formula for diluted EPS? Same, net profit or loss attributable to equity shareholders after giving effect to potentially diluted equity shares divided by weighted average number of shares outstanding after giving effect to potentially dilutive equity shares. After considering the dilution effect, what will be my net profit? What will be my weighted average number of equity shares? You calculate. Then you will get diluted EPS. The existing basic EPS should decrease. Then only it is diluted. Suppose these potential equity shares, if they converted, EPS is not decreasing, increasing. They are anti-dilutive. Ignore. They are anti-dilutive. Ignore. So diluted EPS is calculated only when the potential equity shares are having which effect? Dilution effect. Hello? For example, convertible debentures are there, sir. If I convert convertible debentures, what happens? Tell me. Number of shares will increase. At the same time, interest cost will be saved. To that extent, my net profit will increase. And also, interest cost saved means tax I need to pay. So suppose, for example, savings in interest cost 1 lakh, on that 30% tax. So therefore, what is the savings in interest cost net? 70. Add to the net profit divided by number of equity shares. Number of equity shares means weighted average number of shares plus, if I convert potential equity shares into equity shares, how many shares will be added? So both numerator and denominator will be affected by conversion, and then calculate the EPS. If the EPS, basic EPS, if the EPS came is less than the basic EPS, then it is diluted EPS. Like this you need to consider, sir. But here one important point, sir. Share options. See, I will solve one question. This question, sir, I think, yeah, this question, illustration 6. See this question once. What is the net profit for 2011? 12. What is the weighted average number of equity shares during 2011? 5. What is the average fair value of one equity share? 20. Weighted average number of shares outstanding option during 2011 is how much? 1 lakh. Exercise price for the share under the option is 15. Calculate basic and diluted EPS. So, in the year 2011, sir, you see your net profit is 12 lakhs, sir. Your weighted average number of shares outstanding is how much? 5 lakhs, sir. So, basic EPS 12 lakhs divided by 5. Correct? 12, 2.4. Basic EPS. Hello? Now, in the question, they have what? Options. They have options. Option is what? Potential equity share. Option means, suppose ESOP, employee stock option. Company give option to employees. In future, they can exercise. That means in future, these options will become shares. That means they are potential equity shares. Now tell me, in this case, each option is given at what price? 15. But what is the fair value? 20. So therefore, you need to find out how many shares will have the dilution effect. Here, see this, company is collecting how much amount, sir? See this. Actually, how many options company is giving? 1 lakh. See this, 1 lakh into 15 rupees they are collecting. How much? 15 lakhs. Divided by, suppose the fair value is 20. So if I allocate at fair value, how many I need to allocate? 75. See this. That means, important sir, I am allocating 1 lakh options at 15 rupees. Suppose if I allocate at fair value, I should allocate only 75. That means how many options I am allocating without consideration? 25. Only 25,000 options will have dilution effect. Therefore, when you calculate diluted EPS, sir, 12 lakhs divided by 5 lakh 75,000 you need to take. 5 lakhs already outstanding plus 75, not 75, 25. 25 we need to consider. 25. Because in this 1 lakh options, only 25,000 options have dilution effect. Why they are called having dilution effect? Because just number of shares are increasing without increasing in the profit. Therefore, definitely they will reduce EPS. Therefore, in options, the dilution effect is there only for those shares, those options which is given freely. How much amount I collected? 15 lakhs. If I allocated fair value, how many I allocate? 75. But I am allocating 1 lakh. How many options I am allocating without consideration? 25. Only those 25,000 options will have dilution effect. That's why, see here, 12 lakhs divided by 5 lakh 25, 2.29 is what? EPS. I think this is one of the important point. They may ask this question. So you understand this? In case of options, the dilution effect is there only for those options which is received without consideration. How to find out the shares without consideration? Simple. 1 lakh into 15 divided by 20. You will get number of options that have been issued at fair value. 75,000 only we need to allocate. But how much we are allocating? 1 lakh. So therefore, how many options we are allocating without this? 25,000. Only that much will have the potential dilution effect. So age 20, that's it sir. I am covering only to this extent because lack of time. So this extent only, please complete sir. Everybody, okay?